to what the former Fed Vice Chair Roger Ferguson had to say, and speaking about the expectations that he's expecting from the upcoming Trump administration, the decisions that are likely to take place and that could impact the U.S. economy. Listen in to his thoughts.
There will continue to be, tax cuts. I don't think they'll manage to cut government revenue as much as they want or government expenditures as much as they like. And so I do think their policies are likely to be more towards deficit spending for sure, which could feed into rapid growth, but it could also feed into greater inflation. So I think the only thing to expect right now is a little bit of wait and see. What an expectation, though, are probably slightly higher inflationary pressures because of deficit spending likely to continue.
Okay, that's all the global overnight action that we've seen coming in. But how are all these cues going to be impacting our Indian markets? We will go across to our research team who is standing by to tell you what the trade setup is looking like and what are the important stocks that we're keeping on our radar this morning. Good morning, Vivek, as well as Hormaz. And Vivek, let me start with you first. All these cues that we saw coming in, nothing exciting. What is this trade setup looking like today for the Indian markets?
Well, good morning, Vinny. It's the last trading day as far as calendar year 2024 is concerned. Going into the last day or the last trading session of this particular year, what is it that we are looking forward to? Slightly muted cues, like you mentioned, all of the US indices closed in the red, but off the session low. So there is some slight minor positive takeaway from, but nothing taking away from the fact that 2024 has been a very strong year for equity markets, especially as far as US equities are concerned. Now, yesterday, an interesting trend, natural gas prices across USA surged almost 20%. This was on the back of a higher or a much stronger than anticipated winter as far as the month of January is concerned. Crude oil prices inched up slightly, Brent now trading near the $74.50 a barrel mark. Now, coming to the Indian markets, yesterday, very volatile trading session. The first couple of hours, you actually saw quite a bit of strength. The Nifty Bank at one point of time was up almost 1.4%, but then saw a very steep sell-off. Nifty Bank cooling off over 2% from the day's low. Most of the indices traded in the red. The only index that managed to marginally outperform was the Midcap index, and on the back of that, the Midcap index saw significant outperformance, especially against the benchmark indices that were seeing quite a bit of sell-off. There was also a bit of rebalancing, especially as far as the CPSE pack was concerned. So volumes over there, delivery volumes there were quite strong as well. Now, going into today, remember, market rate yesterday was in favor of declines. FI selling continued even, in what essentially a very thinly traded week as far as volumes are concerned. Asian markets, GIFT Nifty, all indicating a subdued start for our own markets today.
Okay, indicating a subdued start for our own markets today, but important stocks that you should be keeping on your radar this morning. Let me start with Mazgaon Dock. Now, the company has signed a contract with the Ministry of Defense, which is valued at around 1,990 crore rupees. This is mainly for construction of independent AIP plugged-based technology developed by the Defense Research and Defense Organization. So that is something that we are keeping an eye out on. Moving on, we have Ease My Trip that will be in focus. Now, sources say, CNBC sources say that co-founder Nishant Pitti is set to sell the remaining 14.21% stake for 780 crore rupees today. That's a one to watch out for. We have seen Nishant Pitti selling and reducing his stake in the company for a while now. Let's move on to Hindalco because that is also in focus. Now, the company has been allocated the Meenakshi coal mine in Odisha. The allocation has was formalized through vesting order, which was issued by the Ministry of Coal. Shriram Properties is the next stock that you should be keeping on your radar. They've announced a strategic sale of 3.9-acre land in Chennai, so keep an eye on that. RVNL, they bagged an order of around 137 crores sent from the Central Railway contract, and this is something important coming in there. Lupin, they've acquired a drug from Eli Lilly, which is a type 1 diabetes and type 2 diabetes drug that is Humosulin. So this is adding to the diabetes portfolio. So keep an eye on that one. Plus, one of their litigations with Teva and another company in the US that was going on. Now, there's a delay, Amneal. So there was a bit of a delay that is coming in on that front. And that would lead to a positive move coming in for Lupin. So keep an eye out on that stock. Okay, that's the stock to watch out for a trade. But let's move on and go across to Hormaz, who's standing by to tell us which are the important F&O cues in today's trading session. Good morning, Hormaz.
Morning, Vinny, and nothing exciting as you just mentioned, right? Final trading day, you end the year usually on a high, but the GIFT Nifty is indicating anything but that. As of now, another gap down start that is likely for the Sensex and the Nifty. Short positions were seen both on the Nifty and the Nifty Bank in yesterday's trading session, and the index breaking below key support levels at 23,700 was that level to watch out for. It's closed below that, so now downsides open up further, and FIIs, the ones that are still around, continue to remain net sellers in the cash market. They were net sellers in the index futures as well in yesterday's trading session, and the net long exposure now is down to 14.3% as of closing during yesterday's trading session. Even the clients added 2.32 lakh contracts in yesterday's trade. Now the short exposure now 1.97 lakh contract short now are the FIIs as we speak. Now when it comes to the options data, there has been significant call writing that is seen at higher levels, be it 23,800 or 24,000. So now what was earlier a support has now become a barrier for the index to cross on the upside, and as I mentioned, the downside levels have opened up is evident from the fact that there was some writing seen in the 23,200 and the 23,300 put options as well. So those are the levels to watch out for going into today's trade. The immediate support, of course, comes in around 23,550 and 23,800, of course, because of the call as per the options data. That becomes the first barrier on the upside that the Nifty has to cross. And in terms of stocks, there are no stocks in the F&O band today, but keep an eye out on Adani Enterprises. The stock was in the news all through yesterday's trade, and fresh long positions seen in that stock as well. So keep an eye out on Adani Enterprises, but downside levels, the one to watch for the Nifty.
Thank you so much for that, Hormaz. But on that note, we're going to slip into a very short break. Up next, we have Reserve Bank, which has released its financial stability report. We'll get you the highlights of that report on the other side.
Time highs, while the lesser-known altcoins like Palm AI and Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor, with market cap now at $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and blockchain as a technology, and the markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein now expecting $200,000 per Bitcoin. MicroStrategy, in the meanwhile, expects Bitcoin to rise 29% per annum over the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
We are looking at multiple product level acquisitions in the US and outside US as well to add to our current offering in the market. Again, our idea is not to acquire those products and launch a generic version of it. We'll again create some uniqueness around it, launch a novel strength or a combination of a product, and then launch it in the market. On injectable side, as we speak, we will start the construction. I think in next few months we'll form up our plans in terms of establishment. Product development is already started, so there are a lot of products we are currently working on the injectable space that we want to do it in the US market. So as the product development will happen, we also want to acquire few products on the injectable space as well.
I am happy to inform that we have just 2 days back, we have received the consent to operate letter, and we have just, the unit has been lit up, and maybe it's a matter of few days that the synchronization of the unit will also happen and the COD. I'm happy to announce that as we have been maintaining that we'll be close to 10 gigawatt with our Greenfield projects which are getting commissioned by year end. We are on track of that. And over and above this, with this O2 acquisition.
Welcome back to Power Breakfast on CNBC-TV18. Let's move on. And the RBI has released a financial stability report last evening. Now, this is showing a rise in bad loans and warned about the sharp increase that one is seeing in terms of write-offs at private banks. Ritu is bringing us more from the central bank's recent stress test.
I'll start with some of the key risk areas that RBI has flagged off in the Financial Stability Report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections, but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
Thank you so much for that update there, Ritu. But let's move on. And as equity markets look ahead into 2025, Survi gets us the 5 key factors the market will be looking out for as we move into the new year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full-year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity, and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Thanks so much for that, Surbi. But on that note, we're going to slip into a very short break. But after the break, we'll get you what's happening in the world of commodities with Manisha Gupta.
Operational capacity current and by June 25 reaching 2.3 gigawatt. And once the KSK process happens, I'm happy to tell that by June 25, we will be definitely exceeding significantly the 10 gigawatt number. That we are getting a very, very high quality asset, and which is close a total at a built up to 4.7 gigawatt of capacity, out of which by June 25 almost 2.3 gigawatt will be operational. And as we are aware of wind build of around 8 to 8.5 crores per megawatt. Then we see that what is that turns to for 4.7 gigawatt. We have found this very, very attractive.
...2024 began with a bitter pill for contract development and manufacturing organizations or CDMO players. A muted biotech funding environment dampened the pace of early-stage projects, leaving these biotech firms feeling the heat in 2024. But here's the good news. Positive triggers are emerging on the horizon, and there are clear green shoots that are visible and indicating a turnaround for the sector. The first one is an uptick in biotech funding, signaling a recovery expected in CDMO players. Demand for CDMO services in late stage as well as commercial molecules is also on the rise. Moving on to the third one, we have broad-based commercial contracts in biologics and small molecules that is picking up pace, as well as biologic CDMO demand that has remained robust, and we are expecting the good growth to continue going forward. Nutraceutical manufacturing demand that is also recovering quite steadily, and now we will shift focus and talk about what the highlight and commentary is coming in from the CDMO players. That's a key one, because what they're signaling is that maybe in the near term, there could be some mixed near-term challenges that we're watching out for. Welcome back to Power Breakfast on CNBC-TV18. But it's time to go across to Manisha Gupta, who's standing by to tell us what's going to be happening and what's happening in the world of commodities on the last working day of 2024. Manisha.
Vinny, thank you for that. And, even if it is the last working day, we've still seen some bigger moves coming in for commodities. I mean, we do understand that this is on the back of lower volumes. But look at the crude oil prices, and it was a percentage higher overnight. We're looking at prices trading at a 5-week highs now, and the prices have gained by 5% in the past month as well. Well, the markets are reacting to decline in U.S. inventories. There is colder weather in U.S. and Europe, and forecast of that continuing for the next week and 10 days as well. And then there are hopes of economic stimulus coming in from China. So markets clearly are taking support from that. Not the same case when you look at some of these metal prices, because silver declined 1.5% overnight. It's now trading at a 3-month low, and silver prices now has slipped below $29 an ounce as well. The hawkish U.S. Fed and uncertain industrial demand outlook seems to be weighing here. And then there is pressure also continuing in case of copper. That also fell 0.5% overnight. Copper is now trading at a 3-month lows. The China manufacturing PMI data that came in today has continued to decline. And the markets now are waiting for Chinese details on stimulus measures. That is still awaited. So even as copper prices have gained up by 5% in this year, they're still down 30% from the kind of highs that we saw in the month of May in 2024. So, well, yes, even as it's the last day of the year, we still have a big moves coming in for many of these commodities.
Absolutely, Manisha. Thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. Thanks so much for tuning in. Up next, Bazaar Morning Call. Outlook that is coming in for the medium term. Pharma is expecting to see early teens growth as the CDMO segment is outpacing the company's average growth. DB's Lab, they remain quite confident in terms of a double-digit growth in terms of revenue. We have Syngene, Laurus as well as Newland Labs. Now their commentary is quite similar, because what Syngene is saying that they're expecting high single-digit growth in FY25, but FY26 expected to be stronger. Similarly for Laurus Labs, expecting a soft growth in FY25, but a good growth from FY26 and onwards. And Newland Labs also flat growth in FY25, but targeting a 20% CAGR growth in the medium term. Now let's look ahead. The industry is poised for an acceleration in terms of top-line growth. Currently somewhere at 9%. By FY27, 16% growth is what one is watching out for. However, valuations, that's the key concern coming in here, because valuations currently are ranging somewhere between 47 times to 60 times for these players. Following the surge that we've seen coming in on a YTD basis in terms of a stock performance, that was somewhere between 40% to 80% in the run-up that we're seeing, which is outpacing the Nifty Pharma's 34% rise that we saw this year, approximately on that front. Now, finally, here's what investors and analysts need to keep an eye out on. One is the progress in terms of the Biosecure Act, when it's going to be picked up in the US Senate. Moving on to the next one, we have seen sustained recovery in biotech funding. Will that continue in 2025? That's going to be a key factor. Uptick in RFQ surely is there, but are they translating into confirmed orders? Keep an eye on that, as well as company-specific new launches. What is the trajectory that they have for price erosion in generic APIs is something that is very important for CDMO players. The CDMO sector is navigating a complex landscape of challenges and opportunities that they're seeing. While there are signs of recovery that is quite evident, sustained momentum will be a hinge on factors like funding, legislative support, as well as execution capabilities of these key players. However, could these stretched valuations limit the sector's ability to deliver significant gains in 2025? Let's watch out for that.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now, what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now, with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now, over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25 as well, which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning and welcome to the CNBC-TV18 Motilal Oswal studio. This is Bazaar and I'm Lata Venkatesh. With me is my colleague Rima Tendulkar. Well, it's one of those mornings when trading is going to be thin, when everyone is actually planning what they are going to do tonight. And there is no US trading tomorrow, or rather most markets will not trade tomorrow. So we could have two things, an extremely thin volume trade and therefore a lot of wonky moves because it's easy to move markets today.
Indeed, there's so much festive cheer outside, but when you look at the trading screen, the way we traded yesterday, it's just a bit like, there's fatigue which has crept in, or it's a little lackluster. And even US markets, they were under pressure for the last 2 trading sessions.
No, I take your point. That will be the inaugural cue that the US markets had a bad 30th. And whether that will cast shadows, between 1 and 1.2%, all the indexes. But my sense is that what impacts Indian markets, or for that matter, emerging markets, are the other 2 parameters, which is the bond yields and the dollar index. And there, the bond yields have fallen by 8 basis points, which is usually EM positive. I mean, if you're an algo trader with an EM and a US, trading, and the yields fall, then it is normally positive EM. Likewise, dollar index has slipped below the 108 mark. It's a small fall below the 108 mark. By no means is the dollar weak. But what I'm saying is there is no incremental bad news from both these places. So my sense is this is as good a time as any that the bulls can use, or funds can use, institutions can use to prop up NAVs. Simply because the other props are in our favor. The other point I want to note, however, is that the FIs are not out of the market. Yesterday, not only was there a sell of nearly 2,000 crores, 1,890 crores. Do you see the gross volume? It's like 17,000 crore sell and some 15,000 crore buy. So it's a substantial 33,000 crore of participation. That's not a small participation.
But yesterday was also the Nifty quarterly rebalance. So stocks like NTPC, for instance, saw a little bit of a weight up. There were a lot of adjustments, so that could have impacted volumes yesterday.
Okay. Thanks for that, Reema. But my sole point is that the cat is not quite away. Nevertheless, I think today is going to be a thin trading day, and I expect a lot of green on the screen and dressed that way simply because I think there will be at least NAV management today.
Okay, but just a quick recap then of how we fared yesterday. Well, yesterday was a bit of a disappointing session because it showed promise. There was an intraday surge, but at elevated levels in the second half of the trading session, selling pressure kicked in. The Nifty ultimately ended at 23,644, a cut of about 0.7% below the 200-day moving average. But just take a look at the key levels over the last couple of days. Now, yesterday, the Nifty made an intraday low of 23,599. This is lower than the lows that we've seen over the last 5 trading sessions. And the high yesterday, 23,915, pretty much coincides with Friday's high. So now the boundary for the market just over the near term is 23,900 on the way up, yesterday's intraday high, and on the way down, 23,600 thereabout. And yes, while the FI selling did pick up yesterday, as Lata said, nearly 1,900 crores sold in the cash market, the DIIs did buy a little bit more. So 21,073 crore was bought by the DIIs in the cash market. The China manufacturing PMI data is also out. So just a quick word on that. It's expanded, which is positive, 50.1 in the prior month, but this is lower than expectations of 50.3. So clearly the stimulus, whatever measures they've announced, is not enough. So the expansion in China is not keeping pace with the expectations. So that's a bit, and we should pull up the Asian markets. Very, very quiet moves so far.
Now, I take your point on that. Let me put just one more worry on the table. The Reserve Bank's financial stability report. Let me first tell you that the financial stability report is intended to check out how banks and financial institutions will do when they are under stress. But it doesn't mean that that is the base case. It is an extreme case.
So it's like a stress test?
Yes, it is a stress test. Okay. So, basically, suppose cryptos were to fail. Suppose there is a cyber security risk. Suppose there is a big, bad loan, or there is a big event in global markets. The over leverage that you see in global markets suddenly turns bad. You imagine all these scenarios and then say that loans can, kind of fall. But what the RBI is saying is even with extreme stress scenarios, Indian banks will not go under. Even if the top 5 banks have this level of stress, even then no bank fails. So actually there is a positive in the report they are giving, and all these are scenarios. They are not exactly what the government or RBI expects, because they have not even lowered their GDP forecast. The GDP forecast is as of December 9th, when they said 6.6. So they're not expecting it. It is a rosy picture as far as the Indian growth is concerned. I mean, 6.6 is bad compared to 7, but it's a good rate of growth to work with. And therefore, we must take these scenarios with a pinch. The only part I would worry about is where they're talking about unsecured loans.
But that's not new to the market, right? We've been flagging it off. Corporates too have been talking about the stress in the unsecured portion, in the unsecured portfolio. So in that sense, it's not that it's a new, fresh negative development for the markets, a new unknown.
No, when Reserve Bank reiterates it,
the
market worries a bit. Yes, you worried us. Last November, the risk weights on unsecured loans were raised to pre-COVID levels. So, okay, they do say that the percentage of unsecured loan has slowed. But they do point out that private banks are showing high level of write-offs. And there is increasing incidence of one person having multiple loans. I mean, he has a credit card loan and perhaps a personal loan. And he's also a person servicing an auto loan and a car loan. So that worry is very,
documented by. All right, let's take stock then of the way forward, how the global cues are stacking up as we head into next year. Rupal Bhanchali, Chief Investment Officer, Global Equities at Double Duty Money Management, now joins us on the show. Rupal, it's so great to have you on the final trading day of 2024. And what a year it's been. It's blown past everyone's expectations, particularly the US markets. In a span of 2 years, the S&P 500 is now up 50%. Who would have thought that? But now, given that, given where we're starting off, what do you expect in 2025, the first half and second half?
It's really hard to make predictions. I prefer to prepare rather than predict. And I think what I would do to prepare is to watch the bond markets very carefully, because if you notice, the 10-year bond rate in the US has shot up quite a bit. And in fact, while equity markets perform very well, the bond markets did very poorly. And I think it's really behooves equity investors to take their cues from the 10-year treasuries, which is about 4.6%. If you look at the leveraged loan market and you look at the consumer credit market in the US, it is already showing signs of stress. The default rates are spiking up, and this does not bode well. Whenever risk appetite reduces, equity markets do poorly. So unfortunately, I don't have a very positive view on market performance next year, whether it's the first half or the second half. I think a lot of the stresses that have been hidden from view because of the obsession with AI and other technological improvements, we are ignoring a lot of the challenging news that's coming out of markets.
Okay, well, that's well put, Rupal. In fact, we were just discussing, Rima and I, about similar fears that the Reserve Bank has expressed in its financial stability report yesterday about the Indian consumer, some of them being, or a rising number being over-leveraged. But before I come to that, let me parse the other statements that you made, that the bond yields are rising and the equity markets need to worry about that. Why does that worry you?
Well, I think the bond market vigilantes, like they did in the UK, are expressing their views in the US that they are worried about long-term inflation. I think we've been coming off a period of excessive stimulus, whether it was monetary stimulus post-GFC or COVID-related stimulus, in the more recent years. Worldwide, we've had a lot of money being given to corporates or to consumers. And that excess, has a price to pay. Inflation is not coming under control. And that's what the bond market is worried about, that with the incoming presidency, that those deficits will not be addressed. This is true in Brazil as much as it is in the US. So I don't want to single out any particular country. The French market is facing the same conundrum. And so I think it's a global phenomenon. And I think it'll manifest itself in people charging a higher risk premium in markets.
Okay. Rupal, at the moment, in spite, these risks are known. I mean, we have been looking at the bond markets day in and day out, hour in and hour out. But nevertheless, people are going on piling their savings into the Nvidias or to the Magnificent Seven or even lower down. Would you not do that as a chief investment officer? wouldn't you still continue to believe that a large number of US stocks are still doing well, that they will probably get tax cuts and their EPSs may actually increase in 2025?
Actually, if you look at the budget deficit, I think the market is saying the scope for tax cuts is quite limited. But besides that, I think your larger question is, how would I invest in markets as a CIO? I think there are investors who play momentum and there are investors who play fundamentals. I am the latter. So I totally understand your point that, when the market is running away from you, there is a feeling of missing out, the classic FOMO. I guess I don't feel that because I've been in markets for 30 years. And I know the overhang and the after shock that these sorts of bubbles can create. Ultimately, valuations matter in pricing an asset, and valuations act as a gravitational force down. We are all trying to be astronauts, and I think we need to come down to earth and recognize that we need to walk, and we won't have artificial support allowing us to fly.
Fair point. So what would be your picks at this point in time? Which markets or which kind of stocks, sectors?
Ironically, for all my concerns about the the credit sector, credit markets that I just expressed, I actually think banks in emerging markets are a very good way to invest, both for capital appreciation, because they're quite undervalued when you look at it from a price to book or a price to earnings perspective, and also from a credit quality perspective. Banks actually have become far more circumspect since the GFC, and they've actually gotten rid of a lot of risk on the balance sheet, and they're quite well capitalized. I'm not saying every bank, but I think in emerging markets, the real rate of interest is quite high. And I find blue chip banks, leading banks in the countries, have actually sold off or underperformed as people overinvest in technology. And some of the names I would mention, certainly in Latin America, which I think is one of the cheapest markets in the world, you will find banks like Banorte in Mexico or Credicorp in Peru, and many other banks of that ilk. In fact, coming home to India, as you well know, HDFC Bank, one of the most blue chip banks in this country, has underperformed. And the reason they've underperformed is because they've taken it on their chin to engage in better risk management. They are one of the few banks that is refusing to grow their loan book in the unsecured consumer market and actually have reduced it. Now, that hurts margins in the short run because consumer credit unsecured is one of the highest margin loans you can make. But I think they are showing circumspection, especially because of this RBI report and other things perhaps they are seeing in the market. I would bet with a smart money like HDFC Bank and actually prefer to not take risk today so that you can actually take it tomorrow when you're paid to take it. So these are some of the opportunities that I find interesting in the markets. There are many others, of course, but I thought the banking sector globally, with interest rates, being high, remaining high, are actually very positive for their spreads.
So HDFC Bank is one of your top ideas for India. What else, Rupal, do you like?
Not much else. I'm an intrinsic value investor, and I think I've been on your show for many years, and I actually have not participated in this Indian rally, which has of course gone on for a multi-year period. But I think as long-term investors, we sometimes know when you should lose the battle to win the war. And in order to win the war, sometimes you need to give up on short-term gains and avoid long-term pain, which is, massive corrections. I've been through many bear markets. And while, this one has eluded one for a long time, and I'm not alone in my view, so I'm hardly non-consensus here, I think there comes a time when you have to look at the data. So let me give you one point you've made is, what's different now? Because these concerns have been around for a long time. I think the difference now is you're looking at the data, you're seeing the default rate in the most vulnerable end of the market, which is the leveraged loan market and the unsecured consumer credit market, deteriorate, not just in India, but even in the US. The other point I would make is look at the profit warnings that have come out. They've all come out from consumer goods companies. Fast-moving consumer goods companies have profit warnings in India. They've had profit warnings in the US. They've had profit warnings globally. Now, whether it's a low-end consumer in the discount store market, which emerged initially in the US, or it is the high-end consumer in the luxury goods market, which is either unwilling or unable to spend, now it has seeped into the mid-end consumer. So worldwide, you're seeing profits, being eroded because the pricing power that we thought consumer goods companies had are actually not playing out in practice. So I think inflation, finally is hurting the pocketbook in a way that is now affecting corporate profits. I think that's why the day of reckoning is sooner rather than later.
Okay, that sounds dire, Rupal. But we had fund managers for year-end chats, and one of them told us that that's why he will buy FMCG. He thought that there was sufficient scare around them. Like HDFC Bank, they're also one of the underperformers of 2024. So buy because the market fears. Is that not a strategy?
I'm not afraid to go against the grain of the market momentum and actually lean into fear, because that's when you get some opportunity. Unfortunately, these stocks have been so expensive. They've priced in so much growth that the valuations are still not compelling. Unlike in the case of the banking sector, not necessarily in HDFC Bank, but some of the other banks I mentioned, you can get dividend yields of between 5 to 8%. That is sufficient rate of return on the dividend alone that I don't even have to worry too much about capital appreciation on a long run basis. Not to mention these are ROEs of 15-20% on very low leverage. So I think the FMCG sector has yet not offered compelling valuations globally, which is why I'm staying away. But I'm not averse to it. They're getting close to that level.
Okay, that's good to hear. Well, let me just be the devil's advocate. In this case, the devil is the bull. We had big fears 2 years ago and even last year that the US is going to end in a recession or going to see a recession as the Fed starts hiking rates. That didn't happen. Look at the US GDP. I mean, it's a picture of strength. So, can we be discussing similar fears at the end of the 2025 as well? Yes, there will be fears, over leverage, likelihood of inflation, but nevertheless, good corporate earnings. Is that a possibility?
So again, you're absolutely right. Many of us have been proven wrong in our assessments because some of the leading indicators, which was an inverted yield curve, which has traditionally been a very good marker of a recession, frankly, did not play out. I think a lot of this has to do with excessive fiscal stimulus. In the short run, you can prime the economy in ways and at a magnitude that is very hard to ignore in the short run. But in the long run, it catches up with you. This is happening in major markets like France. It has happened in the UK. Brazil, the real has actually collapsed because the fiscal deficit is out of control. I think the US is not far behind. So this is why I think the day of reckoning is sooner rather than later. That said, as investors, our job is to make money for our investors and to avoid areas where you're likely to lose it. And so there is opportunity in the market. It's a question of finding it. Another example is the tire industry. The automotive sector has been hit hard, again, as a consumer is avoiding durable goods as much as they're avoiding, fast-moving consumer goods. And in the durable sector, the automotive sector, the tire industry tends to be more resilient and is trading at very attractive valuations. And they are big beneficiaries of some of these trends that we're talking about, whether it's, move to EV, a move to larger vehicles, which everybody seems to enjoy, SUVs as opposed to compact cars. It's also playing on the mining tire industry because, mines tend to be very far from the ports and you need heavy truck and therefore truck tires, to ply those goods to where they're needed. So I think there are opportunities in the market. They're just not the obvious ones. And so we are fully invested in our clients' portfolios. The question is, are they the popular stocks or are they the compelling stocks? We would choose the latter, even if it means sacrificing near-term gains.
Okay. Well, I think I know the answer to what I'm going to ask you, but nevertheless, since this is the talking point here, the big winner, we don't have a magnificent 7, but we've had these wonderful e-commerce stocks, the Zomatos, the Zaggles, Nykas, Swiggies, which have done very well. And, we have some of these, Paytm, PB Fintech, which have kind of fallen and come up, basically the e-commerce stocks. Then we have the EMS stocks, the electronic manufacturing. India is new into this, global value chain theme. And some of those Dixons, Canes, all those smaller stocks have done very well as in, 200% gains. None of these tempt you?
No, because I'm very focused on making sure I trade true to my discipline. I have been to this movie before in many, many other countries. In fact, if you look at China, 5 years ago, this was the same argument being made there, and 10 years ago. And we've all seen how dramatically China has slowed down. So it doesn't take a lot, for these fortunes to reverse course. And you want to be very careful as to what you pay for them, because the losses on the other side of the equation can be excruciatingly painful. And if investors don't know what the intrinsic value of a business is, and they're investing in companies simply because it's going up, they will not know what decision to make when these companies start going down.
Okay.
I think you need to be anchored in what you're paying versus what you're getting. And I find a lot of investors are investing based on flows rather than fundamentals. I rarely see people talk about, what the compelling opportunity is versus what the growth opportunity is. Growth stocks have a very potentially uncertain future when you go further out. And a lot of the growth rates, that you have to assume are very far out in the future. And the further out they are, the higher the risk premium you should charge rather than a lower one. And so I think this argument for growth stocks is sort of upside down. Investors are investing them because of the growth. And I would argue as a value investor, a bird in hand is worth more than two in the bush. And so you should not overpay for something too far out, because a lot of things can change in the future. And if you put your down payment in a very large way upfront, then you are the one who's going to lose. And the other side, who's already taken their payment upfront, does not have much to risk.
Okay. Rupal Bhansali, it was a pleasure speaking with you, and it's always good to know that there are very cautious and careful fund managers out there. I'm sure many of your investors will, in the end, actually thank you for taking such good care of their money. Thank you very much for joining us, and have a brilliant 2025 yourself.
Okay,
and
moving on.
Happy New Year to you too.
Happy New Year. Happy New Year, and wish you a wonderful 2025. But now let's tell our viewers all the corporate interactions that we've lined up on the show today. So first up, at 8:30, we've got Amnish Agarwal of Prabhudas Leeladhar joining in for some fundamental stock analysis. At 9 a.m., we have Manik Taneja of Axis Capital, and he will talk about the key trends in IT sector. 9:20, Mihir Vora of Trust Mutual Fund will be a market master. 9:30, the management of Shriram Finance will be with us to discuss dispersals, loan growth and outlook for next year. And following that, Vinity Saraf Mutreja of Vinty Organics will be chatting with us at 9:40. A little later at 9:50, Satish Wagh of Supria Life Sciences will join in to talk about the second half of the year. And towards the end of the show, it's always our special segment, It's the Economy. We'll connect with Mahesh Vyas of Center for Monitoring the Indian Economy, CMIE, and Dharmakirti Joshi of CRISIL to discuss if the capex cycle has taken off.
Okay, so that's what we've lined up for you. It's time for a quick break, but we have lots of stock-specific action to take you through today. We will do it in just a bit in our special segment, Top 10. We are going to look at Hindalco, Lupin, ITC, Mazgon Dock, RVNL, Shriram Properties, ONGC and Oil India. These are the stocks that are on our radar for positive news flow. And bank stocks and easy trip planners are on our radar for likely negative news in these stocks.
Twenty 2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at 108,000, surging 130%. The crypto market capital also hit an all-time high of $3.9 trillion. Well, the year 2024 started on a higher note with launch of Bitcoin ETFs, which gave easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion worth inflows. Ethereum also did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Institutional investors now own nearly 20% of all Bitcoin ETFs traded in the US. And then it was also about Bitcoin halving, an event that happens every 4 years. It leads to reduction in block rewards by 50%, lowering the supply of Bitcoins. It was also then that the rally took wings with the US President-elect Donald Trump pro-crypto stance. he has pledged to make US the crypto capital of the world. He also suggested US Bitcoin reserve, and there also was a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who is a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have cheered, expecting favorable regulations going forward. The Russian President Vladimir Putin recently said that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. After El Salvador, countries like Tonga, Paraguay, Panama are also considering adopting Bitcoin as a legal tender. The cryptos also are taking support from wider adoption of retail.
Welcome back. The Gift Nifty is suggesting a negative start. So after losing nearly 160 points, 170 points yesterday, the implied open suggests another 150-point down tick. But let's get to the stocks. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And first up, it's Abhishek joining in on banks. Abhishek.
Well, RBI has given out their FSR, that is a feasibility study report that they have seen. They have mentioned that banks have strong profitability, declining NPAs and sufficient capital adequacy ratio and liquidity buffers as well. So the return on asset and return on equity are at decadal high, with gross NPA being at decadal low or a 12-year low. So NBFCs remain healthy with sizable capital buffers, a robust interest margin, that is net interest margin, as well as earnings and improving asset quality. Both are augmenting well for them. Provision coverage ratio stands at 77% as of September 2024. The key worry that they have cited in their FSR is that nearly half the borrowers availing credit and personal loans have also another retail loan which is of the higher ticket size, like housing loans or vehicle loans to say. So this is an area of concern, and also another area of concern is the high write-off seen in the private sector banks. So this could be partially masking the underwriting standards that private banks have. Just to highlight our viewers, much of the write-offs that have happened over the last 2 quarters for private banks is in unsecured portfolio like microfinance, credit card and personal loan, where the recovery rate is really low and you cannot have recovery over there. Back to you.
Point taken, Abhishek. Extremely well summarized that those are specifically the fears of the Reserve Bank, the high write-offs and the higher rate of NPAs in unsecured loans. Overall, GNPA is not much, but in that there is an overwhelming share of unsecured loans going bad, and that's the Reserve Bank's only worry. But I want to once again stress that this is a stress test report, so all the numbers should not be taken as negative news. These are scenarios. If these negative things happened, then things could go bad. But I take Abhishek's point entirely on the write-offs and the unsecured loans. Well, let's go to Vivek. You have news on Hindalco, Vivek.
That's right. Good morning. Hindalco is in focus. The company has received allotment from the government. This is for the Meenakshi coal mine in Odisha. Meenakshi coal mine, remember, is a fully explored block with a peak rated capacity of close to 12 million tons per annum, and it has a geological reserves of up to 285 metric tons. Now, what is it that the company is saying, which is positive news? They say that the allocation of coal mine rights actually aligns with the company's strategy to reduce operating costs and also boost energy self-sufficiency. This will also help reduce the dependence that the company currently has on auction as well as linkage coal, which is almost 40% higher than Meenakshi coal mine. So overall, a positive development with the allotment of the Meenakshi coal mine as far as Hindalco is concerned.
Thank you very much for that. There's an important news and update coming through on Lupin. Vinny joins in for more on that, and even on ITC. Vinny.
Good morning. So yes, Lupin, couple of news flows that we're seeing coming in. One, yesterday there was an announcement that came in that Lupin has acquired an anti-diabetic medicine, Hamacillin, which is from Eli Lilly. It is for the India business. Now this becomes a good addition to the diabetes portfolio. It's for the treatment of type 1 as well as type 2 diabetes to improve blood sugar controls. Now, obviously, do not forget, Lupin's diabetes portfolio has grown 19% in Q2 FY25 on a year-on-year basis versus the industry, which grew at around 9%. So yes, an improvement in terms of the portfolio. Other than that, Lupin, one more news flow has come in because there was a case that was going on between Teva as well as Amneal in the US court, where they had filed a petition now for en banc hearing of this case. Means all the judges will hear this case together. This means that there is going to be a delay in terms of a launch coming in from Amneal in terms of their drug, which was GoPro Air, which was expected to be launched somewhere in Q4 FY25, around that level, around that time. So now this delay turns out to be a positive for Lupin, because that means that the sales that are coming in for them for this drug still continues, and the decline that analysts were expecting from this drug will maybe get delayed. So a positive on that front for Lupin. Other than that, we have ITC that's going to be in focus, and we're expecting green here as well, because ITC Hotels demerger, the X date is going to be 6th of Jan 2025, while books are going to be separated from 1st of Jan, that's tomorrow. So keep an eye out on this, because one shareholder of ITC, 10 shares, if they're holding in ITC, will get 1 share of ITC Hotels. This is going to be expected to take place, the listing of ITC Hotels, within 60 days from now on, from the NCLT order. And Hotels arm will also receive 1,500 crore rupees cash in this demerger to continue their business, as well as there's going to be a division in terms of properties. But 6th Jan is the record date where we will see X of ITC Hotel, that ITC will start trading in terms of shares.
Okay, thank you very much for that, Vinny. You know, ITC is going to be the talking point today, because you look at the way Indian Hotels is done.
Yeah.
So if ITC Hotels is going to bank on that, even if it does even 90% of that or 80% of that, you have a winner on your hands. After all, FMCG has not done well. So ITC, you know, if you took out the prized part and gave it separately, it will probably fly. That would be expectations. And they have drawn up some very big, very aggressive, you know, a hotel a month, or you know, something like that for the till they reach 200 or something. It's like fairly aggressive plans. So I think ITC could be the stock of the day. Let's get to the another big stock of the day for different reasons. Easy My Trip. Vivek is going to tell you all the news in that stock.
Well, that's right. So Ease My Trip is in focus. Now, as per the term sheet that CNBC-TV18 sourced, what we understand is that one of the promoters, Nishant Pitti, remember, he had earlier sold close to 14% stake in September. Now, once again, we understand that he's looking to sell close to 14% stake. This particular stake sale is likely to be done via the block deal. And we also understand that this particular size of the block deal is at close to 780 crore. What is slightly concerning, the floor price 15.6 rupees a share, almost a 9% discount. This comes immediately on the heels of the September stake sale. Also remember, today being the last day of the quarter, this also is the day in which the insiders can actually go ahead and sell their shares. So that's also one thing that we need to keep in mind. So overall, 50 crore shares that will be sold. 15.6 rupees a share is the base price at which the deal is likely to take place. And remember, last time after this particular deal took place, the stock saw quite a bit of a sharp negative reaction, a bit of a bounce the next day, and again hit 2 lower circles. It will be interesting to see how Ease My Trip behaves if this particular block deal goes through.
Thank you very much for that. That'll be the other stock of the day. And Upasana joins in for some more news. Upasana.
Good morning. First up, let me start with Masgao Dock. Now, Ministry of Defence has signed a contract valued at 1,990 crores with the company, which is basically for the construction of air-independent propulsion system, that is AIP system, which is mainly technology that allows submarines to stay underwater for longer. Now, this AIP system was built by DRDO, and the units will be built by Masgao Dock. Now, next up is RVNL. Even this stock will remain in focus on the back of the order win. The company bags 137 crore order from Central Railway for Bhusawal Khandwa project. Hence, even this stock will be in focus. And lastly, Shriram Properties is also on our radar, as the company announced strategic sale of 3.9 crore land parcel in Chennai to a prominent healthcare and educational group in South India. Also, the company signed an agreement for divestment of securities held in its arm, that is SPL Shelters, for 93 crores. Hence, all these stocks will remain on our radar today.
Okay, that's good to hear. Thank you very much, Upasana, for giving us a brief on so many stocks. But there are 2 more stocks that should be on your radar, is what Manisha Gupta thinks. Manisha, tell us, why should we be watching ONGC and OIL India?
Oh, well, yes, because the crude oil prices have continued to gain in the last couple of days, with thin trades and last few hours as we finish 2024. But even with that, the price moves clearly have been exaggerated. We are headed for a very small annual decline when it comes to the crude oil prices. 0.5% down for WTI and 2.5% down for Brent is how this year seems to be closing as of now. But with the overnight gains, we've gained up a bit of a ground. We're trading at a 5-week highs right now. The crude prices have gained up by 5% in the last 1 month as well. The support comes in from 3 factors. One, there is decline in the U.S. inventories. Second, there is colder weather in U.S. and Europe, and there is forecast of colder weather as well. So that means the natural gas, the crude oil product, will see higher demand. Third, the market is looking at hopes of economic stimulus coming in from China. So these are the 3 factors that seem to be supporting crude oil prices right now. So we are back above 71 for WTI, and 74 is holding for Brent as well.
Thank you very much for that. A quick recap then of the top stocks. Stocks with positive news flow are Hindalco, Lupin, ITC, Mazgaon Docks, RVNL, Shriram Properties, ONGC, Oil India. Stocks with negative news flow are banks and easy trip planners. We will slip into a break. On the other side, we'll invite Amnish Agarwal, Head of Research at Prabhudas Leeladhar, for some fundamental stock analysis. Stay tuned.
The stable coins are also emerging as payment tools for enterprise businesses. The year 2024 also had its share, though, of frauds, hacks and rug pulls. The sector lost nearly $2.3 billion this year in frauds, though lower than the last year. The names that went through issues this year was Wazirex, Radiant Capital, DMM Bitcoin, among others. While the Bitcoin grabbed the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano all reached all-time highs, while the lesser-known altcoins like Pharma and Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor, with market cap now at $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and blockchain as a technology, and the markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein now expecting $200,000 per Bitcoin. MicroStrategy, in the meanwhile, expects Bitcoin to rise 29% per annum over the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always space to be cautious.
2024 began with a bitter pill for contract development and manufacturing organizations, or CDMO players. A muted biotech funding environment dampened the pace of early-stage projects, leaving these biotech firms feeling the heat in 2024. But here's the good news. Positive triggers are emerging on the horizon, and there are clear green shoots that are visible and indicating a turnaround for the sector. The first one is an uptick in biotech funding, signaling a recovery.
Welcome back to Bazaar Morning Call. It's that time of the day when we have our first guest to understand the micros. And today there are lots of stocks to discuss. Joining us now is Amnish Agarwal. Amnish, good morning and thank you very much. But before I shoot my first question to you, can we just get the key details of the Reserve Bank's Financial Stability Report, because that is going to be our first question. They released what is called the FSR last evening, and that is giving us some warning about unsecured loans. So let me just listen in to my colleague Ritu Singh, who filed the story.
I'll start with some of the key risk areas that RBI has flagged off in the Financial Stability Report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
That was Ritu Singh who filed the story yesterday. Amnish, the latter part of what Ritu is saying is only if there is stress, if something happens globally. But in the earlier part, as Ritu delineated, RBI seems to be worrying about a higher leverage, more people having 4 loans per head and size also ballooning by 43%. Any worries? How would you approach the banking and NBFC sector?
Yeah, hi Lata. You see, these are some of the things which have been highlighted. They are not, I would say, entirely new. Well, if you look at, say, last couple of years in particular, there have been news from time to time that the unsecured lending in particular can come under pressure. And that is exactly what this report is highlighting. Now, the second part is on the microfinance loan. If you look at all the MFI and the related, whether it is an IndusInd Bank or some of the standalone MFIs. So I think they are actually witnessing sharp increase in the NPAs in the last, say, few months. So I think a lot of it is already there. But having said that, the kind of, pressure which is currently being witnessed with many of the consumers more at the lower to lower middle and having multiple loans and all, I think that is something which is a reality. And I think it is going to play out over the next, say, couple of quarters. Now, having said that, my sense is that maybe you can say this quarter and at maximum couple of quarters more, the inflow of the worst news that would be over. So in terms of stock price, if you look at all the segments, most of these stocks in these segments, whether these are, the banks related to that or some of these MFIs, I think they have either bottomed out or they may be close to bottoming out in the next, say, 3 or 4 months. So I would say in certain segments, the growth rates have come off. Say, for example, whether it is, NBFCs, which are focused on commercial vehicles. So the growth rates might remain nimble for some time, but a lot of these negative news might have already been factored into the stock price of stock companies.
Amnish, hi. ITC Hotels, that's going to be the talking point. The development overnight is that the record date has now been announced, which is 6th of Jan. Now, just for our viewers to put on board the numbers of ITC versus CN Indian Hotels. Now, ITC's revenues in FY24 were about 3,100 crore rupees, while Indian Hotels was 6,700 crore rupees, so less than half its size. And margins for the two are comparable at close to about 32-34% roughly. So margins are comparable. But ITC Hotels, Amnish, has set a fairly ambitious target. They have 140 hotels currently, and I think they have indicated that by 2030, they would like to have 200 hotels. From 140, they want to make it 200 hotels by 2030. Have you done the analysis of ITC Hotels? What would be the appropriate value? And between Indian hotels and now potentially ITC Hotels, which one should retail shareholders look at?
Okay, hi. You see, when it comes to ITC Hotels, it's the second largest chain in the country. Now, we have been valuing this company as a part of ITC Limited, where we have assigned a value of, say, roughly around 27, 28 rupees per share. Or you can presume anywhere between 25 to 30 rupees per share is the value which comes for the ITC shareholders. Now, if you then translate into the standalone, you can say entity, which would be having close to, say, I think some 125, 126 crore shares. So that should translate to something like, you can say 200 to 220 to 230 rupees per share. But I think once this company is listed separately, then I think that the dynamics would be different. And I think it could command a reasonably good valuations because the size is there, the profitability is there, and they will also be giving it enough cash to grow for the next few years. And the hotel industry currently is doing well. Your ARRs are moving up, the occupancies are good. So, and I think that given the state in which the hotel industry is currently, I think the listing of the ITC should be good and it should really unlock value for shareholders.
The company said that they'll be transferring 1,500 crore of cash from ITC to ITC Hotels to begin with.
Yeah, so, you know, Amnish, since you have now a formidable competitor for Indian hotels, would you, chip off something from Indian hotels, reduce your positions or at least reduce your price targets?
I don't think it's going to play out like that because the ITC Hotels was always a very formidable competitor when it comes to business. But when it comes to, you can say, now the only difference is that it will be a separately listed company. Now, when it's a listed company, actually it gives a more option to the investors. Because if you look at all the hotel companies which are listed, for example, your EIH is there, ITC is there, and then the host of, you can say, mid-cap names are there. So to that extent, I think the second largest company getting listed separately is positive. Now, I don't think that necessarily there would be, you can say, something which would, yes, there will be, I would say, renewed interest as far as the ITC stock of the hotel is concerned. However, having said that, I don't rule out that few months down the line or when, I think at the earliest possible opportunity, your BAT will come and try to sell their holding in ITC because ITC Hotels is being demerged as a, you can say, mirror image of ITC Limited. Okay, and BAT would be having roughly around, say, if you look at, say, 60%, 25% of that, around, say, roughly around 15% of holding will be with BAT. And I think BAT would be looking at exiting this company sooner or later. So I think that will actually also provide a very good base for the institutions to take or increase the shareholding in ITC. But nonetheless, I think it is going to be quite interesting. And the way the hotel industry is, I think, doing at present, ITC Hotels will provide another opportunity for the investors to participate in the growth in this industry.
You know, the kind of wealth Indian Hotels has created, 100% in 2024 and 400% in the last 3 years. So the hospitality sector in India has really taken off post-COVID. Amnish, stay on. Need to get into a break. On the other side, we'll talk technicals. We'll also invite Sudarshan Sakhani and Shrikant Chauhan on our show. Players. Demand for CDMO services in late stage as well as commercial molecules is also on the rise. Moving on to the third one, we have broad-based commercial contracts in biologics and small molecules that is picking up pace, as well as biologic CDMO demand that has remained robust, and we are expecting the good growth to continue going forward. Nutraceutical manufacturing demand that is also recovering quite steadily, and now we will shift focus and talk about what the highlight and commentary is coming in from the CDMO players. That's a key one, because what they're signaling is that maybe in the near term, there could be some mixed near-term challenges that we're watching out for, but a promising outlook that is coming in for the medium term.
Piramal Pharma is expecting to see early teens growth as the CDMO segment is outpacing the company's average growth. Divi's Lab, they remain quite confident in terms of a double-digit growth in terms of revenue. We have Syngene, Laurus as well as Newland Labs. Now their commentary is quite similar because what Syngene is saying that they're expecting high single-digit growth in FY25, but FY26 expected to be stronger. Similarly for Laurus Labs, expecting a soft growth in FY25, but a good growth from FY26 and onwards. And Newland Labs also flat growth in FY25, but targeting a 20% CAGR growth in the medium term. Now let's look ahead. The industry is poised for an acceleration in terms of top-line growth. Currently somewhere at 9%. By FY27, 16% growth is what one is watching out for. However, valuations, that's the key concern coming in here. Because valuations currently are ranging somewhere between 47 times to 60 times for these players. Following the surge that we've seen coming in on a YTD basis in terms of a stock performance, that was somewhere between 40% to 80%.
Welcome back. Amnish is still with us, but we have to look at our technical moves as well today. And of course, today being the last day of the year, of the quarter, whether there would be also some, moving around to manage NAVs. Sudarshan Sukhani and Shrikant Chauhan, our technical experts, are joining us for some trading strategies. Good morning, Sudarshan. What do you think today? Yesterday, we were taken for a cool ride with the markets going up and down. But is there a long trade today?
Good morning, Lata. No, unfortunately not. The chances are that we'll break down from the support levels of 23,600 today, right at the open. Now the markets can do anything after that. We can go down and then finally have a relief rally or do whatever else. But on the charts, on the technicals, once a significant support is broken, as it will be today, most likely, then the long trade is gone. Now we'll have to wait patiently for new signals, essentially the markets to stop falling, move sideways, build a new base. The entire process that was done a few days ago, has to be repeated. So today there is no trade in the Nifty. It's much better to focus on stocks. If you have long positions, you need to exit on small rallies.
Okay. Oh, that's useful advice. Shrikant, how would you trade the indexes?
Good morning, Lata. Good morning, everyone. I think the markets are clearly forming lower top, lower bottom series. It is sustaining comfortably below the 200-day simple moving average, which is a cause of concern. And after opening to the levels of 23,500, where there is good amount of put writing, we could see some maybe relief rally in the market. But broadly, we are of the view that the markets are again heading towards the levels of 23,250, which was its previous lowest level. So I'm of the view that in these markets, we need to be very, very stock specific instead of taking any specific weight on the indices.
Okay, so everyone's playing caution today. Thanks much, Shrikant. Now let's get to specific stock strategies. Sudarshan, trading short or trading long?
The trades are still on the long side for stocks because there are stocks, there's a large universe of stocks, and some stocks are doing better than the market. So the focus should be on those stocks. Going short is not easy because we are in a very long-term bull market. Short selling causes problems. So I have on the long side Balkrishna Industries. Now my initial stop is 28.25, but given the chances of a gap down, traders will have to adjust these stops. So Balkrishna Industries is a buy. My only intraday short is Navin Fluorine with a stop above 32.50. Again, there are two pharma stocks, Cipla and Laurus Labs. Both are buying opportunities, and the dip could actually give us better opportunity. So Cipla with a stop under 14.95 and Laurus Labs buying with a stop under 5.80. Adjust the stops according to the market's open.
Got that. Shrikant, what are your individual stock picks?
I think in this type of markets, we need to be a short on those stocks which are expensive in terms of valuations, as well as they are falling from their immediate highs. So in that specifically, we are technically bearish on Trend, which is currently around 7,000 levels. It has left almost all its important short-term averages, and it closed below those levels. So from here, the stock can fall to the next levels of maybe 6,700 or 6,650 in the near term. So it's a short at current levels. print at 6950, 7,000 levels with a stop loss close to 7,100. And the other stock on which we are specifically bullish, or maybe on the sector on which we are bullish, is from the pharma space. Aurobindo Pharma looks good. Currently, it is around 1,300 levels. And if we see the overall performance of pharma stocks, then they are relatively doing much better as compared to other stocks. So Aurobindo Pharma looks good at current levels with a target close to 1,400, 1,430. And we can keep stop loss somewhere close to 1,270 for the same.
Okay. Well, we have more questions for both of you, but we have to get into a mandatory break. Shrikant and Sudarshan, do stay on. We'll come back to you at 9:10. Quick break, and we're going to come back. We will have the pre-opening rates.
We are seeing, which is outpacing the Nifty Pharma's 34% rise that we saw this year, approximately on that front. Now, finally, here's what investors and analysts need to keep an eye out on. One is the progress in terms of the Biosecure Act, when it's going to be picked up in the US Senate. Moving on to the next one, we have seen sustained recovery in biotech funding. Will that continue in 2025? That's going to be a key factor. Uptick in RFQ surely is there, but are they translating into confirmed orders? Keep an eye on that, as well as company-specific new launches. What is the trajectory that they have for price erosion in generic APIs is something that is very important for CDMO players. The CDMO sector is navigating a complex landscape of challenges and opportunities that they're seeing. While there are signs of recovery that is quite evident, sustained momentum will be a hinge on factors like funding, legislative support, as well as execution capabilities of these key players. However, could these stretched valuations limit the sector's ability to deliver significant gains in 2025? Let's watch out for that.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high.
Welcome back. You're watching Open Exchange, Bazaar Open Exchange, live from the CNBC-TV18 Motilal Oswal studio. It's time now to invite Soni Patnaik from JM Financial Services for a few F&O trading strategies. Hi, Soni. Good morning. So, what do you have for us?
Hey, good morning, Reema and Lata. Thank you for having me on your show. So I think if we look at the indices, maybe Nifty can break down, but if we look at for Bank Nifty, it is quite at a crucial level. Bank Nifty is just holding above its 200 exponential moving average. And in any latest sell-off scenario, we've seen it defending those levels. So maybe small risk traders can look forward to buying those declines on Bank Nifty if it opens around a 50,600, 50,500 level, which is exactly where the 200 exponential moving average is placed. If it bounces back from those levels, it can again retest the 51,000, 51,200. The strategy for index would be to buy on declines, but to hedge the positions with the buying of a 50,000 put option. So this is strictly for Bank Nifty. I think for Nifty, we'll have to wait and watch and get into stock-specific action. For stock-specific, I've got 3 ideas. One would be a buy in Indian Hotels, which has seen very aggressive long built-up position yesterday. So one can buy Indian Hotels on declines up to 880. Keeping a stop loss of 850 and a target of 920 to 940 can be seen. The second buy idea is for Polycab, which has seen very strong short covering yesterday, and it has been holding strongly above 7,200 mark. So one can buy Polycab on small declines up to 7,200, keeping a stop loss of 7,140, and a target of 7,400, 7,450 can be seen. And the third trading idea is a sell trade for ABB. Now, ABB has been seeing continuous downside and has broken major support levels. So one can sell ABB futures with a stop loss of 6,850 and a target of 6,600 to 6,540.
Okay. That's a lot of stocks to munch over. Thank you very much indeed, Soni, for joining us, and have a great 2025. We don't speak to you. Amnish Agarwal is still with us. Amnish, there are two stocks in the news which we desperately want to ask you. One is Adani Enterprises moving out of Adani Wilmar. Does that make any of them attractive to you? And the other one is Easy My Trip, if you are looking at that stock.
Okay, see, Ease My Trip, I don't have, you can say, much hang on. As far as your Adani Wilmar and Adani Enterprise is concerned, I think in a way it is positive for both the companies. If you look at, say, Adani Enterprise, then actually they will get an inflow of close to $2 billion, which I think could be very handy for them because they are incubating a lot of new businesses. They are entering into a lot of segments. And I think a lot of, you can say, lot of requirements of funding the capex will be taken care of by that, at least in the near term. So that is definitely a positive. Now, when it comes to Adani Wilmar, you see, the main thing is that Adani Group is going more on the, I would say, if you look at their forays, it's more on, you can say, they are into ports, they are into power, and they are into reality and various other infrastructure segments. So Adani Wilmar was the only, you can say, JV which was on the consumer side, and that too in the more commoditized segments where the margin trajectory as such is low. Now with Wilmar, which is actually, you can say, Asia-based MNC taking it over, I think the focus will be slightly more in any which ways, as per our understanding, most of the operations they were being undertaken by Wilmar only. So that I think that focus will also come on that. I think over a period of time, I think it's a win-win situation for both the companies actually.
Just in the near term, Wilmar will face a supply overhang. As one of the promoters looks to sell that 13% stake to bring it down to 75%. So there will be that supply overhang. But Amnish, thank you very much for joining us today and wish you a very, very happy new year. Look forward to chatting with you more often in 2025. But now let's talk about the IT sector. Now, yesterday it was in the news because the President-elect Donald Trump has backed the use of H-1B visa, saying he fully backs the program for foreign tech workers. He says it's a great program. And he, remember, was once opposed to H-1B visas in his earlier regime. To discuss the impact on Indian IT companies and the generative AI play, will the hype turn into actual revenues in 2025? We have Manik Taneja, Executive Director, IT Services and Internet at Axis Capital, joining us on the show. Manik, thank you very much for joining us today on the 31st. So tell us first, this H-1B news that we had yesterday, is it noise for you right now? Would you wait for the final guidelines or would you read something into it?
Thank you for having me on the show. I would say Indian IT companies have weathered some of these visa-related challenges in the past and are in a better situation compared to probably even say when Trump was elected for the first time in late calendar 16. That being said, certainly there have been some news flow about potential changes to the salary levels for H-1B visa holders. These things do tend to get passed on to the customers in general. And I would say this will be no different this time around. And thereby, at a net level, I don't see this as a big intent for the sector.
Okay. Manik, good morning. Thank you very much for joining us. More generally, what are you picking up on IT stocks? We saw Accenture push up its earnings expectation or range guidance. What's the sense? Are people recruiting more? Are your sources in IT companies talking about better orders, better execution? Will Q3 be better than Q2?
So at the outset, I would say typically third quarter does have lower number of billing days, typical December quarter phenomena. And thereby the third quarter performance may be sequentially weaker than second quarter in most cases, which is the usual trend. That being said, the sector essentially through calendar year 23 and calendar year 24 went through significant growth moderation, which was a function of multiple factors. Some of those headwinds are certainly receding, and given the optimism in the US going into calendar year 25 with the hopes that the new regime is also pro-business, certainly that optimism should feed into better demand backdrop. That being said, and thereby the rate of change for the sector essentially will be positive from a growth standpoint. As investors/analysts, the challenge that we face essentially is the fact that valuations for Indian IT are significantly higher than what they have been the last 3 to 5 years. In fact, most companies trade at premium to Indian IT companies. So our viewpoint has been to play the sector selectively when it comes to India listed names. At a more broader level, I would say global tech services companies offer better risk reward, a combination of lower than historical valuation multiples, lower valuations compared to Indian techs, and significant price underperformance over a 1 year basis compared to Indian IT. And they should also be significantly benefiting from a pickup in demand.
Okay, so your preference is for global tech companies versus the Indian tech companies, and I think your recommendations will also come up, or your picks will also come up on the screen. Wanted to get your thoughts in on generative AI. Now, you've come out with a very exhaustive report, and you've titled it Millennium Shape Shifter to Transform Services. So in a nutshell, tell us what generative AI is likely to do in the near term.
So certainly that's the most I would say, most widely used term across management commentaries in the industry over the course of last 24 months now, since the time this came up. And the pace of development essentially is very sharp. From an Indian IT standpoint, the bigger question is that given the productivity benefits that one can have in the software development lifecycle, can these benefits be retained by Indian IT companies? Just to essentially highlight, Indian IT companies' commercial model have typically been effort-based, or basically billing for effort, and thereby the question is that whether with the benefit that these companies gain from lower effort, can these gains be saved? At least going by the history of the sector, and we've seen through the cycle with the way currency depreciated, or some of the savings that happened post-COVID. Over the course of several years, these gains got passed back to the customer. The positive viewpoint essentially is that these companies can pivot from a services to a software model, but I think given the lack of proof, one would need to see as to how this evolves. For now, our belief is that most of the gains from GenAI will get passed on to the customers in the form of pricing or efficiency gains.
Okay. Manik, we'll have to leave it at that. Have a market to trade. Thank you very much indeed for giving us your thoughts on the IT sector, and have a good 2025.
Thank you.
It's 9:10. Thank you. It's 9:10. So Sudarshan, straight away, what is your 9:10 call? And more importantly, a question I missed asking you. You know, the IT and the Adani stocks are the best performers for the week. Is there any long trade there?
Yeah, good morning. See, Cipla is my 9-10 trade. Consider buying Cipla with a stop under 1495. I would avoid Adani stocks altogether. They're far more volatile to be bought and thought of in this environment. IT stocks are certainly buying on dip opportunities even now.
Okay. Thanks for that, Sudarshan. And of course, have a great trading day. We'll wish you a happy new year tomorrow. You will be with us. Let's get to Srikanth now. Srikanth, your 9-10 trade? Okay, Srikanth isn't with us. So I think we have Hormuz.
We do. We have Hormuz for some stocks you should have on your radar as we get ready for opening. Hormuz?
Beverages is one you should be having on your radar because Antique has come out with a note, a buy recommendation, a 710 rupee price target. It refers to the recent acquisitions that Varun Beverages has made in the African market, and it says that because of these acquisitions, the share of its international volumes post that will increase to 36.5% from 2026 from 19.5% that was in 2023. It also talks about the fundraise where it says that the QIP that they have raised through 7,500 crores to the QIP, majority of that will be used to service debt, and post which Varun Beverages will become a net cash company post the servicing of that debt. Now they are also expecting the overall volumes, revenue and EBITDA to grow at a 21, 24 and 28% CAGR over calendar year 2023 to 2026, and as a result they have revised their 2024 calendar year EPS estimates lower by 3% and increased the same for the next 2 years by 10% and 3% respectively. Now interestingly, Varun Beverages is up 30% this year, and it has maintained its post-listing record of giving positive annual returns every single year since it listed back in November of 2016. Now JSPL is the other one you should be watching out for. Nuvama met the management and it says that it is in the process of resolving its pellet bottlenecks, and once that is resolved, it will increase its volumes by around 8.3 million tons in FY26 itself. Around about 3.5 million tons capacity is set to come on stream by the end of this financial year. And for the coal blocks, they are in the last leg of government approval, and mining should begin from the first quarter of FY26. But they are reducing their FY25 and 26 estimates by 6% and 4% to factor in the lower volumes. But regardless of that, they still have a buy rating on JSPL with a price target of 1292.
Okay. Thank you very much for that. But that's not the only stocks that we want you to keep an eye on. Abhishek is telling us to put microfinance stocks on our radar. Abhishek, tell us why.
Well, Lata, UBS has written on microfinance wherein they say that overdues are up 110 basis points month on month in the month of November. So they believe that elevated forward flow from early delinquencies buckets will result in higher slippages in H2 FY25 versus H1 FY25. So portfolio at risk, that is par of between 1 to 30 days, is down about 20 basis points month on month. However, portfolio at risk between 1 to 90 days is stable on a month on month, except in few states like Bihar, West Bengal, etc. So portfolio at risk 90 plus days month on month has increased on a sequential basis, that is month on month across states. They expect the growth to remain muted in FY25 due to stress with respect to the asset quality and disbursals norms getting impacted from microfinance industry. So they believe that while this is net positive in the medium term, this would reduce liquidity for weaker borrowers, which could impact the near-term stress in this sector. So they remain neutral on Bandhan Bank, IndusInd Bank and AU Small Finance Bank. All of them have exposure to microfinance industry, while they prefer HDFC Bank, ICICI Bank, Federal Bank and have a sell on SBI as well as SBI cards. Back to you.
Thank you very much for that. Just waiting for markets to open. In pre-opening, it's suggesting that we're going to have another down day, 85 points lower. Some of the stocks you should have on your radar is ITC, because their demerger of the hotels business has taken a step further. The hotels business should be listed latest by 16th of February, because that's 2 months from the time the NCLT approval came through. That was 16th of December. So ITC should be on your radar. Adani Enterprises was a big mover yesterday. So we'll find out whether there's profit booking visible in that or there is a continuation. And the bell has gone, and the first stake on the Nifty is at 23,550. We're staring at a downtick of nearly 100 points at open. The Sensex 2 is lower by 0.5%. Midcap index giving it company on the way down, 0.5% gone. The Nifty Bank is under pressure. So this is a decisively lower start. But again, volumes are on the thinner side, and we've just had a minute of trade. On the way down, you've got IT stocks. So in fact, the top 5 Nifty losers are IT names. So Tech Mahindra, HCL Tech, Infy, TCS, Wipro down more than 1%, extending up to a 2% loss. But remember, the Nifty IT index has had a good year after more than a 20% rally last year. Even this year, it's ending with about a 22% gain. So some profits are being booked on the last day. Adani Enterprises comes in for some profit booking. IndusInd Bank was the lone private sector bank which managed to close up in the green yesterday. So that's seen some profit booking, while ICICI Bank is a bit subdued. We'll pull up HDFC Bank and find out whether it's higher in trade. No, 0.5% gone on HDFC Bank too. So that's not, that's also stumbling on the last day of trade. On the way up, it's PSUs, BEL, Coal India, ONGC all up. Tata Motors is having a good start. Some of the other winners include metal names like Tata Steel, Hindalco. ITC, as we pointed out, is also up and about in trade. And Hindalco, where there is news, has also got a green start.
Well, actually, the markets have not, taken advantage of what would be thin trade and done any NAV management as I was expecting. It's been down, as even Sudarshan warned us, that 23,600 could be taken today, and that will disturb the long-term, or rather the near-term bull trend in the market. So it's something he worried about, moving below the 23,600 mark. But at this point in time, it's not a big cut if you look at it in percentage terms. It's 1/3 of a percent lower. And there is still, of course, like yesterday, every chance that the market pulls itself by its bootstraps, if not anything, at least for NAV management. Just want to point out a few mid-cap stocks that have positive news going for it. Mazagon Dock is up about 2.5%. It's got some orders, as is RVNL. So both those stocks are up about 2 to 2.5%. ITI, I mean, there are no rules for this stock. It's a huge zigzag move. Pull up a 6-month for that stock and you will know what I mean. It was rising 15-16%. Today it is still up about 6%. So ITI is once again having a field day. Among stocks that are not doing well, Adani Wilmar is feeling the pressure of that big block deal in which Adani Enterprises moved out. Indian Hotels, my sense is feeling the pinch of competition. There is going to be a slightly stronger competitor in the form of ITC Hotels very soon. Competition on the field they have always seen, but on the stock market there wasn't any one big hotel stock of the level of Indian Hotels, and maybe that's why there's a bit of chipping off on that stock. And then there's Zomato, Geo Financial, Adani Total, Infosys, Ather Energy. I mean, a lot of the Adani stocks were up this week, and I think it's just traders riding up and down. So nothing much to speak about in terms of fundamental moves on those stocks. I think ITC should get a look in. ONGC, as Manisha was telling us, is likely to rise because we saw crude prices go all the way up to $74, and therefore that's having a positive impact. Oil India would likewise be positive. Now there is a little bit more green with Coal India, BEL, Nestle, SBI, JSW Steel, all of them somewhat in the green, but we are talking really narrow ranges at this point in time. The overarching color is red. Now let's see if we can change that.
The Easy Trip, that's the biggest volume trader. Volume traded stock of the morning right now, and it's straight away opened down with a cut of about 8.5%. The volumes are very, very large on Easy Trip. So, watch for that. And two other stocks. One is Mazagon Dock and the other one is RVNL, where there are order wins, and these stocks have opened up in the green. And Shriram Properties, where the company is monetizing some land, has got a green tick to begin trade with.
Okay. Well, those are the stocks to put on your radar right now. But at the moment, the markets having done their first thing in the morning, taken a red turn, still holding at 23,550 thereabouts. With that backdrop, let's invite our market master for the morning. Mihir Vora, the Chief Investment Officer at Trust Mutual Fund, is with us in our studio. Mihir, good morning, and thank you very much for cheering up our 31st by coming to the studio. We aren't the only two people working.
Absolutely. Always a pleasure to be here.
Yeah. Okay, well, for starters, I mean, we've lost enough from the 26,300 plus mark. Does the market look attractive at any level, or do you think you'll wait for dips to buy?
So let's keep today the glass half full day. Okay. The markets are still up 8 to 9%, right, on the Nifty. The small cap index is still up 25%, the mid cap index also. And it's been a wonderful year in terms of stock picking. If you look at the sectoral dispersion, on one hand, in a good market, in a bull market, you have the high beta sector, which is real estate, which did so well, 38% up on the real estate index. But in the same year, you also have the pharma index, which is up 35%. Yes. So a defensive is also up. A high beta sector is also up. So it's been a wonderful year for stock picking. And while the Nifty, which is the large cap index, is up 8 to 9%, you have the broader market, which has done really well. So I think if you just step back a bit and see the returns of the Nifty this year, they're kind of normalizing the returns of the previous year. The previous year we had 17-18% returns on the Nifty. So now this year we had single-digit returns, so kind of averaging out. So we are starting off with a good normalized base, I would say. We're not stretched in terms of overall valuations. Expectations are not that high at the Nifty level. Probably yes, in some small cap, micro caps, there is a bit of a stretch. But in general, we are starting off with a good base. I think a boring year would be good.
You know, I just want to put, you know what, Mihir had tweeted a couple of days back that 2024 is the 9th year of positive yearly returns. And this is the longest run of back-to-back positive years of returns since the inception of Sensex 45 years ago in 1979. That said, the current streak is the longest in number of years, which is basically 9 years, but the lowest in terms of percentage returns. Because in 9 years, we've only gone up 3x, while in the previous long stretches of returns, we've seen gains of 6, 7, 8% as well.
8x, yeah.
So what does it tell you, right? What happens after the markets run up 9 years? Do they correct over the next 3 years, 4 years? I mean, how should you view this data when you have a longer lens?
Sure. So I think it all boils down to valuations. Probably the markets have also evolved a bit. So maybe they are less volatile than before. Lot more institutional participation, lot more retail participation now. So to that extent, the markets have evolved. And frankly, the reason why probably we had this long stretch of positive returns, though may not be the best in terms of absolute returns, is also the fact that globally, after 2008-9, central banks have kind of backstopped the markets at every downturn, you know. So to that extent, maybe it may be artificially propped up because of central bank actions, but that's the way it is.
Okay, you know, let's speak about the mid caps because that's what all of us are chasing, and that's where all the gains are. Do you think there the rally can continue, especially in really attractive businesses, not stock valuations, businesses, e-commerce, EMS?
Absolutely, you know, and I'd kind of make a distinction between mid caps and small caps because, you know, the way it is, we have kind of artificially, you know, defined the top 100 as large cap, the next 150 as mid cap. So technically, mid caps is only 150 stocks. But let's say I'm talking about the broader market, which is all the mid caps and small caps. I think that's where the real action is because as the economy evolves, and we are evolving in terms of, you know, demographics, income levels, you'll see more and more segments like, you know, premium consumption, financialization savings, capex, infra, real estate, all those segments which are frankly not represented in a meaningful way in the top 50 companies. So the real stock picking, you know, chances are there. Government-linked sectors like, you know, PLI-linked schemes, those are the ones which are really doing well. And, you know, you can see it, the EMS theme that you mentioned.
Aren't there, you know, not pockets, but large areas, swathes of overvaluation?
Overvaluation, you know, it's
EMS and e-commerce.
So that's the whole thing, you know, and which is where our, you know, philosophy of terminal value investing comes into play. When a sector or a stock is starting from scratch, and if you see a 10, 20-year, you know, runway of growth for the segment itself, for the sector itself, then the top stocks in the sector will trade at a premium, will trade a meaningful premium, because when you're starting at zero, the base can grow at 25-30% CAGR for 10, 20 years, which we have seen. For example, when the first private sector banks came in, they grew at 25%. They grew at 25-30% CAGR for 15, 20, 30 years.
So which are these sectors? EMS is one, defense is one.
EMS, defense. I think the whole of capex still has 5 to 7 years more to go minimum.
Because capex as well.
Because right now everything in the capex world has been propped up by government spending. We really haven't seen the private sector kick come in. Once that comes in, and who's going to make the factories for EMS or defense and all? It has to be based by capex, right? And, you know, again, stepping back, we say we want to compete with China, right? But China, Japan, Korea, at their peak and maintaining that peak for 10, 20 years, they were investing 40 to 50% of their GDP in fixed assets, in capacity, infra creation. We are currently at 30%, 32%. And China is 5 times bigger than us. So even today, China is investing $7 trillion in infra and physical assets every year compared to our $1 trillion. You know, so we have a long way to catch up. And if China plus one becomes a reality, even to the extent of 10%, we need to double our, you know, industrial base.
So the structural opportunities are capex, manufacturing, etc. But just for, say, 2025, those who like to play for 1 or 2 years, where are the opportunities, you know, according to you?
So structural always remain the core of our portfolio. But tactically, I would say that financials, especially the banks and NBFCs, have underperformed.
In NBFCs, where?
In NBFCs, I would stick to the mortgages, the second-hand vehicles financing, the bigger ones. I would not really go down the curve in NBFCs even now. So the bigger NBFCs across segments look good, not so much on the unsecured loan part because RBI is still keeping a close watch on the unsecured part. But the secured lenders, whether it's on the auto finance, truck finance, mortgages, etc., I would go for gold finance. I would go for on the NBFC side. But private sector banks are really attractive now in terms of valuations. And the reason why the banking sector underperformed is because credit growth came down. Now it's almost down to 10%. I don't think we can go lower than that in terms of credit growth. It can only go up.
And Reserve Bank is now in a
and valuations are attractive. Exactly.
Any others?
And that's almost 35% of the Nifty. So there's a big chunk of the Nifty which is looking at.
Large NBFCs, large private sector banks.
Absolutely. The second pocket I would say is certain chemical stocks which have underperformed for almost 2 years now because of China coming back and all. So that pocket looks good. Even
we have Vinty Organics joining us. So maybe you want to listen.
Yeah. And auto also looks good, again, after having underperformed. I don't think a country like India can have suboptimal auto growth for too long a period. So last few months have been a bit, suboptimal. That has to normalize.
Okay. Well, what's your sense about the underperformance in Reliance? Some of the big, why did Nifty not do as well as the mid caps? It's because many of these big boys did not perform. Other than banks, there are big stocks. Do you think that now they are at good valuations?
See, I'm personally not a big value investing fan. So we don't buy stocks just because they are cheap. And our view is that the global economy will not do as well as the domestic economy. So India, I would rather stick to stocks which are more domestic facing because I think the domestic GDP growth will be structurally higher even for 2025 as well as structurally for the next 10 years will be higher than the rest of the world. So global cyclicals we are not very positive on, especially because of the fact that China, which is the largest consumer and producer of all these commodities and metals and all, is not growing as fast as it used to be. I think China has created all the infrastructure that it needed to, and more probably in terms of real estate also. So global commodities, I don't think we would be structurally bullish on. And that's the reason, why some of these stocks in the energy space, in the metal space are not performing. And that I think will continue to be a theme going forward too.
Okay.
And that's why the question mark on Nifty performance versus the broader market.
Doesn't consumption worry you? I mean, we've heard so much in Q2 about FMCG and then Godrej Wonders and then you saw the Q2 GDP numbers, consumption, and even how much more can even discretionary consumption go? Titan has not had a great year. So I'm just asking the entire consumption thing.
So discretionary, I don't think is a problem yet, in especially high-end consumption.
Hotels.
Hotels, airlines, jewelry actually not doing too badly. The structural dynamics of the industry is changing, but per se the segment is not growing at a suboptimal level. But everything, for example, liquor. Liquor consumption, the spirits companies are doing well.
It's been everyone's buy.
Yeah, so hotels, liquor, airlines, premium cars, premium real estate.
SUVs.
Premium real estate is rocking, right? So premium consumption is not a problem. So basically the discretionary theme. In FMCG, I'd say that things will normalize both in terms of margins as well as in terms of volumes because the governments are spending now. All these state government schemes for the women, etc. They're actually some kind of an indirect UBI, universal basic income coming in. So that should kick the consumption theme also.
What's very quickly and briefly, tell us what's the big global call that you're taking? Because we do get impacted by what happens, on the global front.
Sure. So the base case, and we'll talk about the risks to that base case. Base case is that it will be a normal year.
Okay.
CY 2024, the global GDP growth was around 3%, expecting similar numbers for the next. US economy, which did very well, almost 2.5%, 3% last year, probably will slow down to 1.5 to 2%, which is fine. Corporate earnings are still doing well there. And for India, about 6.5% GDP growth. So that's the base case we are working with. So as I said, a boring normal year will be a good outcome next year.
Okay. And what are the sectors that you would completely avoid, at least as per the visibility that you have right now?
Avoid, I wouldn't say it may be a strong word, but as I said, global cyclical still, not very positive on.
So that's
I still believe in the domestic story.
Okay. What about IT and pharma? And will rupee depreciation be a big tailwind?
So in IT, we are actually underweight the large caps, but overweight on the mid caps. The large caps, basically, even in a bull case, we are talking about a decent single-digit kind of a growth, not really trailblazing kind of growth. But there are niche mid-caps which are doing much better and will structurally do better because of management changes, the niche segments that they work on. So IT mid-caps is a good area for stock picking. In pharma, again, we are quite overweight, significantly overweight, not as a top-down call, but just because of the fact that we have so many bottom-up picks in the sector.
Okay.
So we are almost 500 basis points overweight in pharmaceuticals in our portfolios, and that's purely on a bottom-up basis. We are overweight on all the things like CDMO, even generics, healthcare, including hospitals, diagnostics. So across the chain, we found good bottom-up stocks. So it's not a top-down really call, but a bottom-up call.
Yeah, even for that matter, defense that you spoke about, it would have to be bottom up, isn't it? Because valuations have also run up for several PSU stocks.
Actually, you need to then take a top-down call, because a top-down call would be a call for 5 years or 10 years, irrespective of the fact that the order books get delayed by a quarter or two, etc.
Oh, so you're still very positive on
absolutely, that? Absolutely.
Okay.
Because we barely scratched the surface on exports. And while there is a clear visibility of indigenization of production for the next 5 to 7 years, so that's going to double the industry size in any case if that comes through. But exports is something that can triple or quadruple the industry size because the global defense spending is $2 to $3 trillion.
A question that we get asked often is that can you go out and buy a Zomato and Swiggy? You believe in the opportunity,
Absolutely.
but the stocks have run up.
Absolutely.
So is this a it is a long-term opportunity, but at these levels, would you recommend going out and buying?
So we are quite positive on the new age companies. We have a basket of stocks in the segment. And again, there the call is how big is the runway and whether it's a winner takes all.
But you must have gotten it at lower levels, right?
That's fine, but we're not looking at 100% returns. We are talking about a 5 to 10 year runway for some of these stocks. And the fact is that in these situations, once you have that basic, subscriber base in place, it becomes an entry barrier. So it becomes a duopoly or a 3-player market, which is what we are seeing in a lot of these segments.
Okay, so even at these levels, it's fine if you have a long-term
Absolutely, because once you have the subscriber base, you can go for adjacencies, you can introduce newer services as long as you have the basic data in place for the subscribers.
Finally, the other top-down buy has been power. Almost every aspect of power, from the Tata Powers of the world to all the transformers and,
renewables,
T&D and renewables. Which part of the power space do you like?
So we are not so much on the utility side. But
not the generators.
Not the generation, not the utilities. We are more on the EPC companies and the equipment manufacturing companies, both on the transmission space as well as on the distribution side, especially companies which are doing EPC and equipment for the renewable space.
You spoke about large NBFCs. We have a large NBFC, Shriram Finance, joining in. So what are your thoughts on this company in particular, and what are the questions that you would have for the management? Like, what would be the key themes for a company like Shriram Finance going into next year?
So obviously, I can't comment on individual stocks, but probably one should ask the management about visibility of credit growth for the next year, because I think the funding crunch probably is anyway going to ease over the next few months because of the RBI's stance, and even the government is making some noises about slow down, etc. So you should see funding crunch ease in any case. So then the only thing remains to see is the top line growth. Maybe
Okay. Thanks a lot, Mihir, for a bunch of ideas that you have given us on what we thought was a holiday strained day. Thank you for dropping in our studio, and have a brilliant 2025.
Wish you a very great 2025, and to your subscribers also. And thank you so much.
Thank you very much. Okay, we were talking about, Reema was talking about Shriram Finance, and indeed we have the management with us. Umesh Revankar, Executive Vice Chairman at Shriram Finance, is joining us. Mr. Revankar, good morning and thank you very much. Apologies for the bad telephone line last week, and very nice of you to oblige us a second time. Well, as our previous guest was telling us, Mihir Vora, how do you see loan growth in 2025 and more particularly in FY26? Do you think it can be good, because we are seeing so many warnings on unsecured loans, consumption not doing too well?
Yeah, good morning. I personally believe that 25, 26 should be very good, mainly because, one of the main reasons why I feel there was a little slowdown in the pickup in credit was the infra spend by the government was much lower than expected. And that has a major impact in the consumption pattern and also the migration of labor, because a lot of unskilled and semi-skilled labor get migrated to urban centers for the job when there is infrastructure spent. That was a bit lower in the last 2 quarters, and it is picking up now. And that will have a major positive impact going forward in the next full calendar year. I believe next calendar year, the growth rate would be much better, and credit demand also will grow accordingly.
So do you have a range in mind, sir, for credit and loan growth next year? What are you targeting or hoping to achieve?
See, from Shriram side, we would be happy to grow anywhere between 15 to 20%. That is because we would always be very conservative in both planning and estimation. And but industry can grow. Industry may grow, especially NBFC credit, compared to what it has been in the last 2 quarters.
Okay. Well, we have to discuss the RBI financial stability report. They are worried that, loans, multiple loans are being given to the same person. They're often giving consumer durable loan and maybe a credit card loan to a person who has an auto loan and a home loan probably. Now, you will not be in the personal loan segment, but you may have given them an auto loan, for instance, but that person has multiple loans. How worried are you of unsecured loans?
See, when we look at our customer, when we lend the money, when we look at the credit bureau score checks, we normally see that our customers have no other borrowing. At the most, he may have some gold loan borrowing. Otherwise, he do not have multiple loans, is what we see. Because most of our customers are in the semi-urban and the rural market. They are not... typically, they take the multiple loan, is what we, because this is our data and what we have. And there may be some instances where there is a multiple loan. In fact, many of the lenders today would like to give the multiple loan from the same institution so that they have a better track of his cash flow and his ability to pay. Only when he has a different loan at different places, then we have a difficulty in tracking his income versus ability to pay. We try to put things in such a way that we are sure about he's having enough source of income to repay the loan.
Sir, are you increasingly seeing more competition in the CV lending space? Because, margins are more lucrative. There are reports that banks too are muscling their way slowly and steadily into this segment. So first, tell us, what has been the competitive landscape last year? How has that changed? And your view going into next year?
See, we have been in this industry of this lending activity for a very long time. The competitive intensity was always there. It is not that today the banks or other lending institutes are becoming active. We have seen depending upon the various economic scenario, many people become active sometimes little passive. This is the way the management reacts to different situations. So competitive intensity is always there. I don't see there is a heightened or increased competitive intensity now. It has always been there. And if you are carving out a niche area for yourself, then you are very comfortable in the niche area you are in. So many of the NBFCs, they have their own niche areas and they play around that niche areas. I don't think there is a direct competition, especially in the among the larger NBFCs for a particular space.
Okay. Can you cast your eye over the next 365 days and tell us how will cost of funds pan out for you? Will it be lower than it was in 2024? And therefore, margins, will they be like 50 bips higher, 40 bips higher? Any guidance for the 2025 margins?
I believe the first 6 months, the margins and the cost of borrowing would remain almost same. I don't really see significant change, because even if there is some change in the policy rate, to translate into or get into the NBFCs, when it passes it on to the NBFCs, it may take a while. So I believe it may first 6 months it will remain same. Post that, there is a possibility that the interest rates can come down a little depending upon the policy rates and the liquidity that being available. So I feel over the year, if I say the second half of next calendar year, there will be around advantages of around 25 to 50 basis points. Overall net interest margin for us would remain same. I don't really see big difference because whatever the benefit we get, we'll pass it on to the customer.
Yeah, and actually, Abhishek has given us a nice table of the NIM performance of all the big NBFCs, and all of them have dropped by about 10 basis Q2 over Q1, whereas you all have dropped only 5 basis. So do you think 8.75 is something you'll manage?
No, we'd like to be in that zone, but anywhere between 8.5 to 9 is a good zone for us. We would prefer to be around 8.75, that's the midpoint. And we are just hoping that we'll be able to manage for next couple of quarters.
So 15 to 20% growth, top line growth, and margins between 8.5% to 9% is what you're hoping for next year. Any fundraising plans?
The fundraising for us is a continuous because it's the raw material we need. So we are, so one thing about Shriram is we always been looking at new source so that we are not over dependent on one single source. So the resource raising in various sources or trying to see a new source which is likely to be more liquid at any point of time is the our senior leadership has been trying to find it out all the time. So this is always there. So we are quite comfortable now. We have raised recently a large sum. You have noticed that we have raised 1.27 billion in the recent tranche. So we are very comfortable as far as the fundraise is concerned now. We are not really looking at any immediate fundraise.
Okay, just one more number. Your bad loans GNPA ratio. Again, you all were the only ones who brought it down Q2 over Q1. Everybody else saw some 10 basis points increase. Are you sure with all these Reserve Bank warnings, you remain below? I mean, will it go down from 5.32 to 5.3, 5.2? Is that the direction?
See, we actually targeted to reach 5%, but depending on the economic environment and situation, it can vary. We are quite comfortable at 5.32. We feel like we have done a very good job, and we'll be happy to maintain at this level for some time.
Okay. Oh, certainly it's an outperformance compared to your peers. Mr. Revankar, it's always a pleasure having you with us. Thank you very much for giving us a macro and a micro understanding of Shriram Finance and the NBFC space. And here's wishing you a brilliant 2025.
Yeah, wish you happy New Year.
Thank you. Well, at the moment, not too much happiness in the stock market if you're a bull. Midcaps in particular down 0.7%. Likewise, actually, the Sensex Nifty are also down 0.5%. Advanced declines are seriously in favor of declining stocks, 1.5 declining to 1, or rather 3:2. Time to take break. But as we step into 2025, CNBC-TV18 is asking some key questions. How will the Nifty perform in 2025? What are the sectors, themes to bet on? Will the faltering GDP growth revive in 2025? Will the Reserve Bank start cutting rates in the coming year? We will ask all the experts on behalf of you. Stay tuned in for the most comprehensive market poll tomorrow on CNBC-TV18.
In high inflation scenario, SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. robust small cap investments have been done by retail investors. Now, what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now, with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now, over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY.
Welcome back. You're watching Corporate Radar. Now, Vinty Organics is the next management on our show now. It's been a sort of a challenging year for Vinty Organics. This year, the stock hasn't given any return, absolutely flat in 2024. But going ahead in terms of growth fundamentals, the company has indicated that they are aiming at a revenue growth of 20% CAGR over the next 3 years, fueled by ATBS, antioxidants, and other products. Vinity Saraf Mutreja, Managing Director at Vinty Organics, now joins in. Vinity, if in a very brief manner, if you had to recap 2024 and the kind of challenges and opportunities you faced, how would you do that? And what would you be looking ahead to if you had to focus on the top 3 things on the board's mind for 2025? If you could lay that out for us.
Sure. Good morning and wishing you a happy new year in advance. I think you have pretty much summed it in your opening statement. 2024, though I disagree to some extent, at least from an operations point of view, I wouldn't call it a challenging year for us. We have grown in, if I look at FY25, to almost 15 to 20% compared to FY24. Of course, FY24 was a low year in general for the chemical industry, with a lot of destocking happening and a lot of overpurchase happening in FY23, and that has normalized this year. And going forward, coupled with our existing expansion of our existing products like ATBS, as well as the new products that we are adding in VBL Organics and the antioxidants, I do expect a 20% growth in revenue in FY26 and FY27, so on.
Okay. Vinity, good morning, and thank you very much indeed for joining us in a holiday-thinned week. Your Q2 numbers were very strong. There was a margin expansion from the previous 22.6 to 24.2%. But, your previous bests are 25, 27% as well in FY23, if I remember right. You think FY26 can be that year when your margins can go back to what you gave us a couple of years back?
Yeah, see, actually the margins are a bit slightly lower in Q1 because a lot of the sales got spilled over to Q2. So if you look at the average margin percentage of H1, it should be somewhere around 25-26%. And I expect to maintain the same margin around 26-27%, even maybe in second half, because historically speaking, second half is better than H1. We do see sales, a lot more sales pick up in October, November, and similarly in Jan, Feb. So in FY26, I think given our revenue mix, maintaining a 26% EBITDA margin looks very reasonable.
Okay, I was calculating OPMs, and for me, your first half came at 24. Not at 26, but it was OPMs. I was not calculating EBITDA margins.
Yeah, maybe I'm including the other income and you're excluding the other income. I think that's the difference.
Okay. So when I meant challenging year, I meant from a stock point of view because, the stock over the last 3 years hasn't given any return. So not just 2024, over 3 years, I think there's been a little bit of a downtick in the, the stock price. But take your point forward that 20% is the kind of top line growth that you expect. Can you give us an update on your expansion plans? I think you'd spoken about 550 crore of expansion plans. Is it on stream? Is it, is it going to come on stream at the same time, scheduled time? Is there a delay? And just talk to us about that.
So the expansions are on track. Our new line for ATBS should be ready in the next couple of months, and we expect revenue growth coming from that. Similarly, so that's about 300 crores of capex, which has been done there. Another 500 crores capex over 2 years will happen in our subsidiary VBL Organics, where we have already started some products, monomer inhibitor as well as a pharmaceutical intermediate, and we're adding 3 new products in that, which is again, one is skincare intermediate. The other 2 are, one is used in the agro industry, tertiary amyl alcohol, which we will be making from isoamylene, as well as we will be backward integrating into anisole, which will start in FY26. And from anisole, we will again be horizontally integrating and adding another food ingredient called BHA, which again uses 2 of our existing products, isobutylene. So the expansions, the product mix, everything seems to is on track from our perspective.
This expansion was scheduled for January 2025. Is when you're saying couple of months now. So is there a bit of a delay?
ATBS will be ready by March, April 2025.
Okay.
Yeah.
Okay, just one word. So you had given us, of course, 26-27% EBITDA margins. Guidance on top line was 20%. You stick with it or improve it?
Yeah, no, we stick. Maybe I just to be safe, I say 15 to 20%. So 17-18% we should achieve.
Fair.
Again,
Okay, 15 to 20.
Yeah, price fluctuations matter.
Yeah, price fluctuation. That's exactly what I was coming to. One of the problems besetting the industry, not just you, have been the Chinese pricing. It was obvious in the antioxidants. Now, it could get worse as China faces tariffs in some countries. It's probably going to be dumping more. What's your view of 2025 pricing, and will there be pressure on some of your chemicals?
I think as far as the China problem is concerned, I do believe the government is intervening, and you see that in a lot of other sectors as well as in chemicals. They are imposing anti-dumping duties and all sorts of duties against China, which is a must because in a lot of chemicals, they are selling below cost. And given the subsidies that their own government is providing them, and hence the pricing disparity. And so we do, in antioxidants, we do expect some government help, and so are other chemical companies. Going forward, I do feel India has an advantage given the tariff conditions in China, given our cost of production. I still feel the overheads are lower in our country, and together as a public-private partnership, overall the next 5 to 10 years, I think the chemical industry is set to grow in India.
Okay, sorry. How much percentage, or which are the products that directly face Chinese heat? What percentage?
For us, it is primarily antioxidants, which is today about 10% of our revenues.
Okay.
I do hope next year, as the sales pick up, it should increase to 20%.
Okay. This 20% revenue growth in FY 25, 26, 27 is taking into account the increased capacity across your various plants, or is it before the capex comes on stream and capex will boost it further?
No, it's taking into account the existing pricing conditions. So I'm not accounting any pricing change. So it's purely volume growth. Now the volume growth will come from most of the capex which we've already done in the new line of ATBS, as well as in VBL Organics, in the new products, which some have started and some are about to start in FY26, as well as the antioxidants where we have the capacity and we're just hoping the market situation to normalize.
Okay. Well, we'll have to leave it at that, Vinati. Thank you very much indeed for joining us. You are a superb entrepreneur. Thank you for joining us, and here's wishing that your 2025 brings you more successes.
Thank you very much.
Okay. Well, maybe we want to cast just a quick eye on the markets, because now the mid-caps are going into a 1% downtick. And that's always a bit of a dampener for Indian investors who have been more of mid-cap chasers rather than large-cap investors. It's not as if the large caps are doing much today. They're down 0.5%, but the mid-caps are racing to 1% downtick, and that's moving the BSE advanced declines to 2:1, 2 declining for 1 in the green. So not a very happy state of things as far as we are concerned with stock markets at this point in time. Things can turn, if you remember the yo-yo market yesterday, but nevertheless, it's something to worry about. With that, let's invite the next management. Supria Life Sciences stock surged more than 122% in 2024 so far. To discuss more about demand trends and expansion plans, we are joined by Satish Wagh, Chairman and Whole-Time Director at Supria Life Sciences. Mr. Wagh, thank you very much indeed for joining us. Well, first up on revenues in FY24, your revenues were 570 crore. First half FY25, 363 crore. Can you give us some idea of when you are looking at the perfect 1,000 crore number? What's the revenue growth for this and the next year?
Good morning. See, as we have always promised that we will do definitely 22% growth year on year. So we will definitely do that. We have recently launched one of our a big block, which is almost 575 KLD, and it will increase our capacity. And this, we have invested 120 crores. The production in this area have already started. Qualification are ending, and we'll definitely produce here some of the products which nobody is currently manufacturing in India. We always use the chemistry for manufacturing against China. We will be manufacturing here some of the products which are currently being manufactured for last 25, 30 years by China only. And that will be a big dent as far as Supria Life Sciences is concerned.
Okay, which are these products, Mr. Wagh? And I mean, as we were discussing with our previous guest, there is a big fear that China would be, you know, I don't want to say dumping, but will certainly be coming with aggressive pricing because some of the markets could be closed to them like the United States. So which are the products and what kind of pricing competition do you expect to face from China?
As far as Supria is concerned, if you see out of 100%, 89% is our exports, the remaining is our domestic. We have always been very strong against China. We have a good chemistry and R&D center which develops good technologies. Now I will tell you the first product, which is a very big mega blockbuster, which is atorvastatin, which is being used as far as therapy is concerned for heart. Everybody imports from China ATS-8, which is 600 tons. So we have decided to manufacture this intermediate from the basic, that is ATS-2, ATS-3, 4, 5, 6, 7, 8, and even N-1. The capacity is designed almost 650 tons to take care of India and our exports. We have no worry at all as far as China is concerned. Even they dump, we have good process and the fully automated plant which will be under operation. We are also using somewhere the latest technology like flow chemistry. We will definitely scale up new products. That is the same product is suoflurine, which is the anti-anesthetic. If you really see, there are only 4 manufacturers who are catering the world from China, and all are non-GMP plants. And currently, this material comes to every manufacturing in India, though they are non-GMP, but we'll be producing all these in our US FDA plant.
Okay. Sir, 22% guidance is for the current year, but do you think the company is designed for a 20-25% revenue growth sustainably over the next 3 to 5 years? Do you think investors who take a long-term call can expect a 20% plus kind of a top-line growth?
Ma'am, I can definitely tell you that we will definitely achieve is the 2 products if you see. The first is ATS-8, currently being sold at $75 per kg. You can imagine 650 tons capacity, US FDA plant, not a non-GMP plant. The suoflurine is also the same. It is currently being sold by China at $75-80. Our capacity is 275 tons. So if you just calculate, you will understand that we will definitely achieve our goal.
And the goal, sir,
more
is?
than that, but I assure you that we'll do it.
So the goal is, Mr. Wagh?
I can't give you the figures, but initially when you ask, when you will cross, is this the figure? So that figure will definitely cross.
Okay, what would be your penetration? Okay, just a minute. That's the Unimech Aerospace listing, and what a fabulous listing! 80% higher. The stock is open at 1,416. The issue price was just 785. The company had raised 500 crore rupees. Of that, 250 crore was a fresh issue and an offer for sale of 250 crore rupees. But the promoters said that the offer for sale is to bring down, the promoter holding, for the listing. This is a company which, provides certain precision components in the defense and aerospace segment. So it's a hot space. Many of the companies in this particular segment have done very well. And it's the last listing of 2025. And what a fabulous listing, 80% higher on Unimech Aerospace. It's a small company. The company's top line growth last year was just about 200 crore rupees. EBITDA margins were at 37.9%, but margins for the company have been steadily expanding. From margins of 21% in FY22, margins have expanded to 40.5% in FY24. And the company is also seeing a pretty strong growth on the top line too. In FY24, the revenues had doubled from 94 crore to 200 crore odd. And in the first half of the year, the company has done about 121 crore of a top line. Small company, but a bumper listing. But getting back to our conversation with Satish Wagh of Supria Life Sciences. Sir, the street is also looking forward to how you will increase your penetration in regulated markets like Europe, Latin America and Japan. So what is your current penetration here? And in the next 3 years, how much can you increase it by?
Ma'am, as I told you that our exports are 89%. Out of that, 57% is Europe.
Okay.
After that, we go to the Latin American countries. And slowly and silently, we are moving in US also. We have another plant also which is coming up where we have invested 130 crores. That means you can understand we have invested 250 crore. The first plant at Ratnagiri at Chiploon has already gone on stream. The another one at Ambernath will also go on stream within another 30 days. And these two manufacturing sites will give a boost and the strength as far as our sales are concerned.
So US, what could be the revenue contribution from US in 3 years?
We will definitely be with US roughly around about 10 to 15%. But major exports will be in Europe. And
yeah, you
that
said.
is our...
So margins should increase from current levels?
Yes, definitely. The first strong point of Supria Life Sciences Limited is it's a debt-free company. We do every expansion, everything from our own pocket for revenue which we are earning.
Okay. Thank you, Mr. Wagh, for joining in and wish you a very happy new year. It's been a good year for all the shareholders of Supria Life Sciences as the stock moved up more than 100%. We'll get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned.
Which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while NBFCs may see improvement or stability in their net interest margin because their cost of borrowing from the banks will incrementally reduce, which is one of their key borrowing segment right now. Now, management terms are expected to end in 2025 for these banks like IndusInd Bank, Indian Bank, you have Bank of Maharashtra as well. Also, for Central Bank of India as well as Punjab and Sindh Bank. Over the last few years or 6 years or so,
Welcome back. 23,500 in the Nifty, down more than 100 points. So still no respite for the markets, pretty much at the day's low. Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, is with us on the show now. Vinay, 23,500 is an important support for our markets. So, how important is it? What if it breaks, and what would be the trade?
Yeah, good morning and thanks for having me on the show. So definitely 23,500 is a very strong support. It happens to be the previous swing low and it seems to be breaking that level, and the previous swing low was around 23,263. So I think it is marching, index is marching towards that level, and small cap index is also showing some weakness and breadth has been negative. So FIs have been continuously seller. They have been selling into index future as well as the cash market. So the long to short ratio of FIs have in index future has gone to 0.17. So though it is oversold, but still the momentum is there. Nifty has broken down below the consolidation which was there for last 4 trading session. So it's a typical flag pattern breakdown on the charts. So 23,500 needs to be tracked, and if it is sustaining, we are tracking that level closely. If it is sustaining below that for next half an hour, then it is definitely a weak. So markets are precariously poised right now and headed for the lower level. So I think the next support is around 23,200 odd level. That is also a retracement levels as well as the previous swing low. So yes, the outlook for the market is on the bearish side, and Nifty should be held short with a stop loss of, let's say, 23,700. Unless that is taken out on the upside, we are asking our clients to hold the short positions.
Okay, short on the Nifty, and the support now is 23,200. Stocks, Vinay?
Yeah, so basically healthcare and pharma, these are the sectors which are actually outperforming and have been showing resilience performance. So yes, definitely there could be a stock specific bullish momentum in healthcare and pharma space. So Sun Pharma is looking stronger to me. I think technically it is looking very strong, and 1887 is the level where one trader can take entry, fresh long entry, 1887. I would suggest a stop loss at 1850. On the upside, I'm expecting a target of 1950. On the sell side, I would go with the ICICI Bank. ICICI Bank has given a fresh trendline breakdown. There is also a flag breakdown on the daily chart. So ICICI Bank can give a short trade. So January future can be shorted around 1290. Stop loss can be kept at 1310, and target can be seen at 1260 next couple of sessions. So one on the short side, which is ICICI Bank January future, and one on the long side, which is Sun Pharma.
Thank you, Vinay, for joining in. Now let's go over to Manisha, and she's going to tell us the one commodity that's on her mind today. Manisha.
Thank you for that. And that commodity is silver. And last day of the year, but we still are looking at a lot of action onto this one, with the volumes maybe lower, but we still are looking at year-end winding down on positions. For the silver prices, we've seen 1.5% of decline in the overnight market. It's fallen below $29 an ounce, and it's trading at a 3-month lows at this point in time. For this year, on the higher side, we've seen in the international market, silver prices hold around 34.5, and the lower side saw 19, but we are trading at around 28, 29 at this point in time. There are some reasons of this decline. One, the hawkish US Fed statements, uncertain industrial demand outlook going forward really seems to be weighing on to the markets. The second point is the overcapacity in China when it comes to China's solar panel industry, and the kind of tariffs that US perhaps could lead to also seems to be curbing a bit of a demand in the international markets. So China is going down when it comes to demand and production of solar panels. The third point is about the yuan devaluation. Remember, silver demand from China has been strong, but with the currency being devalued and China's loose monetary policy, that continues to weigh on many of the industrial commodities, silver being one of that. The fourth point is the weaker growth numbers that we have seen outside US. That's a bit of a concern as well. And add to that the fact that you are looking at strength in US dollar index, the higher yields, that has continued to weigh on many of these commodities. And then the speculative short position seems to be increasing as well. Markets have seen in India 1 lakh rupees a kg when it comes to silver, but from those kind of levels we are trading at around 88,000-89,000 here. So there has been quite a bit of a sharp decline. But for the coming year, the expectation is that while it's going to be a volatile year, but the targets on the higher side have still bouts contained. JP Morgan, for one, believes that you could be looking at $38 of silver. Remember, we're trading at 28 right now. So that's $10 of a jump up that JP Morgan and UBS believe in too. Bank of America is not so bullish. 35 is the high of this year, and that's what they're sustaining for next year as well. Citi is the most bullish in silver. $40 an ounce is what they're anticipating in the next year. Again, we did see all-time highs, but from there, it has been nearly 18% of a profit taking in case of silver prices. Continues to decline on the last day of the year as well.
Okay, that's very interesting, Manisha. So continued bullishness on the precious metal. Thanks a lot for joining us. Well, on the stock market, I do not have such bullish things to say at this point in time. I'll put it to weak trades, weak volumes, and therefore big impact even of low volume trades. But it's 1.2 down on the mid caps today. That hurts. NAV management is not going to be easy. Almost 1%, 0.75 down on the big indexes, 0.85 on the Sensex actually. Banks are relative outperformers. They are down only 0.5%. But it's not a good day at all. I wanted to ask about Easy My Trip. But before that, Vivek has some interesting info on Ashok Bilkon. Ashoka Bilkon first, Vivek. And then I want your details on the Easy My Trip deals as well. But first, Ashoka Bilkon.
Well, Ashoka Bilkon, the news came in just prior to market open, so we'll address that first, given the fact that we've just had a chance to look at the deal and analyze what exactly is it that the company has done. First up, so the company as well as its subsidiaries, which held 11 SPVs, 11 special purpose vehicles, which had assets that were part of the HAM portfolio, the hybrid annuity model portfolio. What the company has done is the company has bundled all of these assets together, and they have sold these assets to funds that are managed by Edelweiss AAA, which is earlier known as Edelweiss Alternative Asset Advisors. What is the valuation at which this particular deal has been done at? The stake sale has been done at 2324 crore rupees. Now, what is pending for this particular stake sale to consummate? There is approvals pending from SPV lenders, NHAI as well as CCI. So, as per analyst estimates, this particular stake sale has been done at almost 2 times the original investment. So it's a positive at the margin as far as Ashoka Bilkon is concerned. Just a little bit about the assets. All of the assets have already reached the commercial operation date, barring one asset. So overall, a positive deal as far as Ashoka Bilkon is concerned.
Okay. Well, on a good day, perhaps the stock would have been in the green, but at the moment, it's just reducing its shade of red. Vivek, Easy My Trip.
Well, Ease My Trip today morning, we told you about how one of the promoters, Nishant Petty, who held just around 14.2% stake in the company. This was after he had earlier paired his stake in September 2024 by almost 14%. So he had halved his stake in September, and we had understood from our sources, and we also had access to the term sheet where we understood that he was looking to trim or pair out his entire stake in a block deal that was supposed to happen today. But as per the trade window that we had a look at, it appears as though only 1% stake. So out of the total 50 crore shares that was expected to be sold in the block deal window, only around 5 crore shares have actually passed through. There is significant pressure on the stock, down almost 9%. Remember, the base price for this particular deal was at 15.6. So the stock is now trading almost at those levels, but it does not appear as though the entire deal has gone through. We will get confirmation and clarity on the exact quantum of stake sale once the block deal, bulk deal data comes out in the evening on exchanges.
Okay. We'll keep coming to you, Vivek, to explain this deal and, of course, the dynamics happening in the company's management. But at the moment, the legend at the bottom of the screen is telling you the somber news in the stock markets. Nifty plumbing near-term depths, gone below the 23,500 mark, which was held up as a support level. That support is gone. The next support level, my friends in the market tell me, is 23,300. In fact, that's been a level which people have been talking about. 23,300 to 24,300 was believed to be the move, the playground of the Nifty. We are very close to the 23,300 mark, but well, I don't see it getting pierced now. Anyway, a somber day as far as the bulls are concerned. Let's see if they can make a match of it in the remaining 5 hours of trading. For the moment, it's a break. Thereafter, we are going, of course, macros. We're going to check out in our special segment, It's the Economy. We're going to check out if the capex cycle has picked up well and truly for the private sector as well. I'll be speaking to Mahesh Vyas of CMI and DK Joshi, the chief economist at CRISIL.
Ratio difference between the PSU banks and private banks have narrowed from as high as 967 basis points to about 127 basis points at the end of calendar year 2024 so far. Similarly, the net NPA ratio difference has narrowed from 451 basis points that you saw in 2018 to right now about just 11 basis points in 2024 so far. Historically, this is one of the lowest net NPA ratio difference seen between PSU banks as well as private banks. So from CY 2018 to CY 2024, PSU banks gross NPA ratio has declined from 14.2% to about 3.15%, and net NPA ratio has declined from 6.25% to 0.62%. Private banks, their gross NPA ratio has declined from 4.5% to about 1.9%, and the net NPA ratio has declined from 1.74% to about 0.5%. Will RBI change its stance on lenders? Now, RBI has banned many products or entities in 2024. So, RBI did ban, Kotak Mahindra Bank's onboarding of customers via the digital and mobile customer application, as well as they have placed limits on the credit card business due to deficiencies seen in Kotak's IT infrastructure. Now, RBI had raised material supervisory concern on Asirvad MFI, which is a subsidiary of Manappuram Finance. RBI intends to implement the expected credit loss guidelines from 1st of April 2025 to ensure that there is bank's financial stability.
Has private capex picked up? That's the question we are asking today. The government has done its bit in the past 4-5 years. India's investment to GDP ratio has jumped from 28% of GDP in FY21 to 34% in FY24, the last year for which we have full numbers. But much of this increase of investment to GDP has come because government capex has jumped from about 2.9 trillion rupees in 2017 to 9.5 trillion in FY24, and the budgeted number for this year, 11.1 trillion. But what about private capex? Now, the data I have is from RBI. The Reserve Bank of India report shows that private sector, they've only looked at borrowing from banks and the market. Presuming that people would have borrowed for capex, that borrowing has gone up from 1.96 trillion in FY22 to 5.65 trillion in FY24. That's, more than double, 2.5 times. So, has private capex picked up, and where is it headed in FY26? That's the question we're asking two stalwarts. Mahesh Vyas, Managing Director and CEO at CMI, the organization which has the best data on projects, and Dharmakirti Joshi, DK Joshi, the Chief Economist at CRISIL. Gentlemen, thank you very much indeed for your time. Mahesh, you have given us a wealth of data. Take us through those. There, it does look like projects, new investment projects did rise in FY23, but seems to have fallen off thereafter. But Reserve Bank data is giving us a different picture. It looks like it's more than doubled in FY24 from FY22. Tell us, what are your trends?
So we look at two different ways in which CapEx is moving along. We look at the CapEx database and we look at the prowess database. In the CapEx database, where we track two things, principally, which is the announcement of new large capacity projects, and we look at their completion. So steadily, people keep announcing new investment projects, then we track them over their life cycle till they're completed. And as we take snapshots every quarter, we get a time series of the rate at which enterprises are proposing new projects and completing them. What we are finding in 24-25, the first 3 quarters, is that there is a slowdown, and a significant slowdown in the announcement of projects and in the completion of projects. So while there was a big pickup in 22-23 and 23-24, at least in new investments and in completion, we expected some slowdown from there. But the slowdown is lower than even the past average. So it's a bit disconcerting that both new investment proposals and completions have slowed down in 24-25.
Okay. No, it is a bit worrying. One hopes that the slowdown is because government capex slowed, and therefore ancillary investment probably slowed. I'll come to that in just a bit. Mr. Joshi, how would you look at the trends and the data that CRISIL has?
Well, I think if you look at the CSO data, you rightly pointed out that the driver of capex has been government. and the household sector, the housing sector has done well. The corporate sector, I think, has the official data also shows that it has been moving very gradually. And I think from a very macro perspective, I think one of the reasons why private capex has not been forthcoming, despite, I think, the very favorable conditions, the preconditions, so to say, whether it is tax rates or it is, let's say, the PLI scheme, industrial policy of the government, or it is the ability of the private sector to invest, which reflects is reflected in the leverage, low leverage they have. So there is a lot of capability to invest, but I think it's not reflected in the ground. Now, I think here one of the reasons I think which has been playing out for last few years, I think, has been the global uncertainty in terms of the tariff policies. I think it's not. Now it has become much bigger. I think if Mr. Trump comes, I think that's going to create more uncertainty from the global front. Let me explain how it plays out into the investment. Well, I think when US raises tariffs on China, China has overcapacity. They have deflationary pressures in the economy, which are already playing out, which might intensify if I think if Mr. Trump goes ahead with what he said in his election campaign, that the tariffs will increase. Now that will create further deflationary pressure in China. It will slow down the economy, so their exports to other countries will become even cheaper. We already import quite a lot from China. So right now, I think what I'm trying to point out is that the capital-heavy investments, I think, which require some certainty, I think they take a backseat in such a scenario. So I think that's one of the reasons. And then I think even the domestic demand has been a bit uneven, I mean, so to say. If you look at the GF's gross fixed capital formation, I think that has risen by 29. It's 29% higher than what it was in 2019-20. But the consumption is only 17% higher. GDP is only 19% higher. So there, I think, the demand unevenness also plays out, but not to that extent. And I think CSO was planning to do a intention survey. I think that kind of survey would throw further light on why I think the private sector has not come forth to that extent. But to me, I think the uncertainty plays a pretty big role, I mean, at this juncture. So you are in a wait and watch mode, I would say.
Okay. No, fair point, Mr. Joshi. I take both your issues. There was some data, I think it was S&P, which pointed out that in 2018, when the first Trump tariffs were unleashed, global business investment came down because of the uncertainty. And an action replay is definitely possible, and it's probably already playing out. People want to hold back and see what comes after Jan 20th. And the second point you make of consumption being lower could also be a reason why people are holding back on investments. But there can always be, of course, a flip side. I'll come to that in a minute. Mahesh Vyas, I looked at this RBI data, and it's fairly detailed. They have looked at finance raised by companies from banks, FIs, FCCBs and ECBs and IPOs, and assumed that that is for capex. Otherwise, why would you raise so much money? And there it's quite a jump from 1.96 lakh crore in FY22 to 5.65 lakh crore in 23-24. They don't have for 24-25. Isn't that impressive that it seems to have gone up, at least the money raising?
In terms of the amount raised by non-finance companies, it's very impressive. So certainly that doubling or near doubling is very impressive. But at least some of them, and not an insignificant amount, is offer for sale, at least the IPOs. So some part goes off over there. The thing is that the corporate sector is raising resources more than what it used to raise earlier, but that's still not getting translated into net fixed assets creation. So mind you, companies did not have any dearth of capital or financial resources to invest even in the recent past. Since the last 3 or 4 years, they have been making more profits than they ever made. 3x is the profit they're making since the pandemic compared to what they made earlier than that. So they are making a lot of money. So it is not about the resources at their behest. It is what they do with the resources. That seems to be a bit of a worry, because that money is not going into the creation of net fixed assets. Now, if you look at the balance sheets of companies, whether it is listed companies or unlisted companies, the growth in net fixed assets in nominal terms is in single digits.
Yes.
So what Mr. Joshi was saying, that households and the government sector is the source of capital formation, but not the corporate sector. But the most efficient source of corporate capital formation is the corporate sector, which is not investing. And what we see from the balance sheet is a bit shocking, Lata, if I may say, that consistently for the last nearly 10 years, as the corporate sector has been making good profits, it's parking the money into financial investments. So while fixed assets are growing in mid-single digits, investments into financial assets is growing in double digits. So it's not about the resources. The RBI's findings are fine, but what is stopping the corporate sector from putting this money into long-term capacity creation?
You know, we are playing exactly the data that you gave us. Growth in net fixed assets was a high in FY20 of 13.6% growth, year-on-year growth. And as we come towards 23-24, it is just 6.6% growth. And in fact, we also have CMIE Provis data for H1 of the current year. And even over there, we are seeing a fall from 7.8% last year to just 4.8% this year. And investments, that means people are company treasuries, corporate treasuries are just putting their money in probably mutual funds or in shares. They're just investing. They're not putting into concrete fixed assets. That's what the data is indicating, at least for the last 2-3 years from FY22, as it were, and that's a little worrying. Mr. Joshi, can it play the other way around? You raised the China worries, uncertainty as a worry. But that can also mean that the China plus one factor can work. We have seen a lot of even Chinese companies making investments in India, and definitely Apple and a whole host of, mobile phone companies, laptop companies coming in. So can it play positive?
Yeah, it can play positive. I think you're right. Let's look at the nature of corporate investment that is taking place. That will provide an answer to what you are saying. I think steel and cement are doing well because government is creating infrastructure, and so the prospects for steel and cement investments remain quite bright for the next 3-4 years, according to CRISIL assessment. Now, if you look at the industrial policy of the government, which also promotes private investment by incentives, here, I think we have seen less capital-intensive segments like your electronics or pharmaceutical. They are the ones which have done well. So there, I think the ratio of capex to sales is quite low. Now, in the next phase of PLI, I think we will see the movement towards more what you were mentioning. I think more capital-intensive stuff, which is mobile, solar panels, etc. Here, I think you will add more value, and we have found that in the past that where the value addition rises, the capex intensity also rises. So you will see this play out, and the PLI is going to peak in 26. So I think you'll see some traction in 25 and 26. And then I think also what needs to be kept in mind is that the newer emerging sectors are now going to play an important role in the capex cycle from the private sector. And here, I think I just want to point out that when you get into a newer area, you also have newer risks, but you don't want to miss out. So I think that balancing has to be done, and so that kind of makes the corporate sector a little cautious. But 40%, according to S&P, 40% of the investments in the next 10 years from the conglomerates is going to come from newer areas.
Got it. Yeah, unfortunately out of time, but thank you very much, Mr. Vyas and DK Joshi, for giving us a very clear idea that the private sector has not yet quite picked up the baton. It looked like that in FY22 and 23, but we are seeing corporates making money hand over fist, but keeping it in financial investments and not creating fixed investments. Hopefully, the trend should change. Thank you very much. That's it on this edition of Bazaar. After a break, it'll be time for Chartbusters.
Interest, assess the overall risk exposure and accuracy, reflecting the true value of bank's loans portfolio. Now, project financial, there may be additional provisions over there as RBI has stated in their draft regulations. So, this will be implemented in a phased manner, 2% by 31st March 2025, 3.5% by 31st March 2026 and to 5% by 31st March 2027. RBI has given new draft norms which states to increase the bank's liquidity coverage ratio by an additional 5%. Now, the runoff factor for retail depositors is a key cost, and this will also see that who are enabled with internet and mobile banking, that will see additional incremental over there. So, it may come into effect from 1st of April 2025 and may lead to short-term slowdown in credit and impact the net interest margin of the lenders on the negative side.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how
the Indian market trades with cuts on the last trading day of 2024 on the back of weak global cues. Both Sensex and the Nifty are down over 0.5%. IT stocks are the top losers while Pharma remains resilient. The broader markets further underperform.
Shares of Easy Trip Planners fall as much as 10% after co-founder Nishant Pitti announces plans to sell his remaining stake via block deals. Now, at least 3.5 crore shares worth around 53 crore rupees have already changed hands in block deals. So far, the stock is down around 8% right now.
Adani Wilmar is down nearly 7% after Adani Enterprises decides to fully exit the joint venture post. The exit, Wilmar will increase ownership to 75%. JP Morgan goes underweight on the stock with a target price of 320 rupees per share, while Investec gives a hold call with a target price of 397.
Masgao Dock was up almost 4% at the start of trade, but now has given up the gains to trade 2.5% lower. The company has signed a contract worth 1,990 crore rupees with the Defence Ministry for submarine technology.
And Unimech Aerospace marks a stellar debut on D Street today. The stocks lists at an 85% premium of 1,460 rupees versus its issue price of 785 rupees. In fact, the management will be joining us shortly to discuss their post-listing strategies in detail.
Good morning, you're watching Chartbusters here on CNBC-TV18. I'm Hormus Patakia, with me is Vinny Motiwala. It's the final day of 2024. You usually end the year on a high, but it does not look like the market has any intention of doing that considering the screen we are seeing right now.
It's red today. There's nothing. Yesterday, I think at least one of them was managing to hold on to green. That Pharma, which was in the green, also has gone in the red right now. So there is nothing green, but I think everyone's in that low volumes, like we were saying yesterday. So that is the one factor that comes into play as well. Low volumes, and then anything that is a bit of a decline also, you see a sharp fall.
Profit booking as well, right? From the bounce that we saw, we're almost back to the lows that we had made in the month of November on the index. So 23,500 remains that very, very key level to watch out for on the Nifty. But pull up the Nifty Bank as well, and that was the major culprit in yesterday's trading session as to why the market fell from the highs. And the Nifty Bank too currently is down around about 100 points right now. So still managing to hold on to some bit at the lower levels of around 5,800 or 5,500 is that important level to watch on the downside for the Nifty Bank. But for the Nifty, you've seen call writing taking place at 23,800 and at 24,000. So now those two become the barriers for the index on the upside. And as of now, it's a 120 point cut on the index, and that is what we are seeing. The broader markets, though there are plenty of stocks that are moving, though I'd like to pull up REITs. A lot of these railway names are doing well in today's session, although the Midcap index is also down around 0.8%. But REITs is the one that is trading with gains of around 10% in today's trading session. But the market may not be wanting to end the year on a high, but the IPO market has definitely ended the year on the high with the final listing of the year, which is
Absolutely.
Unimech
What a
Aerospace.
bumper listing coming in, right? And that is from Unimech Aerospace. Interesting company there. So we will begin the show with the newest kid on the block. And it's an aero component manufacturer, Unimech Aerospace, that listed at an 85% premium to its issue price of 785 rupees. Now we have Anil Kumar P, who is the chairman as well as the managing director of the company, joining in with us to discuss the post-listing strategies. Good morning, sir. Thank you so much for joining in with us. And what a bumper listing coming in. So firstly, congratulations on that. But, now you can talk numbers. So we are also excited about that because, your growth, obviously, it's been a lower base when you look at it in the last few years. What a good growth just in FY24 when you look at it, 120%. But now what is the strategy, right? Currently, when I'm looking at it, first half, 121 crore rupees was your first half FY25 revenue. Where is it in FY25 end, the revenue? And do you see the 400, 500 crore mark coming in the next couple of years?
Yeah, so thank you. Thanks for your wishes. And so from a revenue point of view, we, as you see on our DRHP, we have booked about 120 crore in the first half of the year. And usually second half of the year is always better in the nature of business that we are in. So while I would say you would have a decent growth compared to the last year, and especially with the capacity that we have installed recently, and the utilization is picking up. And for investors, definitely it's going to be a gain, I would say, from the revenue, the business performance point of view.
Mr. Kumar, good morning. Thank you for joining in. Congratulations on the listing. Most of your revenue comes from the export markets. Is there a plan to focus more on the Indian markets as well, considering the push that you are seeing in the sectors that you are present in, or would you like to continue to maintain or remain an export-oriented company and maintain the numbers as they are?
No, I think we are already in the process of growing our business in the domestic world. Especially the Indian defense is picking up. There's a massive opportunity that we have yet to grab, and also the nuclear sector with the nuclear power capacity demand increasing from at least 3 times from where we are now. So we want to kind of capitalize the opportunities in the nuclear and defense segment, and also to an extent space segment. So we are definitely looking at expanding to Indian market.
Right. Mr. Kumar, one thing also I want to understand is in terms of your margins. FY22 margins at 21%. Now, H1 FY25 margins are at around 40%. So, we've seen that sharp jump in terms of margins. But from here on, where do we see the margins moving? Is this 40% peak, or is there still more room for upside?
I would say I think we had the best of the quarters. I would say 40% is the best of the margin. I would say we might be able to marginally increase, but in those quarters we have done those complex products which kind of yielded very high margins. But I would say it's best, and you can kind of look at the trend. Usually we would be around that trend in terms of the margin. So if you see the 22, the reason why we had a lesser margin was, the utilization, especially being a project-oriented company, the utilization would be lesser, for example, because of the after COVID effect. But today we see the utilization is very, very high, and also the complexity of the project that we deal and the value of the project that we deal attracts the higher margins.
So what are the utilization levels currently, Mr. Kumar, if you could share some numbers on that front?
Typically, the utilization will be around 95%. So that's where we kind of, raise the money through the IPO. We are investing on more and more capacity. If you see the last 3 years trend, it's always at 90-95% kind of a range.
Right. Mr. Kumar, generally in your line of business, the gestation period is somewhere between 7 to 28 weeks in receiving the order and then receiving the payment. So could you just explain us your working capital situation currently, and where do we see that moving? Any improvement expected on that front, or this would be something that would be maintained?
Yeah, so from a working capital cycle point of view, I think we are doing okay compared to the peers or the segment especially, because our delivery timeline lead times are typically between 8 to 16 weeks, and our customer payments are somewhere between 45 to 90 days based on the customer. So we are doing approximately 140 days of working capital cycle, which I would say would stay around that timeline in the coming days. As you know, as a business, we are kind of mixing or growing our precision component segment, where you would see some level of increase in the precision working capital cycle, whereas as long as our bigger portion of the business is tooling, definitely the working cycle would be around 140-150 days.
Right. Just, quick follow-up, Mr. Kumar, in terms of the air tooling as well as both the segments, the precision component segment, where right now you're mentioning 90% of your revenue is from air tooling, more than that, 99 approximately. How are the margins for both these that work? And, is there a chance that you would be focusing on precision component segment going forward furthermore?
See, I think from an internal plan, we have about 70-30 or 65-35 ratio between tooling and the precision components and sub-assemblies. So where tooling attracts higher margin because of its complexity and lower volume nature, precision components will have smaller margin, deficit compared to the toolings. Whereas as an overall business, our strategy is to kind of maintain that 70-30 ratio to kind of maintain the company level margins at a similar level.
All right, Mr. Kumar, thank you so much for sparing time and joining us today. Wish you good luck as a public company. Hope to touch base with you more often now that you are a listed entity. That was the management of Unimech Aerospace, the final listing of 2024, and a stellar one at that, a 74% bump up from its IPO price currently. But time for a short break on Chartbusters. On the other side, we'll be joined by Shilpa Raut of Prabhudas Lilladher to get a chart check. And what better time to do that? Stay tuned.
Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government capex side, rising welfare spending is becoming a challenge. With the enforcement of the 3% fiscal deficit limit likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. Capex has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state capex is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.67 lakh crore in the first half of FY25 to just 28,300 crore.
Welcome back to Chartbusters on CNBC-TV18. Markets not doing anything exciting, but a couple of stocks that are managing to hold on to gains today. We have RVNL on the back of an order that's seeing strong gains as well. Hormaz earlier mentioned RITES as well in the railway space, but RVNL specifically because of the orders that we're seeing coming in, that also is managing to hold on to gains of 7% at the day's highest point. Lupin on the back of a couple of news flows. One is they've expanded the diabetes portfolio, so that is something that is keeping the stock in focus, as well as a case that was going on in the US between Teva as well as Anmil. Now that does benefit Lupin because these two are big players in the drug that is going on, that is generic Pro Air. So because of that, which Lupin will increase the sales because of this issue going on between the other two companies, and that is why Lupin is also in focus today. But let's welcome on board Shilpa Raut of Prabhudas Leeladhar for a technical check on the markets. Shilpa, good morning and thank you so much for joining in with us. Markets, last day of the year, nothing exciting that is happening. But what are the charts indicating, because we have seen that fall coming in. What is the level that we should be watching out for? People have mentioned 23,500. Is that a worry that we're watching out for in terms of trade today and tomorrow?
Good morning and thank you for having me on the show. Talking about the setup, we see that the FIs, net longs has dipped very dramatically to 14%. So they're officially now in a very oversold zone. So from here, maybe consolidation can work for a while, but a sharp short covering rally is definitely on cards. So I don't see much of a downside from here. Probably, on a very positional trade on a larger time frame, you can see 23,200 acting as a support. But positionally, if you look at for Jan series, I believe, this is where you can start accumulating and look for targets of 24,500 also coming this series. For today, I believe, keep a stop loss of day low and stay long now. I believe, levels of 23,650 can also definitely test this today. So I'm very bullish on the market right now for intraday basis with day low as stop loss. Talking about Bank Nifty is also holding 50,600 zones. So as long as it is holding that, that is where the support is placed and it is respecting those levels. So from here, again, levels of 51,500 can come in. So keep that tight stop loss of day lows and stay long.
What about specific stocks then, Shilpa? You are anticipating a short covering on the Nifty to take place and you're seeing some bit of recovery as well right now from the lows of the day. What are the stocks that you're recommending this morning?
I have, the first buy would be in oil. Oil, trading at around 427, 428. This 430 is a little resistance, but once it crosses this, you will see a very short, a very strong rally towards 445 zone. So for me, oil is a very good levels to enter right now. Keep a stop loss of 418 and stay long and look for targets of 445. Anybody trying to trade in options also can do 430 call option trading around 16.5 rupees. The same I have recommended in Prabhudas Leeladhar today as well. Keep a stop loss of 11 and stay long. The other one would be a buy. I would recommend, a buy in HPCL, again, the same sector. It is also looking very strong because the support zones, they are very close. 400 acts as a very strong support. Put factors are very active out there. So with the stop loss of 398, you can still stay long in HPCL and continue with the trade. And look for targets of 425 probably.
Shilpa, thanks a lot for joining in with your views on the index and on specific stocks as well. Wish you a very happy new year. Shilpa mentioned Oil India as one of her picks. Oil India, the top performer on the Nifty PSE index for 2024, gains of around 70% so far this year. But shifting focus now to our special segment where we get you a few ideas for profit from Money Control Pro. Bharat Jenani of moneycontrol.com now joins us to talk about a stock that he's tracking very closely.
Today's ideas will be AG Infra Engineering Limited. Project awarding activity was subdued in the first half owing to the conduct of the Lok Sabha elections and the time taken for new government formation. However, the Prime Minister Modi indicating to the ministries to meet their capex requirements for this fiscal, we expect accelerated project awarding activity in the second half. The Cabinet has recently approved highway projects worth rupees 50,000 crore, which is positive for AG Infra Limited. The company has also scaled up the business in the new segments of the railways and the solar. The new segments currently form over 25% of the order book and has significantly reduced the concentration risk for AG Infra Limited. The company has received projects worth rupees 6,300 crore in April to November this fiscal, and the company is expecting an order inflow of 11 to 12,000 crore in the current fiscal. The company has identified bid project pipeline of 1,10,000 crore rupees, which indicates a huge potential for new order wins. Also, the company is sitting on an order book of 16,600 crore rupees, which is about 3 times trailing 12 months revenues and provides a strong growth visibility going ahead. H-Infra is amongst the few construction companies that has a reputed management, financial prudence, and a strong balance sheet. At the current market price, the stock is trading at a PE of 15 times its core EPC FY26 earnings. Investors with a long-term view can add the stock. Thank you.
Thanks for that, Bharat. But on that note, we're going to slip into a very short break. And as we slip into the break, CNBC-TV18 is asking some key questions. How will the Nifty perform in 2025? What are the sectors or themes to bet on? Will the flattening GDP growth revive in 2025? Will the RBI start cutting rates in 2025? And we will ask the experts for you all these questions. So stay tuned in for the most comprehensive market poll tomorrow on CNBC-TV18.
November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp up in large, lumpy capex projects. Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, the groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
Welcome back to Chartbusters on CNBC-TV18. A quick look at, what the Nifty is doing as of now. Almost, 23,500, just managing to hold on to that mark. So we should watch out for where that is headed in the second half of the trading session. Recovered from the day's lowest point, though, the Nifty. It was at 23,466. So, will it be able to hold about the 23,500? Let's keep an eye out on that one. As of now, the Nifty is down 0.5% in trade. Nifty Bank, too, not performing anything well in trade today as well. That also is on the red front, and we're seeing Nifty Bank also down almost 0.2 to 0.3% in trade. Let's pull up Nifty PSU, because Nifty PSU Bank, that side is managing to hold on to some bit of a green coming in here today. So Nifty PSU Bank is holding on to 0.4. This is Nifty CPSE that is holding on to 0.4%. PSE is holding on to 0.5% in trade, and PSU Bank is up 0.3% in trade as well. So that recovery that we've seen in PSU banks, that's interesting. While banking overall, Nifty Bank is down, but PSU banks that managed to see an up move coming in trade. Nifty Pharma, some bit of a green coming in on that front as well. We have seen those pharma names buzzing in trade today. So yes, interesting to watch out for where all this is going to be shaping up in the second half of the day. Nifty Pharma started in the red, and then at the day's highest point, 0.7% as of now for the Nifty Pharma. But let's move on. And 2024 has been a weak year for global steel industries, and that is impacted majorly by the Chinese steel exports. So can steel find its sheen in 2025 and stage a recovery? Nigel is here with a 2024 recap and what is in store for the steel sector in 2025. Nigel.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
Nigel, thanks a lot for that. But Shilpa just spoke of a short covering on the Nifty a few minutes ago. And look at that, 23,590 now, 120 points off the lows of the day in a matter of minutes. And that is how choppy the market has been throughout last week and to a better part of yesterday and today's trading session as well. What's pulling up the index though is Kotak Mahindra Bank is at the highest point of the day. SBI, as Vinny just highlighted, PSU banks are doing well, and that is courtesy SBI. That is also up around 0.8%, contributing to the upside. Reliance Industries is making a mark, looking to extend its gains, currently just 0.3% higher, but that being a Nifty heavyweight is contributing to the index upside, and it shows on your screen as well. And with that, it's a wrap on this edition of Chartbusters from Vinny, me, and the team that put this show together. Thank you so much for watching. Trading Hour up for the next 60 minutes.
Rusiya tərəfi Azərbaycandan üzr istəməlidir.
The Russian side must apologize to Azerbaijan. Secondly, it must acknowledge its guilt. Thirdly, those responsible must be punished, brought to criminal responsibility, and compensation must be paid to the Azerbaijani state, to the injured passengers and crew members. These are our conditions. The first of these was fulfilled yesterday. I do hope that the other conditions will also be accepted.
Onlardan biri, bax, birincisi artıq təmin edildi.
Good morning. Welcome to Trading Hour, the last trading day of 2024, and things are not looking so bright. In fact, it's looking red, down about a third of a percentage point. The only good thing is that after the gap down opening, then the sell-off that we had in the initial part, it's not gotten worse. So we're still around, 23,000, 580. In fact, there has been a little bit of a recovery from the day's low because we went down to levels of even 23,500. Midcap still down close to about 0.5%. IT has taken a big knock today. The Nifty IT index is down over 2%, and the advanced decline ratio right now at least is in favor of the declining stocks. Hi.
Good morning, Rima. You encapsulated very well, given the fact that there's been a brief recovery after the kind of sell-off that you saw, especially in the first hour. And it's actually been the pharma stocks that have actually managed to help the entire market pull high. All of the pharma stocks now near the day's highest point. So, just looking at the market setup, very volatile trading session like it's been in the last couple of trading sessions, but markets have managed to rebound off the day's lowest points, even the Bank Nifty for that matter. In fact, the top Nifty gainer today is actually Kotak Mahindra Bank with gains of almost 2%. Now, the other section of the market that's seeing very divergent trends today are the exporters or the rupee sensitive, something that you just alluded to. So while IT has been a very big drag, it's actually the pharma index that's holding out in the green, and most of the pharma stocks today are doing quite well in the session. In fact, names like Sun Pharma, Cipla, Lupin, all of them are trading with gains. From the broader end of the markets, one particular stock that's seen quite a bit of a sell-off is Ease My Trip. The block deal of almost 14% doesn't appear to have gone through fully. Only around 1% or a little more than 1% has gone through, and that stock is now down almost 6.5%. From the broader end of the markets, names like Wrights, NBCC, Reddington, these are the names that are doing quite well. So overall, very choppy trade, and pharma is the only segment you could say is actually holding out in the green.
Pharma's had such a good year and towards the end of trade, even the rupee depreciating has acted as a tailwind. But there are individual stocks in pharma where there is positive news. So Lupin is one stock, and we should pull up Lupin because they have entered into an agreement with Eli Lilly for diabetes. And we know diabetes is a big problem in a country like India. So to talk more about it, and Lupin is up close to about 2%, we have with us Vinny joining in. Vinny.
Yes, this is a big drug that is coming from Lupin in terms of adding to the diabetes portfolio from Eli Lilly. They've purchased this drug. Now, this drug mainly currently, when you look at Lupin's diabetes portfolio, Q2 FY25, they managed to see a 19% growth on a year-on-year basis for the diabetes portfolio versus the industry growth of 9%. So this surely will boost their portfolio in terms of the diabetes side portfolio for the company. Now, other than that, the important news flow that came in overnight and yesterday was also that Teva and Amneal, these are two companies that are involved in a drug called generic Pro Air. Now, this drug, mainly there's an issue going on between these two companies. So with that, even Lupin actually sells this drug. So it's a positive that, when Teva and Amneal, the launches of their drugs are going to get delayed. Now, because of this delay and because of the issues going on in the US District Court of all these companies, this benefits Lupin because now the delay of the drug launch by these two companies would benefit Lupin, and they will continue to gain in terms of the market share, and the sales for this product will continue at least till Q1 FY26 is what analysts have also highlighted. So MK has maintained the buy rating on this one for Lupin because of this issue as well. A surprising positive move coming in on this front for the company.
Thank you very much for that. Ashoka Bilcon is also in focus. Vivek, what's the update?
Well, that's right. So Ashoka Bilcon, just prior to market open around 8:50 is when the company updated the exchanges. Remember earlier, the company had sold quite a few assets from its BOT portfolio, that's the Build, Operate, Toll portfolio, to another entity. But today, the development was that the company, along with its subsidiary, has sold close to 11 SPVs, that are special purpose vehicles that actually have HAM projects, which is hybrid annuity model projects. And this particular stake sale has been done to funds that are managed by Edelweiss Alternate Asset Management, or now known as Edelweiss AAA. Now, this particular stake sale has been done at a valuation of close to 2,324 crore, and analysts tell us that this particular sale indicates that Ashoka Bilcon has managed to recover almost 2 times, or close to 1.8 times the original investment. Now, this particular stake sale is subject to a few approvals, and the approvals need to come, number one, from the lenders to the SPVs, NHAI, as well as the Competition Commission of India. all of the 11 projects or all of the 11 SPVs, barring one, actually have achieved commercial operation date. Only one is still under construction. So it's a positive development for Ashoka Buildcon, making close to 1.8 to 2 times the original investment and also divesting the entire HAM portfolio.
Okay, and as we step into 2025, CNBC-TV18 is asking some quickie questions. So how will the Nifty perform in 2025? What are the sectors and the themes to bet on? Will the faltering GDP growth revive in the next year? And will the RBI start cutting rates? We will ask the experts for you. So stay tuned for the most comprehensive market poll tomorrow on CNBC-TV18.
Quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries. And with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1350 to as high as 1950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it was
Welcome back to Trading Hour. Well, with Bitcoin crossing record highs of $100,000, President-elect Trump has taken a pro-crypto stand and more countries are accepting cryptocurrencies as legal tender. 2024, therefore, has been a breakthrough year for cryptocurrency. Manisha brings us more on how the world of cryptocurrencies has evolved in 2024 and what to expect in the new year.
2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at $108,000, surging 130%. The crypto market cap also hit a record highs of $3.9 trillion. The year 2024 started on a very high note with launch of Bitcoin ETFs, which gave an easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion of inflows. Ethereum did not lag too far behind with ETF inflows above $2.7 billion, making its place in decentralized finance. Well, the institutional investors now own 20% of all Bitcoin ETFs traded in US, and then it was Bitcoin halving, an event that happens every 4 years. It leads to reduction in the block rewards by 50%, lowering the supply of Bitcoins. And then it also was about rally taking wings after the US President-elect Donald Trump's pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested that the US Bitcoin reserve could be a possibility, and there was also a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who's a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have totally cheered, expecting favorable regulations going forward. Well, then you had the Russian President Vladimir Putin also recently saying that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. And then after El Salvador, countries like Tonga, Paraguay, and Panama are now considering adopting Bitcoin as a legal tender. Well, the cryptos also are taking support from wider adoption of real-world assets. Stablecoins are emerging as payment tools for enterprise businesses. The year 2024 also had its share of frauds, hags, and rug pulls. The sector lost nearly $2.3 billion in 2024 in frauds, which clearly is lower than the last year, but nonetheless a big amount. The names that went through these issues were Wazirex, Radiant Capital, DMM Bitcoin, among many others. While the Bitcoin grabbed all the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano have all hit all-time highs in this year. While lesser-known altcoins like Palm AI, Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor. Market capital hit $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and also blockchain as a technology. The markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein expecting $200,000 for Bitcoin. MicroStrategy expects Bitcoin to rise 29% per annum for the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
Indeed, wise words. Thank you, Manisha, for that. But now let's turn our attention to the defense space. Now, defense has been such a structural theme of our markets over the last few years, and many investors point out that perhaps it's got a long runway. Now, Care Edge Ratings in its recent note says the Indian defense sector is set to grow at a compounded annual growth rate of 20% over the next 5 years on the back of strong government backing, increasing private sector participation. They also anticipate India's defense exports will grow in tandem with government spending at an estimated rate of 19% from FY24 to FY29. We have with us Dr. Naveen Kumar, Associate Director at Care Edge Ratings, joining in. Naveen, thank you very much for joining in. So first, tell us the crux, the key points of your research report. 20% top-line growth for the industry for the next 5 years?
Yeah. So, we expect, basically what we see is that both, the government and the private participation is being constantly increasing in this particular space. Especially, what we see is that since gaining up the independence in 1947, India has gradually transitioned from relying on the imported military hardware to enhancing the indigenous defense capabilities. This shift is, driven by the domestic manufacturing and the technology transfer agreements. Today, defense sector includes both diverse mix of public and private enterprise involved in various aspects, such as from defense to research and development. And apart from that, we also see that India's defense budget has consistently ranged between 1.9% to 2.8% of the GDP. And in the current year, we see the fiscal outlay of about 6.22 lakh crore. And for the defense production, it is about 1.75 lakh crore. So based upon this, we understand that the defense sector is expected to grow by about 20% going forward for next 3 to 4 years.
What is the percentage of indigenization right now in the production, and what was it earlier? If you could just talk about that.
Earlier, primarily the country was a net importer, but what we see is that there was a concerted kind of an effort which was made by the Indian defense industry. Especially, it was supported by the policy reforms such as Make in India, which is bringing about the gradual shift. Today, India boasts an expanding defense industry encompassing wide range of advanced military weaponry systems. India's defense include diverse array of aircraft, naval systems, missile technology, and all. So what we see is that over the last 6 years, ending in FY24, the Indian defense exports have grown at a healthy CAGR of about 28%, and the Care Edge estimates that the India's defense exports will consistently grow in tandem with the government spending, that is about 20% going forward.
Naveen, so you've spoken about two important aspects. Number one is the own Indian government spend, and then number two is the export opportunity. Now, talking about the Indian domestic market, where do you see the key opportunities lie? So what kind of companies will be more benefited, and what is it, do you feel, in the next AON, that is the acceptance of necessity, will you see what kind of weapons do you feel there will be need for further spending on?
See, we have got, when it comes to domestic companies, so there are now about 4 to 5 key players, key companies which are making this effort. One is Bharat Dynamic Laboratories, and there's a HL, there's a Mazgaon is there. So these are the main entities. Apart from that, the Ordnance Factory Board, comprising of about, which is currently divided into seven corporates. These form the critical in terms of the domestic defense public sector undertaking companies, which form about 80% of the entire defense industry. Whereas when it comes to the private sector, there are about 4 or 5 players are there, which comes from the Tata Group, L&T, Mahindra Defense, Kalyani Group. These all play a pivotal role in advancing the defense modernization, leveraging their engineering technological expertise.
Okay, so you've spoken about the improvement as far as the expertise is concerned. Now coming to a name like a Bharat Electronics, where there have been multiple one-time opportunities. Do you feel that there will be a lumpy nature as far as order wins are concerned, or do you see that there can be steady order wins, especially when it comes to defense spends? H1 especially was quite muted when it came to orders actually coming in.
See, what we see is that the Indian government has made an estimation of reaching its defense production to about 3 lakh crore by FY29. So what we say is that in order to achieve this kind of growth, they have to make a CAGR of growth of about 20%. So in that context, if I have to see, then if I have to say, then there may be during one specific quarter, there may kind of be lumpiness, but we see that overall there will be kind of growth prospects are going to be very healthy for all these companies which are there in the public sector undertaking.
Any particular stock analysis? Have you chatted with the companies? Because earlier there was some concern that the execution may not keep up.
Oh, sorry, execution?
Execution on the end of the companies may not keep up. We may see a lot of order win announcements. But in terms of that translating into revenues or just the pure execution may not keep up with the kind of headlines that we get.
See, what we understand is that, especially when it comes to the DPSU part, there is a kind of dependency on the certain import of certain key raw material from the Russia and all. So what we have seen is that because of geopolitical issues, these imports have been to some extent been inhibited. Because of it, there's a slight delay in terms of the execution. However, with the subsiding of this geopolitical tension to some extent, now we see that the execution and the production is being on track. So what we see is that going forward with the increase in the indigenization within the domestic market, this what are the lumpiness or the crests and troughs are going to even out going forward is what we understand.
Naveen, one last question from our end. What we want to understand is, especially in the case of a name like HAL, which is, in the process of manufacturing the LCA or the light combat aircraft, they've been dependent on supplies from someone like a GE. And this particular delay has caused significant waiting as far as the investors are concerned and as far as the revenue booking itself is concerned. You did mention about supply chain challenges. Do you see this continuing, in the coming years as well? And how do players overcome this?
With respect, I abstain from making a comment company specific. So while we overall, what I say is that not only for the HL, overall the industry, whether it is like BrahMos, whether it is for JV with both India and the Russian government, and also the Ordnance Factory Boards, where they have got partnership with the Russian entities and other countries, we see that there is some kind of supply chain issues which are taking place because of geopolitical issues. But what we see is that this is not a kind of a sustaining factor, this inhibitions factor which are playing out. So overall, what we're seeing is that though there is a kind of lackness is there in a H1 or probably 1 or 2 quarters or 3 quarters, but eventually it is evening it out. So that's why I was saying that this crescent troughs are going forward is going to significantly even out, and we are going to see that much more dynamic is going to play in the domestic industry, defense industry, especially with the private participation coming in. This particular industry is definitely going to grow by about 20%, what we envisage.
Thank you very much for joining in and wish you a very happy new year. Get into a break. We'll come back and talk technicals. Avni Bhatt of JM Financial Services will join in next.
...2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at $108,000, surging 130%. The crypto market capital also hit an all-time high of $3.9 trillion. Well, the year 2024 started on a higher note with launch of Bitcoin ETFs, which gave easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion worth inflows. Ethereum also did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Institutional investors now own nearly 20% of all Bitcoin ETFs traded in the US. And then it was also about Bitcoin halving, an event that happens every 4 years. It leads to reduction in block rewards by 50%, lowering the supply of Bitcoins. It was also then that the rally took wings with the US President-elect Donald Trump pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested US Bitcoin reserve, and there also was a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who is a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have cheered, expecting favorable regulations going forward. The Russian President Vladimir Putin recently said that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs.
India.
Welcome back. The biggest sectoral loser today is IT. The Nifty IT index is down close to a little more than 2%. But this comes on the back of a 21% rally that it's had in 2024. And even last year, in 2023, the index had given more than a 20% up move. Largely what you are seeing is profit booking. So names like Persistent, Oracle Financial Services, which has been a big wealth creator, Coforge has been a big outperformer. The biggest cuts are visible in those names, though there is a Persistent as well, which is down 3%. And that's not had such a great, 2024. In the large cap space, again, it's a broad-based sell-off. Infi, TCS, across the board, you are seeing pressure today. TCS is down 2.5%, and TCS has underperformed Infosys. So year to date, TCS is up 7%, while in Infosys is up nearly 20%. And there's one concern on the street is that the revenue growth of TCS, X of the BSNL deal, has been lagging that of the industry. So the street is a bit concerned, and even the kind of margin recovery that the street was hoping for has not played out. So that's one of the reasons why TCS has been an underperformer compared to Infosys, and Infi's growth has been higher than TCS for the last 2 quarters and likely to be higher even in Q3. But let's talk about the market technicals. Avani Bhatt of JM Financial Services, as promised, is with us on the show, and the little bit of a feeble market recovery continues because the Nifty is now closer to 23,600. Avani, how would you approach trade today?
Good morning, everyone, and season's greetings to all of you. So yes, Nifty, Bank Nifty, both of them did not seem to be in a mood to celebrate the New Year's Eve, but probably we could see some more recovery by end of the day. Yesterday, Nifty had given a close below the 200-day exponential moving average, and the follow-up sell-off was seen by way of a gap down opening today. But since then, since opening, I don't think we are seeing any more further selling from those levels. So a selling climax is done. From here on, if at all Nifty closes about 23,540 today, then I think today's low would be the bottom for the time being. And we should see a good recovery up to around 23,850 to 23,900. That is one area where a lot of resilience is seen. And on Bank Nifty, 50,700 is a very, very crucial level. Bank Nifty, if you notice since last couple of sell-off periods, Bank Nifty has been holding on to its 200-day exponential moving average. So the chances of recovery in Bank Nifty are way higher. 50,700 is the level to watch out for. If it closes above that, then we will be seeing a good recovery up to around 51,400 in a very short time, in coming probably 1 or 2 days.
Avni, very good to hear that you feel that there's an interim bottom in place as far as the markets are concerned. Now, one particular question, have you had a chance to look at the Nifty IT index? Do you feel there could be further downside there, and what are your individual picks for the day?
So Nifty IT, if you notice, if you notice the rally from around 40,000 level to the highs of 46,000 level, From there on, we are seeing a good profit booking happening in this particular sector. And the 61.8% Fibonacci retracement is already done. So I think from here on, it should consolidate for some time and then probably see some pullback, but the pullback is going to be slow and steady. So not expecting any major fireworks in the sector, but the downside should halt and it may consolidate from current levels.
And any individual stocks that you want to suggest to our viewers?
So one sector that has been performing very well is the pharma sector, and among the entire pharma sector, I think the stocks that have not moved and are ready to move on from here. One of those stocks is Glenmark Pharma. So I have an eye on Glenmark Pharma. One can buy in the range of around 1600 for a target of 1735 on the upside and keeping a stop loss of 1555. The second counter on radar is MGL, Mahanagar Gas. So one can go long in this particular stock for a target of 1380 and a stop loss of 1255.
Thank you, Avni, for joining in. Let's move on and talk about Mazgaon Docks. That's in focus on the back of a near 2,000 crore order win. Upasna is here with the details.
Well, that's correct. The stock continues to remain in focus today as Ministry of Defence has signed contract valued 1,990 crore with the company for technology that allows submarines to stay underwater for longer. Now, this is mainly for the construction of AIP system, that is Air Independent Propulsion System, developed by DRDO, and the units will be built by Mazgaon Dock. That's the reason the stock remains in focus today.
Thanks so much for that, Upasna. Mazgaon Dock in focus on the back of that particular development. Let's now take a short break. Up next, we'll discuss the way forward for the market with Devang Mehta of Spark Private Wealth Management.
Visiting previous critical policies. After El Salvador, countries like Tonga, Paraguay, Panama are also considering adopting Bitcoin as a legal tender. The cryptos also are taking support from wider adoption of real-world assets. The stablecoins are also emerging as payment tools for enterprise businesses. The year 2024 also had its share, though, of frauds, hacks, and rug pulls. The sector lost nearly $2.3 billion this year in frauds, though lower than the last year. The names that went through issues this year was Wazirex, Radiant Capital, DMM Bitcoin, among others. While the Bitcoin grabbed the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano all reached all-time highs, while the lesser-known altcoins like Pharma and Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor, with market cap now at $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and blockchain as a technology, and the markets have put even higher.
Welcome back to Trading Hour. Well, as the equity market looks ahead into 2025, Surbi gets us 5 key factors the market will be looking out for as we move into the new year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts, but Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full-year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex, as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity, and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Wow, that was very well explained and put, Surbhi. But let's get in Devang Mehta from Spark Private Wealth Management. He's a perfect person to talk about Outlook 2025. So Devang, let's start with, I don't know if you had a chance to listen to what Surbhi was telling us, but the first factor, right, to watch will be the US markets, the US economy, and whether, the kind of dizzying rally that US markets have enjoyed for the last 2 years will continue. In 2 years, the S&P 500 is up nearly 50%. So what happens to the US markets from here? Because that's the base case, because their valuations are stretched. There is that Trump trade tariff risk as well. And what if the big, the fabulous 7, magnificent 7 stocks don't live up to that AI hype? So there are those challenges on board. How would you approach the global markets as a top-down call?
Morning, Rima. Thanks for having me on the show, and season's greetings to all of you. In advance wishes for a happy new year to all of you, your team, and your viewers as well. Yes, I think clearly, while this is the last day of this year, reflecting on to what happened in 2024, and ideally, I think the last 3-4 months have been so eventful that it takes us to 2025, and I think the start of 2025, we all know that we need to welcome Mr. Trump, and I think the policies that probably lays down over the next 2, 3, 4 months would be I think with a lens markets and market participants across the world will sort of look into it. Now, yes, probably we know that India will not be sort of not a beneficiary of what happens. China, yes, can be a little bit more non-conducive for China than India. Clearly, I think most importantly, you rightly talked about the valuations in US, right? So US valuations, everybody knows by any stretch of imagination are stretched. Now, I think there is a choice that yes, there was a home trade which happened, money flowing out of emerging markets going back to US. That trade is playing right now, and we don't know, probably it might play for a quarter as well. But I think at some point, at valuations which are right now being attractive, we know that the earnings were not so great. There is a contraction in terms of valuation as well, price correction as well. I think at some point we are starting to look a little more attractive than US. Even a lot of emerging markets, be it China, be it India, will start looking attractive. And at that point, the flows would tend to come back. Again, I'm no way saying that it will happen sooner. But very clearly, I think US markets are stretched. Their valuations are expensive. It's a trade which can still last for the next 6-9 months as Trump comes to power, and business policies might be conducive more for US. But the trade is that probably at valuations, in hindsight, 4-5 months down the line, before right now, I think our valuations were stretched. But after this correction of 12% and stocks correcting by 15, 20, 25, 30% also, I think our markets are getting more attractive than US.
Right. Devang, very interesting point you've put out there. Well, you've also spoken about currency volatility, and Indian currency, or the rupee, has been weakening quite significantly. In that backdrop, two sectors we want your opinion on. Number one, how do you look at IT from this point on? And it's been quite weak, especially in today's session. And how do you look at Pharma, which has been doing quite well as far as last 2 to 3 trading weeks are concerned?
I think interesting that currency, I just made a point that Indian currency has been relatively stronger if you compare it to the other pack, emerging market pack. And of course, it is more of a dollar strengthening than rupee weakening, which we have seen. Yes, coming back to the sectors that you asked about, we are very positive on the domestic-centric sectors. Having said that, IT, Pharma seems to be coming back with a bang. IT still seems to be a trade which can generate 10-12% type of returns over the next 2-3 years. The typical large cap IT boys, we know that the constant currency growth and all are probably very, very low single digit. There might be some bit of improvement as the global arena comes back, as demand comes back, and there are more spendings on discretionary as well. So that might come back. But honestly, to tell you the truth, we are more positive on domestic-centric stories than the global linkages or the export-related stories, where we know there are so many moving parts. I was just listening to a conversation before this. There are n number of moving parts when you look at US or China or even the European nations. I'll be more comfortable talking about India's capex or India's strength in terms of discretionary consumption rather than taking global trade. So yes, we might be very gradual underweights over there, but the bulk of the investments that we do are more towards domestic-centric themes.
Indeed, you've been maintaining that for a while, and it's worked very well for all your investors. Any new ideas, Devang, from Spark Private Wealth Management that you'd like to share?
So I think going into 2025, I would probably share certain themes and certain sectors. I think the themes that you rightly said that has worked so far has been energy efficiency, power automation, which we are still bullish on. Honestly, some of the companies that we picked up in the past 3-4 years have become 10x, 12x, and all thanks to the market rally as well, of course. But from here on also, if I dissect the market cap, I think there are a lot more opportunities below 1 lakh crore of market cap, and there are emerging sectors. As we talk, I think there are so many new listings. I'm not getting carried away by the listings, but there is a plethora of opportunities available right now if somebody wants to sort of build a portfolio. And by new age businesses, I'm not meaning businesses who are sort of burning cash. But companies in the automation universe, companies in stamping and lamination, companies I mentioned on a couple of shows back about air compressors, companies like Ingersoll Rand or LG Equipment or Kirloskar Pneumatic, not recommending, but some examples of those. PT Engineering, which is into stamping and lamination. This type of companies, I think, are taking center stage. There are supply chain, TVS Supply Chain is another company which probably should be sort of looked into. I'm not again saying that we are recommending that. Port infrastructure is something which is developing very well. So there is a company like JSW Infrastructure, which also is honestly doing a lot more sort of a work in terms of setting up infrastructure lines for ports as well. And I think it's getting a lot of minor ports into its custody. So I think these are type of businesses which are high in terms of ROE, ROC. These are businesses which are sort of no-debt businesses. These are companies which are growing their profitability at more than 20-25%, EBITDA, PAT. Everything is in line, and these are companies which probably have that type of moat and a huge market share. I think these are sectors one should look into if one has a 2-3 year horizon.
So Devang, you've spoken both about new age as well as some of the old world economy stocks. Now, apart from that, one particular pocket of the market that's not done very well in the last couple of years has actually been the banking pack, especially private financials. Going into 2025, is that one particular space you'll look to nibble in?
I think, see, the problem with private financial has been there is too much of perfect competition as we talk now. Again, I know that it has been a crowded trade the last 2-3 years, and I probably take a bit of pride by saying that we don't own the typical large banks. And why I say that, because yes, we know that the NPA problem has got cleared out, be it private, be it PSU, and I think the banks are all ready with fuel to lend to the new age sectors and the sectors which need sort of a lot of investments, be it semiconductor, be it EMS, all this type of companies. So my sense here is that I would love to be into proxy plays where the lending happens rather than the lenders itself. By saying that, I'm no way saying that banks are under-owned right now as we talk. It has been an over-owned space. The valuations have sort of become reasonable. There can be a trade for the next 6 months, 1 year, which can happen. But as I said, somebody looking out for alpha sectors or companies where the themes would emerge. The next 3-5 years, headlines would have companies or sectors which probably I talked about. So that will be more comfortable over there rather than putting it into a very, very simple sort of banking play.
Devang, thank you for joining in. Wish you a very happy new year and look forward to chatting with you more often in 2025. Enjoy your night. Get into a break. On the other side, the management of Zen Technologies will join in to talk about their outlook for 2025.
For 2025, with Standard Chartered and Bernstein now expecting $200,000 per Bitcoin. MicroStrategy, in the meanwhile, expects Bitcoin to rise 29% per annum over the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
2024 began with a bitter pill for contract development and manufacturing organizations, or CDMO players. A muted biotech funding environment dampened the pace of early-stage projects, leaving these biotech firms feeling the heat in 2024. But here's the good news. Positive triggers are emerging on the horizon, and there are clear green shoots that are visible and indicating a turnaround for the sector. The first one is an uptick in biotech funding, signaling a recovery expected in CDMO investing. Welcome back. Now, Zen Technologies has been one of the biggest wealth creators of 2024. The stock has rallied 200%, and it's backed by an improving revenue growth trajectory. Just look at the numbers. In FY23, the company's top line grew by 200%. In FY24, it's gone up by 166%. And there are some estimates which suggest that in FY25, also the company will see its revenues go up by more than 100%. Ashok Atluri, Chairman and MD at Zen Technology, joins in to talk about the year ahead for us. Mr. Atluri, thank you very much for joining in. That's the first question, right? Do you think, given the visibility, the order book that you have, your revenue growth can be 100% in FY25? That's the current year, because only 6 months are left, in fact, less than that. And for FY26, what is the kind of visibility that you have?
So FY25, we have promised, 900 crores as a target. We seem to be online with that, 430 crores previously, now 900 crores. And we have said that on an average for the next 3 year, growth would be about 50%. So, give or take, we are still hopeful that we would be able to achieve that on an average. I mean, 1 year may be down, the other year may be up, but overall, we are very, very optimistic about the next 3 years. And we think that government's policies are really, really pushing us in that direction, asking us to innovate, and they're buying very innovative guys. Even if you're a single vendor, they're willing to buy. The legacy of having 3 vendors, etc., is gone. So companies with patents and innovation are really, really benefiting. And then, as you know, the IP play, and we are really benefiting from that outlook of the government. Yeah.
So 900 crore revenue guidance stays for this year, 50% revenue growth CAGR for the next 3 years. Now, your margin guidance was 35% for FY25. Is that on track? And over a 3-year time horizon, given the kind of innovation that we're doing, the operating leverage which kicks in, do you think there's scope to expand margins from 35%?
So yeah, we do think there will be expansion of margins, but we are also thinking that we'll be aggressively spending on R&D and developing more products. So, we would like to stick to the guidance of 35% EBITDA margins for the next 3 years also.
Okay. And what is your R&D spend today? And you said you want to use, you want to scale that up as the company continues to grow. So do you have a number in mind?
Typically we have been doing around, earlier we were doing about 20 crores, but this year onwards it will be between 30 to 40 crores. And we expect that to ramp that up, and, maybe in the region of 50-60 crores is what we expect R&D expenditure to go. I wouldn't like to relate it to a percentage of sales, which is actually a very foolish thing. It is a percentage of the kind of opportunities that come ahead that we want to focus on. And we'll be very opportunistic, and we want to invest in very, very high growth areas, especially in defense, which we see, and because with our ground to the year, we know where exactly to invest, and we are going to take advantage of that.
Mr. Atluri, so you've given us a couple of numbers. Number one, over the next 2 to 3 years, you see a 50% revenue CAGR. As far as operating margin is concerned, expected to be northwards of 35%. And we also believe the guidance you've given earlier is that 25% as far as the PAT is concerned. Now, one important aspect to ensure that these particular targets are met is the fact that you need to have very steady order inflows. H1 was quite muted, for the entire space. So H2, how has it panned out so far? And as far as FY26 is concerned, now where do you see the important triggers or important order flows coming in?
So I think I agree with you that the order inflow hasn't been so good in the H1, but H2, especially Q4, we are very, very positive that the order flow will be very good. And I think with the order flow coming in, even if there is a spillover into the next year, we expect the execution to start during FY26. And again, as I said, it's an average growth rate we are talking about, not a year-on-year growth rate. So, even if something happens, we are very sure we'll be able to catch up later. Yeah.
Mr. Atluri, internally, what kind of order book or order inflow were you anticipating for FY25? And in case there is a spillover, what percentage do you expect to spill over into Q1 or Q2 of FY26?
Very difficult to say that. I think as of now, we feel that we are on track to get the orders that we had assumed to be getting during the financial year. But yeah, if there is, again, what I'm saying is even if it gets spilled over, the execution we'll try to execute during the current year itself, or the FY26 itself. So the execution timeline, we typically are between 6 to 18 months, but we'll try to compress that execution cycle. But again, as of now, the things look very good.
Okay. Can you talk about, I think you had indicated that the company is looking to capitalize on the US opportunities along with domestic acquisitions. Is there any update on that? Any more details?
No,
Can you
again, we are very positive about the US opportunities, and with the government now really going after efficient procurement there, the days of primes being given the businesses and the other innovative companies playing second fiddle is over. America is going to buy directly from companies that innovate. And I think we have been to some expos there, and we feel that we are absolutely in good form. And what they want is something we have. And I think that's one area of growth. The US is as one key market that we look as giving us a lot of opportunities as we go ahead.
Mr. Atluri, two questions. Number one, recently you did a partnership with AVT Simulation, where we believe they will help you explore or access the US market a little better. So number one, can you quantify the opportunity size for us? And number two, as far as the recent QIP proceeds are concerned, you indicated you will look at M&A. Any targets that have been identified, any names you could share with us? And what stage is this particular M&A activity at?
So AVT Simulation is a company that's has done some work in air simulation, and we are looking to collaborate with them in air simulation for the Indian market, and they also are long-term players in US market, and they have some ready-made facilities that we can use as a made in America requirement, the value-add requirement. They're willing to share with us. So they will also have the connections to give us faster access to the US market. So I think it's a very balanced relationship that we're expecting from them. And I wouldn't put a number on it, but we should remember that they almost have a $4 billion training market there for the products like what Zen has. And I think, and in terms of our Zen's products, I think we are absolutely number one in many categories. And we think that that's one market that we'll be tapping. Of course, AVT and without AVT also, sometimes as a prime, sometimes as a subcontractor. Yeah, and with respect
do you have enough capacity to cater to this kind of 50% revenue growth year after year?
So absolutely. I mean, our superpower has been the manufacturing has been done through our supply chain, and the supply chain has enough capacity to accommodate this growth. Okay. And a lot of people ask this question: 60 crores in 22. 160 crores in 23, 430 crores in 24, and now you are saying 900 crores. Till 24, how much did you spend on capex? Actually, the answer is it was close to zero, because all the scaling up took place because we had good set of the supply chain. And again, for this year now we're actually, because we do the final integration and software testing and loading into the system. That's the ground space as we are run out of the physical space, and we are building the additional space to accommodate for the future growth of 50% growth rate. And with respect to the second question about QIP, yes, we have, as I said earlier, that we have identified some companies and they are doing. So we expect maybe in the next 2 quarters to announce at least a couple of acquisitions. So we are very positive about that, but let us hope that this, till the thing happens, it doesn't happen. So we'll wait till actually we sign on the dotted line.
Thank you so much, Mr. Atluri, for joining us and giving us a sense of what to look forward to in the coming year. It's been a significant wealth creator, and we wish you and your team a very happy 2025. Well, moving on, as we slip into a short break, here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store.
Demand for CDMO services in late stage as well as commercial molecules is also on the rise. Moving on to the third one, we have broad-based commercial contracts in biologics and small molecules that is picking up pace, as well as biologic CDMO demand that has remained robust, and we are expecting the good growth to continue going forward. Nutraceutical manufacturing demand that is also recovering quite steadily, and now we will shift focus and talk about what the highlight and commentary is coming in from the CDMO players. That's a key one, because what they're signaling is that maybe in the near term, there could be some mixed near-term challenges that we're watching out for, but a promising outlook that is coming in for the medium term. Piramal Pharma is expecting to see early teens growth as the CDMO segment is outpacing the company's average growth. DB's Lab, they remain quite confident in terms of a double-digit growth in terms of revenue. We have Syngene, Laurus as well as Newland Labs. Now their commentary is quite similar, because what Syngene is saying that they're expecting high single-digit growth in FY25, but FY26 expected to be stronger.
Welcome back to Trading Hour. Well, aero components manufacturer Unimech Aerospace listed on D Street at a whopping 85% premium to its issue price of 785 rupees a share. Earlier today, we spoke to Anil Kumar, the chairman and managing director of the company, and discussed their post-listing strategies. Let's listen in.
From a revenue point of view, we, as you see on our DRHP, we've booked about 120 crore in the first half of the year. And usually second half of the year is always better in the nature of business that we are in. So while I would say you would have a decent growth compared to the last year, and especially with the capacity that we have installed recently, and the utilization is picking up, and for investors definitely it's going to be a gain, I would say, from a, the revenue, the business performance point of view. We are already in the process of growing our business in the domestic world, especially the Indian defense is is picking up. There's a massive opportunity that we have yet to grab, and also the nuclear sector with the the nuclear power capacity demand increasing from at least 3 times from where we are now. So we want to kind of capitalize the opportunities in the nuclear and defense segment, and also to an extent space segment. So we are definitely looking at expanding to Indian market.
The last IPO of 2024, and what a blockbuster one it's been, still holding on to all its gains, 70% higher. For the markets in the red, but not by a whole lot, just down close to about 0.25%, 60 down on the Nifty Sensex declining by 250 points, Midcaps faring a little worse. So that pullback, the recovery that we've seen from lows is still holding. It's a wrap on this show. Don't go anywhere, because on the other side of this break is Halftime Report.
For Laurus Labs, expecting a soft growth in FY25, but a good growth from FY26 and onwards. And Newland Labs, also flat growth in FY25, but targeting a 20% CAGR growth in the medium term. Now let's look ahead. The industry is poised for an acceleration in terms of top-line growth. Currently somewhere at 9%. By FY27, 16% growth is what one is watching out for. However, valuations, that's the key concern coming in here, because valuations currently are ranging somewhere between 47 times to 60 times for these players. Following the surge that we've seen coming in on a YTD basis in terms of a stock performance, that was somewhere between 40% to 80% in the run-up that we're seeing, which is outpacing the Nifty Pharma's 34% rise that we saw this year, approximately on that front. Now, finally, here's what investors and analysts need to keep an eye out on. One is the progress in terms of the Biosecure Act, when it's going to be picked up in the US Senate. Moving on to the next one, we have seen sustained recovery in biotech funding. Will that continue in 2025? That's going to be a key factor. Uptick in RFQ surely is there, but are they translating into confirmed orders? Keep an eye on that, as well as company-specific new launches. What is the trajectory that they have for price erosion in generic APIs is something that is very important for CDMO players. The CDMO sector is navigating a complex landscape of challenges and opportunities that they're seeing. While there are signs of recovery that is quite evident, sustained momentum will be a hinge on factors like funding, legislative support, as well as execution capabilities of these key players. However, could these stretched valuations limit the sector's ability to deliver significant gains in 2025? Let's watch out for that.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick.
Market comes off the morning lows in thin year-end trading, but mid-caps are bearing the brunt. IT and realty are the weak spots, while metals and healthcare are exhibiting some strength.
Reserve Bank of India in its financial stability report has flagged the rise in write-offs, especially by private banks, saying these could be masking worsening asset quality in the retail credit segment.
Ease My Trip co-promoter Nishant Pitti is likely to exit the company via the sale of his 14.2% stake. Nishant had earlier divested another 14% in September for over 900 crore rupees. The move raises eyebrows with questions around the motivation for the move.
EV player Ather Energy's rupees 4,000 crore rupee IPO has got SEBI's green light. The fresh issue of shares to raise rupees 3,000 crore will help it expand capacity by 3.5 times. Two-wheeler maker Hero MotoCorp will remain its biggest shareholder.
And Brent rises above $74 a barrel after US inventories declined and China's manufacturing activity saw a positive expansion in the month of December. With this recovery, oil is set to close 2024 with a modest loss of nearly 0.5%.
Hello and welcome to Halftime Report. I'm Lata Venkatesh and with me is my colleague Hormaz. Hormaz, pleasure to be anchoring with you for the first time in my life. You've always been on opposite sides of the table. Well, we are meeting at a time when the market's keeping us guessing. When we wound up on Bazaar, the markets were staring at an over 1% cut for the Midcap index and about a 0.7-0.8% cut for the Sensex and the Nifty as well. At its lowest, the Nifty had gone way below the 23,500 mark to about 23,450 thereabouts, and that was seen as a bit perilous. But the last 1 hour has been kind to the bulls, and we have seen a remarkable pull-up, led, guess by whom? Kotak Mahindra Bank of all things.
Indeed, indeed. And that is the case, right, with most of these banks like Kotak, IndusInd not performing all through the year, even heavyweights like HDFC Bank not doing well. And that shows because another single-digit year for HDFC Bank. But yes, Kotak Bank is the one that is leading the recovery on the index, and almost 130-point recovery now from the lows of the day is what is also contributing to the recovery, though, is Sun Pharma and PSU banks led by SBI. They are the ones that are contributing to this recovery that you are seeing from the lower levels in today's session. Of course, we are set to end the year with gains of around 8 to 9%. But the bigger takeaway is the fact that this will be the 9th straight year of positive returns for the Nifty.
You know, I'm less impressed by that number. Let me tell you, GDP growth of India is higher every year before the previous. markets are somewhat of a reflection of the GDP. So, I mean, yes, there are times when the market gets ahead of itself and then you have a down year, you have financial accidents. But as a rule, markets must end higher every year in a country where the GDP ends 7% or 6% higher every year, would be the way I would look at it. I'm less impressed by these numbers, but more impressed by these individual pockets that have done 100%, the EMS companies, hotel companies. But just a word on this recovery in the market. Well, for one, I rarely have the opportunity to say, I told you so in markets. I mean, I'm always listening to the experts. But there was a buzz in the market that today, with thin volumes, NAV management will come to the fore in the latter part of the day. Let's see. We have still about 3 hours of trading left. So things can go any way. But the expectation is with the cat away, that is the big traders and the big probably foreign funds away, it's possible that in the last 2 hours of trade, traders and funds are able to push up important stocks, SBI, Kotak Mahindra, HDFC. These would be in everybody's portfolio and it would be to everyone's advantage if those stocks did well. To be fair, the mid-caps have seen a lot of news-driven stocks also doing well. RVNL got an order and that's kept that stock buzzing. Likewise, we've seen decent gains coming in BEL, the defense stocks generally, all of them rising. So, there is some method.
You are not impressed with the Nifty returns, but let's ask if Vineet Arora, the managing director at Nav Capital, is impressed with the Nifty returns that we have had this year. Vineet, good afternoon. Thank you for joining in. Firstly, wishing you a very, very happy 2025. How has 2024 been for you? Would you be impressed taking a 9% return on the Nifty, considering the fact that A, the broader markets have done very well, and B, the fact that we have had 9 consecutive years of positive returns for the index? Do you expect some bit of exhaustion creeping in to the markets at the start of the new year, or do you expect another positive year for 2025 as well?
I think a bit of exhaustion will continue as we go into 2025. We've got some headwinds. We've got US elections, which has just happened. Trump will come in. We don't know the policies, what will happen. We've got budget coming in a few weeks' time. And of course, the corporate earnings, which have been a bit muted last couple of quarters, probably largely due to the lack of government spending, which has kicked in towards September. Also, we have to compare it, from a FII perspective or FPI perspective. We have to look at how the global markets have performed. So if you look at YTD, we've got S&P, which is up about 23%, Nasdaq, which is up about 28%, as compared to Nifty, which is up about 8% odd. So global investors will chase where the money is going. And I think another factor which has contributed to it is the US Treasury yields, which were at about 3.6% sometime back, firming up at 4.5%. So all that has led to money flows more into US. A lot of fund managers are sitting on cash on the sidelines, waiting to see what's going to happen. We remain bullish on India. I think it's been a good correction which has happened in 6 months, where the markets are down about 10% from the peak. You cannot have one-way secular bull run. So from that angle, I think the markets are forming a bottom. They are consolidating, and they should rally post the results, which some of the sectors should do better than the other sectors.
Okay. Hi, Vineet. Good to have you with us on the show.
Hi, Lata.
More broadly, the year that was, or year that is about to end, has been very kind to mid-cap and small-cap stocks. While we may bemoan that there is exhaustion in the Nifty, and from the October highs, or the September 27th highs to be precise, it's off by about 7-8%. The mid-caps and small-caps are still, like 20 to 30% higher in most cases. Do you think exhaustion may come in there? Exhaustion or even disappointment?
Some disappointment can come in there. Again, small caps, mid caps, a lot of sectors which have done well, whether it's infra or whether it's solar, which has been in a bit of frenzy off late, or new age tech. A lot is dependent on the government spending. So some exhaustion might creep in, but there are plenty of gems which are still available in that sector. We are up about 60% for the year as compared to small cap index, which is up about 25-26%. So we've done well, we've had a good year, and we continue to believe in the small cap, mid cap space. I mean, we don't even have a single large cap in our portfolio. we try and follow where the government spending is happening in the sectors which are going to do well. And I think there's a lot of juice still left there. While they've been actually doing better than the market even in last 6 months. If you see, while Nifty or Sensex are down about 10%, mid-cap, small-cap are down 5 to 6%. So they've held up quite well despite the exhaustion.
I agree with you. I didn't have much information on most of your top 10 holdings. And so I tried to go to Trendline. I tried to get information. But wouldn't investors worry that they don't find any public research on the kind of stocks you invest in? Wouldn't that be a spot of bother?
It is a spot of bother, and public generally tend to follow the frenzy, and that's not a good sign. But if you actually do a bit of deep dive, you actually spend time with the companies on the ground. Like I spent almost 10 days traveling all across different cities to India, and now we are building up an India office as well for a deeper penetration. The markets will, there are plenty of opportunities, but you need to actually go and visit them and see them because data points are very sparse. And you essentially are betting on the founder or the promoter or the management team. So investing in small caps is like investing into, onto the people, more on the people than on the business, because it's a people-driven, business. It's not reached a scale where they have a very professional management. They'll hire B-school graduates. It's still very, very basic. So you need to really roll up your sleeves and do that hunting because no analyst will cover these very, very small companies.
Absolutely.
Indeed. But Vineet, you mentioned you do not have any large cap stock in your portfolio, and a majority of your holdings in the Global Opportunities Fund comes within the IT space. So would it be fair to assume that most of these names would be mid-cap IT names, say the likes of Persistent and Coforge, because they have been the ones who have been the outperformers compared to the TCSs and the Infosys. But do you expect this mid-cap IT outperformance to continue into 2025, considering the fact that a lot of these large-cap IT names are facing company-specific issues of their own?
So, we can define IT as a broad sector, but if you look at the subsectors, so we are into none of the services sectors into IT. We are into, data center-based SaaS platforms. We are into data centers. We are into cybersecurity. We are into corporate trainings, which have held up quite well. The larger players, when it comes to IT services, where India has been a service provider, they have taken a hit. And because they depend a lot on the global markets, and global markets have been, from a GDP growth perspective, have been relatively subdued as compared to India.
Okay. But Vineet, where are these stocks listed? The ones, I know I was looking at your top 10 holdings. That's when I realized I'm hardly prepared for this interview. E2E Networks, Last Mile Enterprises, TCC Concept, EFC India Limited, TAC Infosec Limited. Are these BSE listed companies? Where are they listed?
So EFC and TCC are BSE listed in process of migration on listing to NSE as well. E2E is listed on both. Then, of course, TAC Infosec is actually a SME stock. It's India's foremost cybersecurity firm with clients like, NSE, HDFC Bank, and global clients like Google. Very interesting businesses. But of course, and these are all businesses which have been literally bootstrapped, grown with very little capital. In fact, L&T took a 21% stake in E2E post our investment at almost more than twice the price of what we invested in September. Again, the challenge remains data sets are you don't get much data onto these stocks, so you really need to spend time on that. But these are the companies, I always believe that no large cap was born large cap. These are the smaller companies which gradually become cap, mid cap, large cap. You find them, work with them, spend a lot of time with them, and that's where you'll find your multi-bag. Typically, you get 7.
I'll tell you where lay investors' worry would come from, including mine. We have seen the SEBI pulling up a lot of companies which are trying to list on the BSE SME exchange at absolutely fantastic, subscription levels, sometimes running into 5-figure subscription levels. Is there not a danger of someone taking you for a ride in this space?
There is, and there have been some issues which kind of within no data sets, and the companies are very small, and there's been a lot of hype going on in the sector. So one has to be very, very cautious when it comes to SME investing. SEBI should actually, and they've on the right track in terms of increasing the disclosures which merchant bankers have to do while doing the IPO. I think that is more critical. And you'll find a lot of these gems in that sector actually. So, E2E, which almost has $1 billion market cap today, did IPO at an enterprise value of 60 crores about 6 years back. Similarly, one of our picks, Insolation Energy, did an IPO at a valuation of 100 crores. The market cap is close to 9,000 crores today, with a PAT now, currently a PAT targeted at about 150 crores. So imagine a company doing an IPO 2 years back at 100 crore valuation, and today you're sitting on 150 crore PAT. But again, you're betting on the promoter, so a lot of hard work needs to be done. You just can't follow the frenzy.
Okay, well, Vinny, let me, I'm being warned we're out of time. So just leave us with one quick advice for 2025 and one quick prediction for 2025. Names of sector, stock, anything.
So IT services, broader, I think we're bullish on data center sector because India consumes a lot of data, and we hardly have, we're bullish on real estate and infra and renewable energy. So these are the 3-4 sectors we continue to remain bullish on, which comes on back of government spending essentially.
Okay. We'll take an interest and continue to look at the stocks that figure in your top 10. Thank you very much, Vinny Arora, for joining us, and have a great 2025.
Thank you. Happy New Year in advance. Have a blessed year.
Indeed, that was Vinty Arora there of Enough Capital, and time for a short break. More on the markets and specific stocks on the other side. Stay tuned.
Growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25 as well, which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being tapered down by regulators and lenders following the same, many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while NBFCs may see improvement or stability in their net interest margin because their cost of borrowing from the banks will incrementally reduce, which is one of their key borrowing segment right now. Now management terms are expected to
Welcome back, and the bigger takeaway is that today is the last trading day of the year. It's the last day of the year as well. So it's time to look back at how the year has been. And one of the biggest constituents of the Nifty, which is the financials, the Nifty Bank that has underperformed the Nifty over the last 2 years now. Abhishek is joining us to tell us how these banking names have fared in 2024. Abhishek.
Well, as you mentioned, Homas, over the last 2 years in a row, Bank Nifty has actually underperformed Nifty with respect to returns being given to shareholders. So, Bank Nifty had massively outperformed Nifty in CY of 2022. So, over the last 6 years, if you take a look, Bank Nifty has underperformed Nifty. Nifty giving a return of almost 2.2 times, but Bank Nifty up only 88%. So, in last 5 years, Bank Nifty has underperformed Nifty 4 times. If you take a look at that data on screen for reference, and in CY24, both of them, that is Nifty and Bank Nifty, have given single digit together for the first time in a calendar year. So RBL Bank, Bandhan Bank, DCB Bank, IndusInd Bank, Yes Bank and Bank of India, all of them have given negative returns over the last 6 years as well as YOY or in last 1 year as well. YOY, if you take a look, the highest decline is seen for unsecured lenders or lenders with exposure to unsecured segments like microfinance, credit cards, personal loan, etc. So RBL Bank has given the highest negative return, followed by IndusInd Bank, Bandhan Bank and IDFC First Bank, all of them giving a negative return of 30% to as high as 44%. Best gainers on a year-on-year basis has been Karur Vysya Bank. Now this is a mid-cap, small size bank, and perhaps they have one of the lowest or best in class asset quality with respect to gross NPA ratio being lower than that of HDFC Bank as well. ICICI Bank followed by Federal Bank, Indian Bank and SBI, all of them have given return to investors more than 23% on a year-on-year basis. Back to you.
Wow, who would have thought out of HDFC Bank, ICICI, Kotak Bank, it will be Karur Vysya Bank who would emerge as the best performing banking stock in 2020.
For a very long time in the mid-year, it was UCO Bank and Central Bank which were the biggest performers. So, I mean, they had Bank of Maharashtra. I mean, it was a super performer for many months in a row because they had excellent capital and most of the bad loans had been written off. But from the loan givers to the loan receivers, okay, India's automobile industry has more than tripled in size in the last decade. But now we are going to look at the automobile industry with a difference. This industry is aiming to get on par with global peers by shifting towards cleaner fuels. It's obviously necessary now to maintain sustainability. Our colleague Sudarshan Kumar has more on the industry's bid in 2024 to move away from fossil fuels. Sudarshan.
In 1983, India's automobile revolution was ignited with the launch of Maruti 800. Affordable, reliable and aspirational. It became the people's car, and since then, India's automobile industry grew exponentially. Today, India is the third largest automobile market globally. In last 10 years, the industry has tripled in value, from rupees 7 lakh crore in 2014 to rupees 22 lakh crore in 2024. But even with this growth, we are only half the size of China and a quarter of the US market. The goal to surpass both within the next decade.
Now in world, USA is number one. They have the size of auto industry of 78 lakh crores. China is 47 lakh crores and India is 22 lakh crore. Now we have a target that within 10 years, we will be number one in the world because of alternative fuel and biofuel.
And how will we do it? The answer lies in a new kind of fuels. The shift will be driven by three key factors. First, emission targets. India aims to cut carbon emissions intensity by 45% by 2030. Second, reducing fuel imports. Did you know that India imports 90% of its crude oil, spending $71 billion annually? Third is cost savings. Clean fuel vehicles are cheaper to operate. For instance, running a CNG vehicle costs just rupees 1 per kilometer compared to rupees 2.25 for petrol. So what are those alternative fuels that will drive the future? First up, electric vehicles or EVs. India's EV market is set to grow from $23 billion in 2024 to $118 billion by 2032. The government's target? 80 million electric vehicles on Indian roads by 2030. But EVs aren't the only players in the game. Hybrids are bridging the gap. These vehicles combine electric power for short trips and fuel for longer journeys. They are cost-efficient, eco-friendly, and ideal for a gradual transition to clean energy. Next up is ethanol. India is aggressively pushing for ethanol blended petrol, targeting 20% blending by 2025. Brazil serves as a global example, using ethanol to replace up to 20% of its petrol imports, with 80% of its cars running on ethanol blended fuel. Brazil has significantly cut its oil dependence. India could follow a similar path. We also have CNG and LNG. They are cleaner and more affordable alternatives to petrol and diesel, and their adoption is growing rapidly. Sales of CNG passenger vehicles surged by more than 30% year-on-year in the first half of FY25, and the market is expected to grow at a CAGR of almost 7% in next 6 years. Last is hydrogen, the fuel of the future. Clean, versatile, and sustainable. It's a game changer for heavy vehicles like trucks and buses.
Hydrogen is the future. And the green hydrogen is the future. Because by electrolyzer process making hydrogen, for 1 kg of hydrogen we need 150 units of power. Now the municipal waste are by using biotechnology generating biomass, using for getting it methane in biodigester, and from that methane we can convert into hydrogen or we can convert into CNG.
2025 is not just another year. It's the year when clean fuels take the driver's seat in India's automobile story. Over 40 new car models are expected to hit the Indian roads in 2025. And guess what? Only 20% of them will run on petrol or diesel, and that too with most of them having the hybrid option. The future of mobility is here, and it's cleaner than ever. Electric vehicles, or EVs, are set to dominate 2025. From Maruti to Tata, Mahindra to Mercedes, every major automaker is going all in on EVs. The goal? To accelerate towards 30% EV adoption by 2030. And that is up from just 6% today. But EVs aren't driving the change alone. Ethanol-powered vehicles are making headlines. As per Roads Minister Nitin Gadkari, big names like Tata, Mahindra and Hyundai are set to launch 100% ethanol-powered cars within the next 6 months. Meanwhile, CNG is steadily solidifying its place as a preferred fuel option in India's green mobility shift. In 2025, Honda is set to join Maruti, Tata and Hyundai in offering CNG-powered models. Tata will introduce the Curvv in a CNG variant, while Maruti plans to launch next-generation CNG versions of its popular Ertiga and Brezza. Adding to the momentum, Honda is expected to unveil a CNG variant of its Amaze sedan. The future of India's roads is not just about speed, it's about sustainability. It's the year clean fuels go mainstream.
So, that's an excellent package that you have put together. I would just add one thing. Can we also think of mass rapid transport? EVs, all well, much better than fossil fuel, but a personal vehicle in a city like Mumbai is something that we should try to wish away and replace with public transport. I think that's also a faster way to get to a cleaner environment and unclogged roads. But just before Sudarshan took off on clean fuel, we were discussing with Vineet Arora on small index. Now, actually, the SME, the small cap IPO index, has remained in focus throughout 2024, generating massive subscription numbers, often running into 10,000 times. Returns as well for investors were huge, rising over 2.5 times in 2024. Now, Hormuz has moved from my neighboring chair to the video wall to explain the fireworks that we saw in the SME IPO space. Hormuz.
You know, SME IPOs continued to make headlines this year as well, mostly for the eye-watering subscription figures that they generated, but also for some wrong reasons as well. Now, after nearly doubling last year, the BSE SME IPO index has jumped nearly 2.5%. This time around, gains of nearly 140%. Now, since 2021, the number of SME IPOs every year has continued to increase. Now, this time around, we had a total of nearly 250 companies going public, which are SMEs. And if that number is not enough, they raised a cool 8,700 crore rupees as well. Now, what is so special about this 8,700 crore? Now, that figure is the sum of the funds raised during the previous 5 years put together. Now, if that is not enough, the next figure is even more eye-watering. Now, these 240 SME companies that went public this year received bids worth over 12.5 lakh crore rupees. That in the quest to raise close to 9,000 crores. The SME IPOs were back in the news recently because of this company called NAC Infra, which became the most subscribed SME IPO of the year, got bids of close to 14,500 crore rupees and ended its trading debut almost double of its issue price. But is NAC Infra the IPO that got the highest bids this year? Not really, because Ganesh Infra World takes that title, getting bids worth nearly 23,000 crore rupees. It planned to raise 100 crores through its IPO. Others in that list also got bids anywhere between 17,000 crore to 20,000 crore rupees. Now, cumulatively, out of the 43 SME IPOs, or nearly 20% of the total SME issues this year got bids worth over 10,000 crore rupees or more. If NAC Infra was the most subscribed IPO this year, which were the other ones? Now, HOAC Foods, HAMPS Bio, KC Energy and Infra, and Toss the Coin is all seeing subscriptions of over 1,000 times. And of course, one must know that these SME IPOs have a smaller size. The number do appear elevated after that. But that also does not mean that there is no demand. All 5 of them saw listing day gains of anywhere between 90% to as high as 370%. So which is the issue that has generated maximum returns this year? It's a company called Oves Metal, which is up over 1,000% from its issue price of 87 bucks. The rest two are up anywhere between 700% to 1,000%. A note of caution here, most of these names are under the extra surveillance measures or ESM framework under various stages. Now, if these are wealth creators, there are wealth destroyers also. MVK Agro, Baveja Studios and others have either halved or are down nearly 70% from their issue price. With thinly traded stocks, little or no institutional interest and no widespread ownership, the scope for manipulation among SME IPOs is a lot higher. Therefore, market regulator SEBI has already come out with tighter listing norms for these companies, and they are potentially stricter rules that are also in the offing. Therefore, it will be interesting to see if these numbers are affected in any form post these stricter SEBI rules, or will this chota packet continue to give bada dhamaka returns in 2025 as well?
Okay, that's very well put, Hormaz. Both the fireworks as well as the caution that we should always keep on the table, and that the regulator has been reminding us of. Let's take a break. When Hormaz was giving us all those fantastic statistics, we saw the Nifty recover a goodish bit, and it's now pretty much close to where we ended the day yesterday, 26,600 plus. So let's wait and see. We're going to get a technical analyst, Sudeep Shah, the head of technicals and derivatives at SBI Securities, joining in with some midday and midweek trading strategies.
For these banks like IndusInd Bank, Indian Bank, you have Bank of Maharashtra as well. Also for Central Bank of India as well as Punjab and Sindh Bank. Over the last few years or 6 years or so, the gross NPA ratio difference between the PSU banks and private banks have narrowed from as high as 967 basis points to about 127 basis points at the end of calendar year 2024 so far. Similarly, the net NPA ratio difference has narrowed from 451 basis points that you saw in 2018 to right now about just 11 basis points in 2024 so far. Historically, this is one of the lowest net NPA ratio difference seen between PSU banks as well as private banks. So from CY 2018 to CY 2024, PSU banks gross NPA ratio has declined from 14.2% to about 3.15%, and net NPA ratio has declined from 6.25% to 0.62%. Private banks, their gross NPA ratio has declined from 4.5% to about 1.9%, and the net NPA ratio has declined from 1.74% to about 0.5%. Will RBI change its stance on lenders? Now, RBI has banned many products or entities in 2024. So, RBI did ban, Kotak Mahindra Bank's onboarding of customers via the digital and mobile customer application, as well as they have placed limits on the credit card business due to deficiencies seen in Kotak's IT infrastructure. Now, RBI had raised material supervisory concern on Asirvad MFI, which is a subsidiary of Manappuram Finance. RBI intends to implement the expected credit loss guidelines from 1st of April 2025 to ensure that there is bank's financial stability, protect depositors' interest, assess the overall risk exposure and accuracy, reflecting the true value of bank's loans portfolio. Now, Project Financial, there may be additional provisions over there as RBI has stated in their draft regulations. So, this will be implemented in a phased manner, 2% by 31st March 2025, 3.5% by 31st March 2026 and to 5% by 31st March 2027. RBI...
Welcome back. Almost into the green now is the index, and just a couple of hours ago we were in conversation with Shilpa Raut and she had mentioned that he's expecting some more short covering to continue towards the later part of the day. And that's exactly what's transpiring on screen as well. But is that likely to continue going forward as well? Sudeep Shah of SBI Securities is joining in on the show. Sudeep, good afternoon. Thank you for joining in, and firstly wishing you and your team a very happy new year. Is this bounce likely to sustain, and what happens now that the Nifty runs into this 23,800 to 24,000 wall? It's not been able to sustain all through the last 8 to 10 sessions now within that range. Do you expect first to get to that level, and once it gets to that, what happens after it? And also couple that up with your stock recommendations for the afternoon.
Good afternoon, Homas and Lata. And wishing you and the entire team at CNBC-TV18 a fantastic coming new year, as well as all our listeners. See, Hormas, you put it up in the perfect way that, first of all, are we expecting any bounce back? The zone of 24,000, which was not able to cross in the last 6-7 sessions. And finally, yesterday, we saw that breakdown below the 200-day exponential moving average, which is placed somewhere closer to 23,700. The gap down opening today, followed by this recovery throughout the last couple of hours, at least is encouraging. But what is important in the last few sessions, what has happened is that throughout the day, there has been recoveries, but the last hour has always seen a sell-off. So for me, the first level which is important would be 23,700. Whether this level is being crossed and sustained, then yes, there could be some hopes of a recovery back till 23,900, 24,000 levels. So 23,700 zone on the upside would be the first resistance. Once indices crosses and sustains above this, then 23,900, 24,000 zone could be on the cards. On the downside, today's low of 23,450, 23,500 mark would mark as an important support zone because it is derived from an upward sloping trend line zone. So here, this is important support from where it has bounced back. So 23,450 to 23,700, 23,750 is the range that we are expecting the Nifty to trade into. And now what is happening is that even if we see the IT index from the lower levels of 42,500, 42,600, IT index has shown a good recovery. So we feel that the IT stocks, the pharma stocks, they could support the markets going forward in the next couple of sessions in the Nifty's bid to recovery. Now, the two stocks that are on our radar are, the first one is from the pharma space, which is Ipca Labs. Now, here, there has been a consolidation breakout on the upside. The stock is already trending upside on the weekly as well as the monthly charts. Even on the daily charts, there is an extremely good setup that is visible here. So this could be bought with a stop loss at 1650 on the downside and a target of 1750 on the upside. The second stock that is on our radar is Jubilant Foods. Here also the stock has broken its previous swing highs, which were in September, which is closer to 710. And now the entire setup on the weekly, monthly charts is quite promising, and the stock looks good for 750, 755 levels. So this could be bought with a 705 stop loss on the downside.
Okay, thank you very much for all those levels, Sudeep. And you have a brilliant 2025 yourself. Let your head down, 31st evening. Okay, now before we go into a break, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store.
New draft norms with states to increase the bank's liquidity coverage ratio by an additional 5%. Now, the runoff factor for retail depositors is a key cost, and this will also see that who are enabled with internet and mobile banking, that will see additional incremental over there. So it may come into effect from 1st of April 2025 and may lead to short-term slowdown in credit and impact the net interest margin of the lenders on the negative side.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the CAPEX story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's CAPEX is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore CAPEX target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government CAPEX side, rising welfare spending is becoming a challenge. With the enforcement of the 3% fiscal deficit limit likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. CAPEX has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state CAPEX is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.
Welcome back. It may be the last trading day of the year, but it's not a day when we don't have big news. Some of the stocks in focus today is what we are going to tell you today. Lupin is one of them. The company has acquired anti-diabetic medicine hum insulin in India from Eli Lilly. Vinny is here with the details. Tell us.
Good afternoon. Yes, so this is a good addition that's actually coming into Lupin's diabetic portfolio. Now, this is Humicillin is what they've acquired in India from Eli Lilly, and this is treating type 1, type 2 diabetes to improve the blood sugar control. Now, do not forget that Lupin in Q2 FY25, the diabetes portfolio of Lupin, that grew by 19%, outperforming the industry growth, the IMP growth of 9%. So this addition also furthermore adds to their portfolio in terms of the segment, and Lupin wants to focus on the diabetes segment. They've mentioned this also previously in terms of their focus areas. Other than that, they'll focus on cardiology as well as respiratory, but this is a key focus area, and that is why a good move coming in from Lupin. Now, other than that, there's one more news flow that's come in, that in the US, we had Teva, who had actually filed a petition against Amneal, and now there's an order that has come in that this petition is en banca rehearing the litigation that they had filed on Amneal. This was for a drug that was generic Pro Air, which they're talking about. So that this drug is actually sold by Lupin as well. So this becomes a positive because these are two big players who are still under litigation. So till then, there will not be any much pressure for the sales of this drug for Lupin, and there's a delay in terms of launch that could be expected for Teva as well as Amneal for the generic ProAir drug, and that is why that is a positive for Lupin.
Will hum insulin result in more gains than 80% that has already gained for Lupin this year? Dekhenge hum log. But then Vivek is joining in now for some news on Ashoka Buildcon that came in earlier this morning. Vivek.
Well, that's right. So Ashoka Buildcon, an interesting development there. A positive divestment of assets that the company has done. Positive because the valuation is quite attractive as far as Ashoka Buildcon is concerned. Now, the company and the subsidiaries have managed to sell almost 11 SPVs which held HAM projects. SPVs are special purpose vehicles, and HAM projects are hybrid annuity model projects that the company had incorporated. Now, these particular projects have been sold to funds that are managed by Edelweiss AAA, earlier known as Edelweiss Alternative Asset Management. The stake sale has been done at a value of close to 2,324 crore. Now, analysts tell us that the implied valuation means that Ashoka Buildcon has managed to go ahead and double the equity investment that they had made in these particular assets. Now, as far as this particular deal is concerned, a few approvals are pending. Number one, the lenders to the SPVs have to give their nod. NHAI, the National Highways Authority, as well as CCI, all of them have to give their nod before this particular deal can go through. Remember, all of the assets, barring one, have achieved commercial operation date. So most of the assets are actually operational. Now, the deal was announced just prior to market open. Interesting development and a slight positive as far as Ashoka Buildcon is concerned.
Okay, thanks a lot for that, Vivek. We have to take a very quick break, but we're going to get you more such stock-specific gems after this break.
Crore in the first half of FY25 to just 28,300 crore by the end of November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp up in large, lumpy capex projects. Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, the groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
Quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries. And with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet the street remains bullish and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1,350 to as high as 1,950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010 the stock has delivered negative annual returns only thrice, and two of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2,080 rupees to as high as 3,750, but the stock is veering more towards the former right now. On the flip side, Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2,700 to 3,700.
Welcome back. Before going to the break, I promised you more stock-specific action of individual companies. Hormuz has two more on his plate. Varun Beverages first.
Varun Beverages indeed, and it's a very interesting name because it's continuing with that trend that it has been holding on to since it listed back in 2016 of positive annual returns every single year since it listed, and it's up 30% this year as well. Now this morning, Antique came out with a note on Varun Beverages. It was a buy recommendation, a 710 rupee price target, which is around a 10 to 12% upside from current levels. They speak about two very key aspects that the company has engineered in the recent past. One of them is the QIP that they recently closed. They raised 7,500 crores from that, and then they said that most of that money will be used to retire debt, and once that happens, Varun Beverages will become a net cash company. So that is a positive. The other bit is the acquisitions that they have made in the African geography. Now what they say is that after these acquisitions, their share of international volumes will go up to almost 36.5% by 2026 from 19.5% in 2023. So that, and as a result of which, they are expecting their overall volumes, revenue and EBITDA to grow at a CAGR of 21, 24 and 28% over a 3-year period. And so they are revising their 2024 EPS estimates marginally lower by 3%, but they have increased their 2025 and 26 estimates by 10% and 3%. So positive commentary on Varun Beverages. The stock not doing well in today's session, but has had a very good year so far.
It always stunned me that someone who's bottling Pepsi, but doing it steadily, correctly, is such a wealth gainer, such a wealth creator. And then why JSPL?
JSPL also because Nuvama met the management of the company and they spoke on a lot of issues. They spoke about the fact that they are in the process of resolving these pellet bottlenecks that the company is facing currently, and once these bottlenecks are resolved, they will be able to ramp up their steel volumes by almost 8.5 million tons by the next financial year, which is FY26. Now they also spoke about the steel capacity, which is almost 3.5 million tons of steel capacity that is likely to be commissioned by the end of this financial year. And they also spoke of coal blocks, where they said that they are in the last leg of approval. Mining will begin in the first quarter of the next financial year, which is FY26. Now, for the fourth quarter this year, Nuvama is saying that that looks promising because of the fact that the steel prices are higher, volumes are also robust, but they are reducing their FY25 and 26 EBITDA estimates by 6% and 4% to account for potentially lower volumes for JSPL. Regardless of that, they still have a buy recommendation, 1292 rupee price target, a significant upside from where the stock currently is.
Okay, so one smokestack stock and one consumer consumption stock, so to speak. Thank you very much for that. We'll take a quick break and thereafter, all-important discussion on commodities. Manisha Gupta will be joining with Kunal Shah, who heads commodities and currency research at Nirmal Bang.
Now, HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet, no analyst on the street has a sell rating on HDFC Bank with price targets ranging up to as high as 25.50. Now, FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street, though, is optimistic, analysts giving targets of up to 3,400 rupees on the stock. Staying with consumption, Titan is set for its first negative calendar year after 2016, and since 2016 the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002, and the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and is the 5th time in the last 7 years that the stock has had negative returns. Yet, 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024, with 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as Ultratech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows.
Welcome back, and joining us on the show now is Kunal Shah. He's head of commodities and currencies at Nirmal Bang. Kunal, hi, thank you for joining us. And well, last day of the year, and we still are looking at some movement coming in for many of these commodities, especially the precious metal prices, where the prices have continued to decline. Gold is sliding. Silver is now below $29 an ounce, far, far away from the kind of all-time highs that we saw in this year for both of these commodities. Let's start with gold first. And what is your sense as we step into 2025? Would you want to divide the year into two? How should one trade this one?
We remain very optimistic about the overall outlook for gold for the year 2025. And we believe that the rising debt across the globe, mainly in US, that is going to be the main theme. We don't know what's going to happen during the year 2025. So far, it has been a good year. There is no delinquencies. There is no defaults in US. Things are looking good. But we don't know, with such kind of debt and with the rising bond yields, the inflationary expectations are also moving up. So it seems that right now there may not be a very bullish trigger in a shorter term. But as we move towards 2025, we feel that the odds for gold to move up are very high rather than go down. And there is going to be a lot of volatility. There is going to be a lot of uncertainty. But the overall outlook of gold, I think, is still very bullish. And we continue to maintain our targets of $2,900 and $3,000 of COMEX. And in India, 85,000, 86,000, very likely. May take time, but I'm very confident that the outlook is very bullish.
Kunal, also, how would you look at the dollar index then? Because we've seen very strong gains onto this one, 6% up in this year. Are you looking at further gains as we step into the new year?
I think it's very tricky because if you look at US 10-year bond yields, which are right now at 4.6%. So if I am a money manager, I'll park my money in the US 10-year benchmark if I'm getting 4.6% interest rate. So that's the reason why there has been a major inflows in the US. A lot of people are, again, taking their money back to US. So it's more to do with the structural shift which is taking place before Trump is joining. But if you ask a currency which is having a $36 trillion of debt, that debt is soaring by $2 trillion every year. That has been a trend from last 5 years, and that is likely to be the trend going forward. So that kind of currency may weaken sharply going forward, not now immediately, but may take some time. After the Trump comes and he comes up with his own policies, I believe 110, 111 should be the peak out level for dollar index. And the fundamental of the dollar index indicates that there is likely to be more weakness going forward rather than a major strength. So remember, US is also on the verge of, they are saying that the number of interest rate cut in the year 2025 will be 2 as compared to 4 earlier. But we don't know. Things can change quite rapidly. And we've seen that central bank saying that there will be only 2 rate cuts. And last time, before the COVID, they came up with 150 basis point of rate cut. So you never know what is going to come. But I believe that the upside is very limited from here. 110, 111 maximum upside.
All right. Oh, well, absolutely. Much would depend also on what Trump does and how do other countries retaliate in sense of taxes and tariffs. I mean, that is something to watch out for. But silver then, and the kind of decline that we've seen onto this one has been quite sharp. Multi-week, multi-month lows rather coming in for silver now. $28 and around is where it's trading. There are speculative short positions being created onto this one. How would you want to trade here?
See, the fundamental of silver is still bullish. There is no second thought. So with the rising dollar index and stronger dollar, we are seeing the temporary correction in the prices of silver. If you see, the silver market continues to remain in a deficit. The production from secondary mine may move up in the year 2025. We are expecting zinc mines to come up with more production going forward. So more and more zinc is going to come in the market, and that will lead to a higher supplies of silver also. But it's still a strong clean energy story. The photovoltaic demand will continue to move up even in the year 2025. And the supply side is still not very strong as of now. So I will still continue with the bullish outlook on gold and silver. It is likely to get benefit from gold also. When gold starts moving up, even silver is likely to get a lot of traction. Right now, China PMI and the Chinese economy seems to be again slowing down. They are waiting for the announcement by US Trump that what they are going to come up with as far as the policies are concerned and tariffs are concerned. So right now it is muted. I don't see a significant downside. Another dollar or so. It's accumulating. It's a level where one should start accumulating silver.
Point taken that. So gold and silver should be your friends when you step into 2025. The dollar index, the run-up that we've seen in 2024 perhaps may not continue in 25. We've done pretty much a lot of that rally already. So that, of course, are cues as we step into the new year. Kunal, thank you so much for joining us and a very happy new year to you. But with that, that's all the time that we have on the show. Business Lunch will take all the action forward.
Well, has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labour unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out, and now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they admit on a year-on-year basis, it will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcomp, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to this.
Market comes off morning lows in a thin year-end trade. IT, realty are the weak spots, while metals and healthcare exhibit strength. Reserve Bank of India in its financial stability report has flagged the rise in write-offs, especially by private banks, saying that these could be masking worsening asset quality in the retail credit segment. Ease My Trip co-promoter Nishant Pitti is likely to exit the company via sales of his 14.2% stake. Nishant had earlier divested a near 14% in September for over 900 crore rupees. The move raises eyebrows with questions around the motivation for the move. EV player Ather Energy's 4,000 crore rupees IPO has got SEBI's green light. The fresh issue of shares to raise 3,000 crore rupees will help it expand capacity by 3.5 times. Two-wheeler maker Hero MotoCorp will remain its biggest shareholder. Brent crude rose above $74 per barrel after U.S. inventories declined and China's manufacturing activity saw a positive expansion in December. With this recovery, oil is set to close 2024 with modest losses near 0.5%. Hello, good afternoon. You've tuned into Business Lunch on CNBC-TV18 and I'm Vinny Motiwala in the Mumbai News Studio. Let's look at what the market is doing today. Surely recovered from the day's lowest point. So surely good afternoon that is shaping up for the markets as of now. When you're looking at it in terms of the Nifty, that's down 0.2% in trade. 23,584 is what we're watching out for. In terms of contributors, we're seeing Kotak, that's the top contributor, SBI, ONGC as well as ITC among the top contributors, while what's not doing well is ICICI Bank, TCS, Infosys and TechM. So IT pack, let's pull that up. The Nifty IT, that's clearly under pressure today because we've seen the top laggards in the Nifty 50 also coming in from the Nifty IT side. Nifty IT as of now is down almost 2% in trade. Okay, let's look at Nifty Bank now. While we saw SBI actually making on the positive side and a positive contributor for the Nifty 50, the private banks recovered from the day's low, but seems like Nifty Bank overall is a bit under pressure as well. Other than that, what we should watch out for is also in terms of the Nifty Pharma specifically today. Nifty Pharma is among the top sectoral gainers today. We've seen a sharp up move coming in for the Nifty Pharma. Aurobindo, Lupin, Laurus are among the top movers coming in for the Nifty Pharma today. Lupin, obviously, there's news flow, but other than that, the Pharma pack as a whole is buzzing in trade today. And IT, specific names I'm just going to highlight. Persistent Emphasis and TechM clearly under pressure today as well, among the top losers for the Nifty IT and top drags coming in for the Nifty IT. But yes, that's how the market is looking like as of now. On that note, let's get started with the show and talk about RBI's stability report that has come in. This is the financial stability report that they released last evening. Now, this is showing a rise in bad loans and they've warned about a sharp increase in write-offs at private banks. Ritu is bringing us more details of what is coming in on this stress test that is taken by the from the central bank.
I'll start with some of the key risk areas that RBI has flagged off in the financial stability report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
Thanks for that, Ritu. Now let's move on. And the aero component manufacturer Unimech Aerospace listed today on the D Street with an 85% premium to its issue price of 785 rupees. Earlier today, we spoke to Anil Kumar P, who is the chairman and managing director of the company, and he spoke about the company's revenue growth target and how they plan to expand. Listen in.
From a revenue point of view, we, as you see on our DRHP, we've booked about 120 crore in the first half of the year. And usually second half of the year is always better in the nature of business that we are in. So while I would say you would have a decent growth compared to the last year, and especially with the capacity that we have installed recently, and the utilization is picking up, and for investors definitely it's going to be a gain, I would say, from a, the revenue, the business performance point of view. We are already in the process of growing our business in the domestic world, especially the Indian defense is is picking up. There's a massive opportunity that we have yet to grab, and also the nuclear sector with the the nuclear power capacity demand increasing from at least 3 times from where we are now. So we want to kind of capitalize the opportunities in the nuclear and defense segment, and also to an extent space segment. So we are definitely looking at expanding to Indian market.
Okay, on that note, we're going to step into a very short break, and we'll return and we'll take a look at how cryptocurrencies are fared in the year 2024. So stay tuned in for that.
And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing is more down the value chain coming in. More components down the value chain. The entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's auto trade. We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanath.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2024.
Welcome back to Business Lunch on CNBC-TV18, and yes, tomorrow is the first of the month and we will have the auto sales numbers that will be coming out for the month of December. What are we expecting this time from these December sales numbers? Let's look at that. Most segments likely are expected to see a growth coming in the wholesale side. Overall, two-wheelers are likely to post a wholesale growth of around 5% versus a 14% decline in terms of registration. PVs are likely to see a wholesale growth of 4%, and Vahan registration is expected to be up by 3%. Now, specifically, let's break down in terms of the sectors as well as, the segments. So, PV, two-wheelers as well as commercial vehicles and tractors. Now, in passenger vehicles, demand trends are expected to be a bit subdued this time. High discounts are persisting. That is clearly of the year. To clear off the year-end inventory. So that is something that we are watching out for. Because of these high discounts that are there, they have inventory, they want to pass that off. So that is an important one. Now, Nomura is maintaining an estimate of around 1% volume growth in the PV industry for FY25. And when you're looking at it in terms of numbers also coming in, we are expecting a decent move coming in on the passenger vehicle space. Specifically, look at it for Maruti Suzuki, we are expecting 1.63 lakhs is what the units are expected versus last December was 1.38 lakhs. Similarly for other passenger vehicle players as well. Now in terms of two-wheelers, registration is down 14% YOY due to last year's high base that they saw coming in because of the festive season side. Nomura is expecting a 12% growth in two-wheeler side for the industry for FY25 with some bit of a downside risk. Keep an eye out on that. Commercial vehicles expect to see a gradual improvement this time, especially coming in terms of the government spending front. So that will be interesting to watch out for. But in terms of demand for tractors, that's expected to be a bit muted. So keep an eye out on that. Expected to do well, I beg your pardon. Good rainfall. Crop prices are something that is improving the rural sentiment. So maybe an improvement is something that we could watch out for in terms of the tractor players. M&M tractor sales are expected to be somewhere, see an increase of around 16% this time around as well. So yes, surely an interesting way to keep an eye out on in terms of the auto sales numbers for the month of December. And we'll start seeing them pouring in tomorrow. But let's move on now and focus on Bitcoin, with Bitcoin crossing the record highs of $100,000. President-elect Trump is taking a pro-crypto stance, and more countries are accepting cryptocurrencies as legal tenders. 2024 has been a breakthrough year for cryptocurrencies. Manisha is bringing us more on how the world of cryptocurrencies evolved in 2024 and what to expect in 2025.
2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at $108,000, surging 130%. The crypto market cap also hit a record highs of $3.9 trillion. The year 2024 started on a very high note with launch of Bitcoin ETFs, which gave an easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion of inflows. Ethereum did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Well, the institutional investors now own 20% of all Bitcoin ETFs traded in US, and then it was Bitcoin halving, an event that happens every 4 years. It leads to reduction in the block rewards by 50%, lowering the supply of Bitcoins. And then it also was about rally taking wings after the US President-elect Donald Trump's pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested that the US Bitcoin reserve could be a possibility, and there was also a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who's a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have totally cheered, expecting favorable regulations going forward. Well, then you had the Russian President Vladimir Putin also recently saying that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. And then after El Salvador, countries like Tonga, Paraguay, and Panama are now considering adopting Bitcoin as a legal tender. Well, the cryptos also are taking support from wider adoption of real-world assets. Stablecoins are emerging as payment tools for enterprise businesses. The year 2024 also had its share of frauds, hags, and rug pulls. The sector lost nearly $2.3 billion in 2024 in frauds, which clearly is lower than the last year, but nonetheless a big amount. The names that went through these issues were Wazirex, Radiant Capital, DMM Bitcoin, among many others. While the Bitcoin grabbed all the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano have all hit all-time highs in this year, while lesser-known altcoins like Palm AI, Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor. Market capital hit $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and also blockchain as a technology. The markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein expecting $200,000 for Bitcoin. MicroStrategy expects Bitcoin to rise 29% per annum for the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
Thanks for that, Manisha. But on that note, we're going to slip into a very short break. And as we slip into the break, CNBC-TV18 asks some key questions. How will the Nifty perform in 2025? What are the sectors and themes to bet on? Will the faltering GDP growth revive in 2025? Will the RBI start cutting rates in 2025? We will ask all these questions to our experts. So stay tuned in for the most comprehensive market poll tomorrow, only on CNBC-TV18.
Take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over leveraging of customers to credit cost to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, X of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023, and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti, and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equita Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, the underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards, but will pose challenges to near-term outperformance or the performance of the sector. Borrower rejection rates are projected to increase significantly as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6%.
Welcome back to Business Lunch on CNBC-TV18. A quick look at what the market is doing as of now. The Nifty small cap, that seems to have moved on the green side. So let's pull up the Nifty small cap where that is headed. Though Nifty obviously has recovered, small cap also has recovered from the day's lowest point, trading in the green. Almost 0.2% of gain is what we're seeing coming in for the small cap. Nifty mid cap also is trading now just with cuts of almost 0.3% in trade. So surely we're keeping an eye out on these names. But individual names that we should be talking about is one, RITES. That's doing quite well, holding on to gains of almost 10-11% in trade today. We have Chennai Petrochem, that is also up almost 6-7%. So let's see that. And other than that, in this mid and small cap side, we have something like a MRPL, Reddington, as well as Latent View, which are managing to hold on to gains. Now, other than that, in terms of losers, Adani Wilmar today is under pressure. Yes, last afternoon we had seen that news flow coming in about an Adani Enterprises moving out of Adani Wilmar, exiting completely out of Adani Wilmar, the 44% stake. So yes, because of that, we're seeing Adani Wilmar under pressure today. Adani Enterprises also under pressure as well. So that's how we're seeing some individual names move in trade today. But let's move on and let's get you some geopolitical updates that are coming in. Now, the U.S. Treasury Department has said that a China state-sponsored actor infiltrated the department workstation in what is being described as a major incident. The hackers gained access to employee workstations and some unclassified documents in the hack. In a letter to the lawmakers, the department said that China-based actor was able to override security via a key used by a third-party service provider. Investigation into the hack are currently underway. Moving on and to some updates coming in from the scientific world, ISRO successfully launched 2 spacecrafts, the Chaser and Target, into the Earth's orbit as a part of SpaceX mission set to demonstrate in-space docking. Now, the PSLV-60 took off from Sriharikota at 10 p.m. last night after completing a 25-hour countdown. The docking process is expected to take place around 7th of Jan. Okay, on that note, let's go across to Hormaz, who's standing by to tell us about Ease My Trip. Why is that under pressure? Especially, we've seen the selling coming in by Nishant Pitti. What more is on that front? Hormaz is here. Good afternoon.
There's always a way Easy Trip finds its way to be in the headlines. Now, be it the Maldives controversy or its foray into different businesses beyond its core, there is a lot to talk about it. Now, let's take a look at the company and what is the latest that has brought the spotlight back on this travel aggregator. Now, news came in on Monday evening that its co-founder, Nishant Pitti, one of the promoters, is planning to sell and exit the company by selling his remaining 14% stake via block deals. Now, however, only 1.2% of that stake has been sold so far. Now, based on the data last check, now at the time of its IPO, the shareholding in Ease My Trip was divided among Nishant, Prashant and Rikant Pitti. Now, Nishant and Rikant had majority of the shares, while Prashant had a negligible stake in Ease My Trip. Now, post its IPO in March of 2021, Nishant and Rikant Pitti, the shareholding was down to 37%, while Prashant's stake remained constant at around 0.5%. Now, by June of 2022, both Nishant and Rikant gave 5% each of their stake to Prashant, taking his total shareholding to 10.5%. And as of December of last year, more than 65% of Nishant Pitti's 28.7% holding was locked up. Now, come March this year, that was over. Then came the selling. Now, in September this year, Nishant Pitti sold a 14% stake in a block deal that was earlier planning to sell only 8%, and that fetched him a good 920 crore rupees. Now, Pitti may have halved his stake, but who bought it? Did institutions buy it? Not really, because the institutional shareholding in Easy Trip is nearly down to zero. Now, what started off at around 6% at the time of its listing 3 years ago, domestic mutual funds now have only 0.2% stake in the company. So who has got the stock gone to? Well, no prizes for guessing. Retail. Now, take a look at this. Now, domestic funds, retail shareholding too stood at around 6% in March of 2021, and come December this year, that stake has gone up to almost 34%. So retail investors technically own a third of the company. Now, in absolute terms, there were 50,000 retail investors in EaseMyTrip during its IPO, and that number has gone up to almost 10 lakh by December this year. Now, in January of 2024, Easy Trip had suspended its bookings to Maldives following a diplomatic row, a move later reversed in October. Now, however, during this period, the number of retail shareholders in the stock has doubled. Now, EaseMyTrip has on numerous instances dangled this bonus issue carrot to keep the retail flock interested. Now, it announced a bonus issue in February of 2022, another one in November 2022 when it also announced a stock split, and another bonus issue came in as early as October of this year. Now, but have financials matched up to this? Not quite. Now, net profit at the end of FY22 was 24 crores. That number is still at 26 crores. Now, even after making a peak of close to 50 crore. Now, EaseMyTrip has also been in the news for its interest other than its core business, because earlier this year, Nishant Pitti along with SpiceJet chairman Ajay Singh submitted a 1600 crore bid for the now defunct Go Air. Now, Pitti withdrew from the bid in his personal capacity in May this year, saying that he wanted to focus on the long-term vision of the company. Now, the company also announced plans in September to foray into manufacturing electric vehicles. A travel company making EVs would left many question marks, but the kind of market that we were in back then, the stock went up 11% post the announcement, only to fall 6% the next day. So what next for EaseMyTrip? Now, to be fair, there are multiple questions to be asked. Now, one, will Nishant Pitti be able to sell his remaining stake? Two, if he does manage to do that, will other promoters follow suit? Now, will retail continue to pile into the stock on the lure of these bonus shares and stock splits? And lastly, all eyes will be on the December shareholding pattern, and that should be up anytime next month. Now, it has been 4 years since Easy Trip went public. It has had its moments, both good and bad, but the trip ahead is anything but easy.
Okay, surely we'll be keeping an eye out on that. Thanks so much for that, Hormaz. But on that note, we're absolutely out of time on this edition of Business Lunch. Thank you so much for tuning in. Midcap Radar up next.
Along with margins, is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized, hence incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
(2024) saw a lot of action in the mutual fund space, and funds raised via NFOs has definitely been one of them. Let's look at the numbers. Funds raised by NFOs or new fund offers stood at 1.04 lakh crores in 2024. This is still the month of November, and we have more NFOs in the month of December that has not been accounted for here. That is an uptick of 63% versus funds raised in 2023 at around 63,800 crore rupees. Now, this was slightly lower than 2022. That time, the number was 67,336 crore rupees. But 2021 also saw massive inflows. This was double the amount versus 2020, when the amount raised was around 53,700 crore rupees. Now, if we talk about the number of NFOs, 2022 still tops the list. So far in 2024, we've seen 205 NFOs which have been issued till November. This compares with 212 in 2023, 246 in 2022, 140 in 21, and around 81 in 2020. Some of the categories that saw high flows: multi-cap funds getting in 6,300 crore rupees of money, and other ETFs at around 1,400 crore rupees. But the real star of this year had to be sectoral funds. 40 sectoral or thematic funds have seen the highest flows that we've seen in the last 5 years. Sectoral funds garnered around 67,772 crore rupees in 2024 so far, which is more than the flows in this space from 2020 to 2023. In this period, sectoral funds garnered around 52,165 crore rupees. This is via 59 NFOs. Even index funds actually saw a lot of interest. 76 NFOs in the index fund space, raising 12,147 crore rupees, which is the highest that we've seen in at least 5 years. Index funds have always seen a lot of interest, and more so in the last 3 years, with more focus on passive investing. In 2023, 53 index funds were launched, garnering around 2,700 crore rupees. This compares with 85 in 2022, and these numbers were very low in 2021 and 2020, as you can see on your screen. Interestingly, no mid-cap funds were launched in 2023 and 2024. This space did see a big rally, but did not see a new product here, but saw massive flows in the existing names. Also, only one small cap fund was launched in 2024. And now we are towards the end of 2024, and December also has seen a lot of action in the NFO space. But will this continue in 2025? Will there be new products by mutual funds houses to diversify their portfolio? Well, time will tell.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports.
Good afternoon and welcome to Midcap Radar. I'm Vivek Iyer, and with me today is Hormaz Fatakia. Good afternoon, Hormaz. It's another session where the benchmark indices are in the green, another session where you saw very weak cues from overnight markets, and another session where there's been a little bit of a bounce as far as an intraday recovery is concerned.
Let's hope it's not another session where the bounce does not sustain as well. But indeed, that's what the story of the market has been, right? Weak cues coming in from Wall Street. Most of the other global markets shut today. And after the gap down that we had, it's been a very substantial recovery that the Nifty has had. But let's take you through the next 30 minutes of the show, starting off with the top headlines this afternoon. The market has come off the morning lows in year-end trade that is thin on volumes. IT and realty are the weak spots. Metals and healthcare are exhibiting strength.
Reserve Bank of India in its financial stability report has flagged the rise in write-offs, especially by private banks, saying these could be masking worsening asset quality in the retail credit segment.
Ease My Trip co-promoter Nishant Pitti is likely to exit the company via sale of his 14.2% stake. Nishant had earlier divested nearly 14% in September for over 900 crore rupees. The move raises eyebrows with questions around the motive for this move.
EV player Ather Energy's 4,000 crore rupee IPO has got SEBI's green light. The fresh issue of shares to raise 3,000 crore rupees will help it expand its capacity by 3.5 times. Two-wheeler maker Hero MotoCorp will remain its biggest shareholder.
And Brent crude rises above $74 a barrel after US inventories declined and China's manufacturing activity saw positive expansion in December. With that recovery, oil is set to close 2024 with modest losses of nearly 0.5%.
Well, welcome to Midcap Radar. As you can see, most of the indices on the screen are trading in the red. The small cap index is the only one that's managing to see a bit of green. What's doing quite poorly today is the entire IT pack. The IT pack today at one point in the day was down almost 2.5%. And in fact, most of the heavyweights were seen as large drag. Names like TCS, Infosys were some of the large drags. But on the other hand, the other rupee sensitive actually saw divergent trends. You saw names like Cipla, Lupin, Sun Pharma from the Pharma pack today that did quite well. But this show is all about mid-caps and names in the broader space. Upasana is standing by the wall. This is our special segment, Mid-Cap Movers. Upasana will take us through the mid-caps that are moving around in the session.
Well, first up, let us look at the top losers in the market today in today's trading session. Persistent System is down about 2%. Phoenix Mills is down nearly about 3%. It continues its 3 days losing streak. AU Small Finance Bank is also down about 3%. It's down most in the last 9 weeks. Indian Hotels is also down and followed by Cochin Shipyard down nearly about 2%. Now let us look at the top gainers on the flip side. Torrent Power is up nearly about 6%, and this rise follows the 4 days of decline seen in the last 4 trading sessions. MRPL is also up about 5%. Hoodco is up nearly about 4.15%. Oil India also gaining into today's trading session, and Muthoot Finance is also up nearly its 52-week high. Now, let us look at the top volume buzzers in today's trading session. Vodafone Idea was a newsmaker yesterday as well, continues reeling upwards in today's trading session as well on terms of the strong volumes. Yes Bank also in focus, NMDC, followed by Suzlon Energy, which was again in focus yesterday as well. Now, let's look at the newsmakers in today's trading session. First up is Lupin. The stock hits 52-week high after the company makes a good addition in its diabetes portfolio. It remains in focus, up nearly about 2%. RVNL also in focus, up nearly about 4.5% as the company bags 137 crore order from the Central Railways. Mazgaon Dock also in focus as company has signed a contract with Ministry of Defence worth 1990 crores. And Shriram Properties also in focus as the company has announced strategic sale of a land parcel in Chennai, up nearly about 3%. And lastly, the IPO listing, that is Unimech, is up nearly about 73% as the IPO makes a stellar debut with 86% premium.
All right, Upasana, thanks a lot for sharing those movers then within the broader markets. Let's also welcome in Apurva Sheth of Samco for a technical check on the markets. Apurva, good afternoon. Thank you so much for joining in. Firstly, wishing you a very happy 2025 to you and your team as well. You know, we've had this bit of bounce from the lower levels, but the question is, as has been the case over the last 8 to 10 days, will the bounce sustain? And what is your call on the index for the January series as a whole? And couple that up with your stock recommendations as well.
Thanks a lot, Hormuz, and a Happy New Year to you and all the viewers of CNBC-TV18 as well. So Nifty has been trading in a lackluster fashion and volumes have also dried up. So even the cash market volumes have dried up to about 80,000 crores turnover on NSE. So there's very little action happening in the markets, and this is likely to remain for the remaining part of this week, and volumes should pick up in the next week. So Nifty for the extreme short term, the major support level is 23,500, and from a slightly medium term perspective, the low which was hit 2 months ago, which is 23,250, is likely to act as a very strong support. So until unless these two supports are held, bulls have some hopes for a bounce back, and this bounce back could put the markets to 24,100 and 24,500 levels. On the January series, the series is not so. January as a month is not so strong. Seasonally, 3 out of the last 10 years, only the January series has ended on a positive note. So not very great January for the markets. We'll see there'll be a lot of volatility coming up with Trump coming back in office, and also with budget. So let's wait for that. And on the stocks front, we have Sun Pharma. So the stock has been a relative outperformer, and it's been an uptrend when the market was crashing down. So, and last quarterly numbers were also quite good. So we believe that the stock has potential to head higher and even touch new highs. For the extreme short term, the stop loss would be 1860 and target should be 1960. And one pick from the mid-cap space is ITI. So even this stock has performed really well when the markets was moving lower. So over the last 2 months, the stock has moved contrary to the trend, and on all the upside days, the days when the stock was up, the volumes have also been very strong. So ITI is another stock one can buy with a stop loss of 360 and a target of 420.
Understood that. Thank you so much for joining us and giving us your topics as well as your index views. Well, let's now slip into a short break. On the other side, we'll be joined by Amitava Chatterjee, who's the new MD and CEO of J&K Bank, appointed just yesterday, joining us exclusively to discuss the company's business outlook at large. Stay tuned.
You in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steel makers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out.
Well, welcome back to Midcap Radar. As promised, we are now going to an exclusive management. J&K Bank has appointed a new managing director and CEO, Amitava Chatterjee. He joins us exclusively on the show now to discuss his role and the bank's outlook in more detail. Good afternoon, sir. Thank you so much for joining us. We understand, just prior to this particular appointment, you were the Deputy MD of SBI and you also served as the MD and CEO of SBI Caps. So you worked with much larger organizations in the past. You are now at the helm of J&K Bank. First up, give us, what is it that you've assessed so far? We understand that today is just day 2 on the job. And what are your targets as far as J&K Bank is concerned?
Very good afternoon, Vivek. Good afternoon, Harmaz, and season's greetings from J&K Bank to all CNBC team as well as the viewers. Well, it's as you said, it's the first day after taking over at J&K Bank. And as you rightly said that I was with SBI till 2 days back. So, of course, what I intend to do would be to add some value to this bank. Of course, you must be aware that this bank is primarily a bank for the services of J&K and Ladakh, while it is present in 20 other states in the country. But primarily, it's for the services for this geography. So, going forward, it will continue to serve this geography along with all the development that is likely to take place in this geography. And the J&K Bank will be very happy to be a partner to all that development. As far as the numbers are concerned, of course, we will be sticking to the guidance that has been given at the beginning of the year. And going forward, we would also like to carry forward similar numbers with improved focus on reduction of NPAs and other such things.
Mr. Chatterjee, good afternoon. Thank you for joining in. Congratulations on the new stint. We are stepping into a new year. You have stepped into a new stint as well. What's the situation on the ground currently? I know for a fact that you're still very early into the job, so I might not go into extreme micro for the bank-specific question, but on an industry level as a whole, there was this brief period where there were concerns about bank deposits and so on and so forth. What is the trend that you are observing right now as you have completed almost 9 months of the financial year as well? And what do you see going forward as well?
Deposits continue to be challenging as it is in the entire banking sector. It is not any different here. We are also trying to face this challenge as and when we would find a solution to this, and especially the concern would be on the CASA. My focus would be on to regain some of the lost CASA in J&K, and there's very good reason why we should be able to do it in J&K, because as you know, this bank enjoys almost a 60 odd% market share in this geography. So maybe a little bit of improved services, a more adoption of technology, and other things. I mean, augmenting the entire process. I think we should be able to improve the deposit scenario. But I agree that it continues to pose a challenge as it does to the entire banking industry.
Mr. Chatterjee, thank you so much for encapsulating those points for us. Now, first up, as you take over, could you give us the top 3 points that you would be, starting with as far as J&K Bank is concerned? Just to reiterate for our viewers, the earlier guidance given by the bank for FY25, credit growth of close to 15%, deposit growth of close to 12%, ROAs in the range of 1.25 to 1.3, and NIMs in the range of 3.75 to 3.85. You said that at this point of time, you are looking to hold on to the guidance, but will deposits be a challenge? And your top 3 things to look out for?
Yes, I agree that deposits are going to be a challenge, especially with the growth that we have seen in the first 9 months. It is definitely going to be a challenge, but we would definitely like to hold on to the guidance given, because what I said, some rejuvenation is required, especially looking into the market position of this bank in this geography. I believe that we should be able to regain. We still have more than 90 days with us for this financial year. If you ask me the top priorities, of course, the top priorities will remain to keep the NPAs and the SMAs in check. That goes without saying. To try and increase the other income for the bank. This bank doesn't have a very good-looking cost-to-income ratio. So we would definitely want to improve upon that. We would like to maintain the NIMs so that ultimately the ROA and ROE are protected. But again, positioning of the bank is very good. It has done well in the last 2 years. If you look at the numbers, 22, 23 and 23, 24, the bank has done pretty well. It has been able to improve upon many aspects. It has done well in the net profits. It has done well reducing the NPAs. I don't see any reason why it should not be able to do in future. And also the environment is conducive. There are a lot of developmental work going on in this geography. So J&K Bank being a major participant in the financial
right. Mr. Chatterjee, sorry to cut you in. You highlighted multiple challenges that the bank is facing, right? You want to boost the other income of the bank. You highlighted some challenges on the cost to income side of things and also on the deposit front as well. What are the steps that you intend to take to address these challenges? If you could encapsulate that for us, sir.
See, of course, cost to income ratio definitely will improve. See, both the numerator and the denominator has to be worked upon. I would definitely want to improve the interest income. The growth in advances have not been that good during the first 9 months, but there is a lot of pipeline that is there. So the bank had undertaken multiple technology initiatives during the last 1.5 years. So that has yet to we are yet to reap the benefits of those initiatives. So the initial glitches are gone now. We are on the threshold of reaping the benefits. We have also partnered with other insurance and mutual funds to sell third-party products. So that will augment the other income for the bank. So overall, I think the efficiency levels also need to be looked into to improve upon. So essentially, these are the three things I am looking at the moment. There would be many more things going forward, which I believe that with my experience in SBI, I'll be able to add value to.
We are sure that you will be able to do that. So thank you so much for joining us. We wish you and the team a very happy 2025 and wish you all the best as you step into this new role. And we'll hope to see you more often on the channel as you go ahead and deliver on the promises you've given us. Well, let's now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Slowdown. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
India is in vogue for a number of international brands this season. Supria Upadhyay, CNBC-TV18, Mumbai.
Hello, I'm Supria Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Welcome back. We ended this year with a very bumper listing of Unimech Aerospace, and the fact that the primary market activity is not dulling anytime soon because market regulator SEBI has approved the IPO of Ather Energy and 4 other companies. Rachna is here with more details on what the primary market is lined up for in 2025. Rachna.
Well, SEBI has approved the much-anticipated IPO of Ather Energy. The company filed its DRHP in September 2024 with a total IPO size estimated at 4,000 crore rupees. This includes a fresh issue of 3,100 crore and an offer for sale of about 2.2 crore shares at an estimated value of about 660 crore rupees. There's also a pre-IPO plan of 620 rupees, which will then be deducted from the fresh issue. Post the IPO is where it gets interesting. Ather plans to allocate the funds towards expanding its operations, about 927 crore, which will be used to set up a new manufacturing facility in Maharashtra. About 387 crore will go towards debt repayment, and about 750 crores will be invested in R&D. About 300 will be directed towards marketing initiatives and more. The selling shareholders in the IPO include Ather's promoters, GIC, NIF, the second one, and the Internet Fund. But Hero MotoCorp, which has been Ather's largest shareholder at about 37.2%, will not be participating in the offer for sale. With this IPO, Ather will be the first pure-play EV two-wheeler maker in the listed space. It goes head-on with Ola Electric, Bajaj and TVS, which are the legacy players. But if we look at it closely with Ola, Both the companies are still in growth phase and focused on ramping up their sales and manufacturing capacities, with Ola holding a market share of about 18%, while Ather is at about 14%. As of FY24, Ather Energy reported a revenue of 1,753 crore rupees, which is a significant figure, but still far behind Ola Electric's 5,000 crore mark, which has Ola, of course, has a larger production facility. It has sold about 3.29 lakh units compared to Ather's 1 lakh units in FY24. However, despite these large numbers, both the companies continue to grapple with significant losses. Ather's net loss for FY24 was at 1,060 crore rupees, while Ola's loss was slightly higher at 1,500 crore rupees. In terms of profitability as well, Ather has a gross margin of about 9% compared to Ola's 12.58%. This reflects the capital-intensive business models with high costs associated with production, scaling operations, and much more. But apart from Ather, SEBI has approved 4 other IPOs as well. First is Cholos Bangalore, a pure-play luxury hospitality chain which will be looking to list at about 1,000 crore rupees. Oswal Pumps also plans an IPO and to raise about 500 crore rupees. Apart from that, there's Quality Power Electrical Equipments that is also gearing up for an IPO at an issue size of about 300 crore rupees. And finally is Leela Hotels, a well-known hospitality brand that is set to raise about 1,500 crore through its IPO.
All right. Thank you so much, Rashna. So 2025, we are expecting the IPO pipeline or the primary market activity pipeline to be as robust as it was in 2024 itself. Well, a couple of stocks on the radar before we wrap up on this edition of Midcap Radar. Have a look at both Tata Chemical as well as GHCL. Remember, both of these companies are soda ash makers, and there has been a development yesterday where there has been a minimum import price which has been imposed on the import of soda ash. This particular development bodes quite well as far as both GSTL as well as Tata Chem is concerned. Back of that, both of these stocks are doing quite well in this particular trading session. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at 108,000, surging 130%. The crypto market capital also hit an all-time high of $3.9 trillion. Well, the year 2024 started on a higher note with launch of Bitcoin ETFs, which gave easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion worth inflows. Ethereum also did not lag too far behind, with ETF inflows above $2.7 billion, making its place in decentralized finance. Institutional investors now own nearly 20% of all Bitcoin ETFs traded in the US. And then it was also about Bitcoin halving, an event that happens every 4 years. It leads to reduction in block rewards by 50%, lowering the supply of Bitcoins. It was also then that the rally took wings with the US President-elect Donald Trump pro-crypto.
Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala joining you from our Mumbai studios. 2024 is nearing its close, and as we gear up for 2025, a year that promises to bring its own share of market volatility, in November 2024, equity mutual funds inflows moderated to 35,927 crores from October 41,865 crores. Meanwhile, the thematic fund inflows saw a sharper drop, sliding to 7,658 crores versus a much higher number in the month of October. So what is it that is lying for the investors ahead in the mutual fund industry? What are we watching out for? Which are the themes and sectors that you should be keeping on your radar? And this new year, we are going to be bringing you that as we bring down the curtains on 2024 and raise the curtains for 2025. We'll help you navigate with all these questions. So we're going to be joined by our guest today. We have Harshvardhan Rungta, who's joining in with us from Rungta Securities, as well as we'll have Radhika Gupta also joining in with us from Edelweiss Asset Management, MD and CEO of the company. But Harsh, let me start with you and let's dive right in. Thank you so much, firstly, for joining in with us this afternoon. I just want to talk in terms of overall, what are we seeing in terms of the trend that is there for the market? Economic landscape that is there in 2025. How is all that going to be impacting the mutual fund industry? What are we watching out for over there?
So, well, Vinny, as far as investors are concerned, I think investors have had a good experience investing in mutual funds, investing in equities in the last 2 to 3 years. So I believe that they will continue investing. However, investors would need to definitely moderate their returns expectations from equity mutual funds especially, or rather equity investments for that matter. I mean, the kind of returns that you've experienced in the last 2 to 3 years, I don't think the same kind of returns will replicate going further, at least in 2025. Now, specifically because, I mean, we'll have to wait for earnings to catch up with the price growth that has already happened. So until and unless we see the earnings pick up, there could be a price correction or a time correction, I mean, for a reasonable amount of time. So I guess investors will have to keep that in mind. With regards to debt, of course, I mean, asset allocation is going to be important. So I just leave it at that for a moment.
Okay, so yes, that's something that we're watching out for. But, Radhika, good afternoon. Thank you so much for joining in with us as well. Radhika, my question to you is, what are you also anticipating in terms of trends for 2025 for the mutual fund industry? What is the key factor that we're watching out for this time?
So I think it's a year of consolidation for the mutual fund industry. As Harsh very rightly said, as all of us have spoken about, over the last 3-4 years post-COVID, we've seen so many new investors come in to this industry, to equity markets in general, made a lot of money. And this is going to be a year of more muted expectations. In fact, I've been saying for a year that my greatest worry is the almost whacked expectations that equity investors have from their funds. So in a year of perhaps slightly lower returns, and nobody can predict, I think it is consolidation. It's people keeping the faith in SIPs, people keeping those equity investments going, people returning back to the days of normal returns, asset allocation, all those good things that we talk about. And I think consolidation is very important because it brings quality to your growth.
Okay. So consolidation is what we're watching out for in 2025. Radhika, will passive investments like ETF, index funds, will that be something that will continue to gain traction in 2025? What is it that we're watching out on that?
So I think that movement is structural and it's happened in other markets around the world. And if you look at the index fund category, if you look at the number of folios that equity ETFs have, if you look at debt ETFs as a category, all of these have meaningfully expanded. If I look at us as an AMC, I mean, 2 years ago, 100% of our flows used to be active. Now 10-15% of our equity flows on a monthly basis are passive. So all of us are steadily seeing an uptake, and this is not just EPFO money, this is retail money. In fact, when I do IAPs and investor events, even in small cities in India, people will pop up and say, oh, what's an ETF? So I think ETF solutions, index fund solutions will grow. I think the color of those solutions will get a lot more sophisticated beyond market by cap based solutions. So one more option in the basket that's here to stay.
One more option in the basket, surely. Harsh, are we expecting a major shift, like she's saying as well, ETFs, that is surely something that everyone has started asking about. But debt markets, let's talk about that as well in 2025. And, we have Trump coming in. We had heard the Fed in terms of the interest rate as well. So, do you think that is something that will pique the interest for the debt markets as well?
So I wouldn't say whether it would peak or not, because, we are at a retail inflation of 5.5%. And it's way beyond RBI's comfort level of 4%. So I don't see rate cuts immediately, at least in the next 2 quarters for sure. I mean, if it happens in the third quarter or the fourth, I think that'll be good enough. With regards to investors, I think the expectations should be again in the range of about 7-7.5%. I mean, that's usually the kind of returns that investors will expect. One important thing that I want to highlight over here is, I mean, you might have to play the duration. So if an investor is sophisticated enough or has an advisor who understands the interest rate cycles and could properly time it, I mean, you could play around a little bit during the, around the duration of the fund. So you could possibly go in for a medium to long-term funds in case you're anticipating the interest rates to come down sooner than what I have said. So you could play the medium-term or the long-term bond funds. So I think that is somewhere that you could, try and pitch yourself in case you're looking at additional returns, the extra returns in a debt fund. Yeah. However, my suggestion to debt investors is that don't try and maximize returns, quite honestly. Yeah. Debt is not a product for returns maximization. It's more to do with less volatility, liquidity when you want it, predictability of returns at least. I mean,
so somewhat sort of a safety wise.
Absolutely, absolutely. So don't play the maximization of returns through a debt fund. I mean, that's my suggestion. But Indian investors are very, very very ambitious in all respects. I mean, they want the best of everything with the lowest of cost. So Radhika mentioned about the shift towards index funds and ETFs. Yeah. One primary reason is we want cheap. We want everything jo sasta, jitna sasta.
And we value customers here.
We have also highest return, lowest risk, least cost.
Yeah.
We want all the positives only. That brings pressure on you. Yeah, exactly. We want everything the best, but surely we have to keep in mind all the factors that are there as well. Harsh, what would be the best sort of an allocation that one could have in 2025? Equity, debt, hybrid mutual fund.
So, I have a point here, Vinny, which I've been emphasizing a lot. I mean, when you do an asset allocation, it has nothing to do with the year in which you're starting or how the markets are looking.
Okay.
So, hypothetically, you were supposed to start your asset allocation in 2024. And in hindsight, now we know that markets have done extremely well. The equity markets have done extremely well. Does it mean that a person who was conservative in investing should have gone into equity, the whole hog? No. So what is important is when you're designing an asset allocation plan, for the moment, keep the markets out. Keep the expectation from markets out. What you need to only focus upon is your time horizon, your goals, and your risk profile. So if you have these things in place, then you design a plan. Now, what will change with market conditions, if at all, is the method in which you invest. So if you had lump sum to invest and you're looking at market valuations being at their peak, then you might not put lump sum. Then you might go in for an STP or you'll go through an SIP, right? So the only thing that changes with market conditions is the method with which you will park your money. Okay. But you will not change your allocation purely based on how the market outlook is, because that could be extremely dangerous. I mean, if you require, so I have some people coming to me saying that I need money in 1 year. Tell me which equity mutual fund to invest in. So that cannot work. Because in the last 1 year, equity mutual funds on an average given 20%. So I'm looking at 20% in the next 1 year. Yeah. So that cannot work. I mean, it doesn't go like that. On the other hand, we cannot say that we are looking at markets to correct, so let's go and short sell. No, that's not the strategy. So an investor should very, very clearly understand that asset allocation is nothing to do with market conditions. It's to do with your time horizon, your risk profile, and your goals.
on the basis of that, how should I go? If my time horizon is there, my risk profile is there, is there a specific way, no matter what you're starting, if I have to hold it for 3 years, okay, or 5 years, long term, as long as you can go, then what should be the ideal way to actually start investing? Like someone newer wants to start now, has gotten it, then what is the way that you should be looking at?
So what we've done is we've got a table keeping only in time horizon in mind. So as I said, there are 3 factors, right? So there's time horizon, your risk profile and your goals. However, because risk profile and goals could be subjective to each individual, time horizon can be more or less standard. So what we've done is that we've got a time horizon chart, if I keep only time horizon in mind. So like for example, if an investor wants to be for more than 8 years, so if you're very clear in your mind that you want to stay invested for more than 8 years, you could go 80% equity and 20% to debt and gold. Now, if you're 5 to 8 years, then 60% equity, 30% debt and 10% gold. If you're 3 to 5 years, then 50, 40 and 10. If you're 2 to 3 years, then 30 is equity, 60 debt, 10 gold. If you're less than 1 year, then 90% debt and 10% gold. So nothing comes in equity if you're in 1 year.
There is nothing there in equity if it's there in 1 year. Radhika, do you agree to that? One advice that you have to give someone who's maybe starting out now, who's younger, what is the best advice to start in 2025? On the first day of January, what is that one thing they should do today?
Well, if you're young, honestly, the advice is on just to get started. And what I tell people who are salaried, who are often getting started is, look at your post-tax income. It's a very simple formula. Look at your post-tax income and target an investment amount. Now, it could be 10%, it could be 20%, it could be 30%. I think 20-30% is a great place to be. But don't, if I'm saying 30 and you're getting stressed, then start at 10%. And do a basic SIP into one of the equity funds, some multi-cap fund, some balanced advantage fund, one of these, what I call classic dal chawal equity mutual funds. Start an investment there and build up. I think the best message about starting is to start. And start simple and do it consistently. And the reason I think SIP works is, SIP is a little bit like TDS, right? You don't avoid paying tax because TDS, it's deducted at source. SIP is investment deducted at source. So start. Simple, consistent start.
Just start. That's the word coming in. Whatever it may be, start little, start somewhere. Then you can build on it, I think, going forward. That's a strategy. But I think on that note, we're going to take a very short break. So viewers, don't go anywhere because we will still have Radhika as well as Harsh or Rumta who are here to solve all those doubts and tell you all what you all should be doing in 2025 for the mutual fund strategy.
He has pledged to make US the crypto capital of the world. He also suggested US Bitcoin reserve, and there also was a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who is a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have cheered, expecting favorable regulations going forward. The Russian President Vladimir Putin recently said that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. After El Salvador, countries like Tonga, Paraguay, Panama are also considering adopting Bitcoin as a legal tender. The cryptos also are taking support from wider adoption of real-world assets. The stablecoins are also emerging as payment tools for enterprise businesses. The year 2024 also had its share, though, of frauds, hacks, and rug pulls. The sector lost nearly $2.3 billion this year in frauds, though lower than the last year. The names that went through issues this year was Wazirex, Radiant Capital, DMM Bitcoin, among others. While the Bitcoin grabbed the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano all reached all-time highs, while the lesser-known altcoins like Palm AI and Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor, with market cap now at $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and blockchain as a technology, and the markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein now expecting $200,000 per Bitcoin. MicroStrategy, in the meanwhile, expects Bitcoin to rise 29% per annum over the next 21 years. But remember, it's a volatile space with significant risks.
Welcome back to Mutual Fund Corner on CNBC-TV18. We still have Radhika Gupta, MD and CEO at Edelweiss Asset Management, and Harshvardhan Rungta, CFP at Rungta Securities, with us to talk about mutual fund strategies in 2025. Radhika, let's continue the conversation and talk about sectors, themes. We had seen those thematic funds. Everyone was very enthused about it in 2024.
Yeah.
What is the role of that going to be in 2025? Also, international funds, does that start playing an important role now given the whole scenario globally?
So on sector funds, I think I've been asked this question every day of 2024, and I've been a little bit of a broken record, even though I run an AMC, on saying that we went from dal chawal investing to buying too much of pickle and chutney and gulab jamun in our diet. And the fact is that sectoral funds became larger than flexi cap as a category. So my take on sector funds is they remain relevant as satellite funds. And by the way, I have sector funds, and I'm still saying this, they remain relevant as sector funds. I think my advice for 2025 with sector funds is a couple of things. One, don't fall for the extremely narrow sector. When you look at sectors in India like financials and tech and consumption, these are broad-based sectors. There are enough stocks for a fund manager to play in this category. When you look at some of the sectors, and I don't want to name them, 3 stocks will make up 80% of the sector. That's a problem. The second is you want to pick sectors that are slightly beaten down. Like we launched a fund in the tech category in March last year when tech was a little out of flavor. Thinking of doing something in the consumption space in January. You don't want to buy into a sector fund when the recent return is 80%, which is unfortunately what people do. So I think the sectors that were the flavor of 2024 may not be the flavor of 2025, and go for broad-based sectors that are out of favor. On international funds, the question's interesting. I think people always try to time international funds and they don't do a fantastic job. I've always believed that for a more evolved investor, 10 to 15% of your portfolio can be international funds. US is a very meaningful market. China still looks like an attractive valuation play. So you can have that combination. The problem is you shouldn't like international funds for past returns. It should be an asset allocation tool.
Dal chawal approach, pickle papad approach. I'm very, very intrigued by that. I've heard this before as well coming from you. But what portion of one's portfolio should be dal chawal, pickle papad? Is it like a real thali that we're eating that
think
division?
It's real thali. I mean, I think it's 80-20, right? I eat 80% of my meals at home and 20% of them outside. And more than that is a little bit of indigestion. Now, whether it's 80-20 or 70-30 is something that you can debate. But it's certainly not 20-80. I mean, I have seen portfolios, Harsh, where people are doing a 30,000 rupee SIP and there are 35 funds, 20 of which are sectoral. That, to me, is too much pickle and chutney. You really want to do things that are all-weather sustainable. And I think in India, where the index is delivering 12 to 15% on large cap and maybe 18% on mid caps, you're pretty good with dal chawal.
Yeah. Harsh, I'm going to come to you. She gave us a portion in terms of how much should be thematic, how much should be, your basic funds that you should be focusing on. I want to understand that, there are a lot of funds coming out on the thematic side, whether it's on sustainability, that's the trend. There's tech-based funds as all thematic funds. What is it in terms of, would you be looking at that in 2025? Any of that is picking up pace, right? Maybe if they have enough number of shares, or is this as a story of sustainability or technology-based thematic fund a good play to bet?
In all decades, you'll have something changing in the economy. So let's not take away that from investing. Okay, at one point, textile companies were the blue chip companies of now nobody even talks about textile companies. So there is going to be an economic, change in the way the industry and the consumption is going. Our consumers are going to take different products. So obviously, you're going to find areas where there is going to be different themes working out in different decades. The question is, are you capable enough as a retail investor to identify that? That's the challenge. So while I'll say it's going to rain, but do I know when is it going to rain? Okay, so if I don't know when is it going to rain, then I'm not going to certainly bet on it.
Yeah.
Right. So the question is, yes, the demographics are going to change. The industries are going to change. The relevance of certain industry and markets are going to be different. But the question is, can a retail investor identify that? So partly answering your question that yes, it is true that there's going to be a lot of change and shift. But the question is, as a retail investor, am I going to be able to capture that at the right time? So my suggestion to a retail investor is, as Radhika rightly mentioned, if your index is giving you a 12 to 15% or 18%, then why are we trying to do more in the expectation of generating probably 100 or 200 basis points more. So if a diversified equity fund, the fund managers anyways are, looking out for, trends in the market and trying to maximize that return for the investors, even in a diversified equity fund, then let that job be done by the diversified equity fund manager, right? So I think a retail investor, the less you interfere with your investments, the better you will get outcomes. So do not interfere with your investments. Let your wealth be taken care of, the wealth creation be taken care by professionals.
Okay. Radhika, quick question. SIP, lump sum investment, or both? Even sometimes I'm confused, do I go for lump sum or just do I continue with SIP? 2025, one has to strategize it. What is the right strategy for playing this?
Okay, so this is a non-popular answer. SIP or lump sum are modes, right? Now, if you're a salaried person, for instance, I can't tell my board to give me 12 months of salary in 1 month, right? So I have to do SIP. So I think of SIPs more as a savings and monthly automation tool. So SIPs continue as it is. For instance, a large part of my investments come via the SIP route because that's how I get my cash. Now, if you have money to deploy today, the question is, should you do it in a lump sum way or should you systematically stagger it using something like STP? Here is my contra answer. Honestly, if you're investing for 10 years and if you're going to do an STP and stagger that money over 6 months, nothing matters because the difference in return is 1-2%. However, for many investors, just staggering things out on worry that Trump is going to come and say something, there's a market event, etc., makes them feel good and gives them the confidence to invest. So if you're a 10-year investor, it doesn't matter. If you're a much shorter term investor and these things help you feel good, maybe it matters.
Okay. Harsh, they've told me to wrap, but a quick same question to you. Anything different on that front? SIP, lump sum or both?
So I would just take it further from there to say that, SIP is rupee cost averaging. So if many people have the lump sum, but they go through SIP because they want to average their investments over a period of time. Lump sum is actually a power of compounding impact. So the earlier my money goes into the system, the more it is going to generate. Okay, so if I'm going to stagger my input over a period of 6 months to 2 years or to 3 years, I know people doing STPs over 3 years. So until 3 years, you're doing a rupee cost averaging. The real sense of compounding will start after your money comes into equity fund. However, having said that, each individual to their own, to their risk profile, whatever gives them sleep, peaceful sleep at night, that is the way to go about it.
Sure, peaceful sleep at night, that's the most important. Today we are not going to be, I hope everyone's partying today, but thank you so much Harshvardhan as well as Radhika for joining in with us on the show on this special day, last day of 2024. It's been a pleasure having you both on the show. 2025, your strategy should be in place because they've given you full on insights about that. But thank you so much for tuning in, viewers. With that, we'll leave you to closing bell to take you through the action in the markets in the last 1 hour.
About projecting its future returns, it's always pays to be cautious.
"2024 began with a bitter pill for contract development and manufacturing organizations, or CDMO players. A muted biotech funding environment dampened the pace of early-stage projects, leaving these biotech firms feeling the heat in 2024. But here's the good news. Positive triggers are emerging on the horizon, and there are clear green shoots that are visible and indicating a turnaround for the sector. The first one is an uptick in biotech funding, signaling a recovery expected in CDMO players. Demand for CDMO services in late stage as well as commercial molecules is also on the rise. Moving on to the third one, we have broad-based commercial contracts in biologics and small molecules that is picking up pace, as well as biologic CDMO demand that has remained robust, and we are expecting the good growth to continue going forward. Nutraceutical manufacturing demand that is also recovering quite steadily, and now we will shift focus and talk about what the highlight and commentary is coming in from the CDMO players. That's a key one, because what they're signaling is that maybe in the near term, there could be some mixed near-term challenges that we're watching out for, but a promising outlook that is coming in for the medium term. Piramal Pharma is expecting to see early teens growth as the CDMO segment is outpacing the company's average growth. DB's Lab, they remain quite confident in terms of a double-digit growth in terms of revenue. We have Syngene, Laurus as well as Newland Labs. Now their commentary is quite similar because what Syngene is saying that they're expecting high single-digit growth in FY25, but FY26 expected to be stronger. Similarly for Laurus Labs, expecting a soft growth in FY25, but a good growth from FY26 and onwards. And Newland Labs also flat growth in FY25, but targeting a 20% CAGR growth in the medium term. Now let's look ahead. The industry is poised for an acceleration in terms of top line growth. Currently somewhere at 9%. By FY27, 16% growth is what one is watching out for. However, valuations, that's the key concern coming in here. Because valuations currently are ranging somewhere between 47 times to 60 times for these players. Following the surge that we've seen coming in on a YTD basis in terms of a stock performance, that was somewhere between 40% to 80% in the run-up that we're seeing, which is outpacing the Nifty Pharma's 34% rise that we saw this year, approximately on that front. Now, finally, here's what investors and analysts need to keep an eye out on. One is the progress in terms of the Biosecure Act, when it's going to be picked up in the US Senate. Moving on to the next one, we have seen sustained recovery in biotech funding. Will that continue in 2025? That's going to be a key factor. Uptick in RFQ surely is there, but are they translating into confirmed orders? Keep an eye on that, as well as company-specific new launches. What is the trajectory that they have for price erosion in generic APIs is something that is very important for CDMO players. Hang Seng, that's trading with mild positive as of now, 46 points up, that is 0.2% of uptick there.
Sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues.
23,550. We're staring at a downtick of nearly 100 points at open.
So it's been a wonderful year for stock picking. And while the Nifty, which is the large cap index, is up 8 to 9%, you have the broader market which has done really well.
And usually second half of the year is always better in the nature of business that we are in.
There has been a little bit of a recovery from the day's low because we went down to levels of even 23,500.
Over the last 2 years in a row, Bank Nifty has actually underperformed Nifty with respect to returns.
It's another session where the benchmark indices are in the green. Another session where you saw very weak cues from overnight markets.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that was the day so far, the last one of 2024, and we've entered the last hour as we say goodbye to 2024 and welcome 2025. Hello and welcome to Closing Bell live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Lata. And Lata, finally, when you look at the market action, the recovery from the lows, 170-point recovery on the Nifty to pretty much come to the flat line. It's giving you the little bit of a festive cheer, right?
Oh, absolutely. The stocks have come down for their New Year's Eve party.
Yeah.
And I, for once, want to say, I told you so. I dressed in green, expecting that in the last hour, we could have some NAV management. After all, volumes are thin. And there isn't that much of incremental bad news. You know, when they look at the dollar and the bonds, they've not given you that much bad news. So probably a pull-up was possible. I always thought there was a bit of a lack of cheer in midday trades, where at one point the Midcap index went even 1.1% lower. And the big caps were trading. Nifty was down to what, 23,440 thereabouts. So we saw that 23,500 getting taken, but it's a good 100-point spring up from that level. And we also have the mid caps up about 1.2% from the day's low. So it looks like we could end with a maybe brighter shade of green if this trend of the last half hour continues. I think the standout performance for the big caps came from Kotak Mahindra Bank, from Trent. Those are the two heavyweights that moved well. And ONGC has been, of course, in the green from the word go.
You know, in fact, we should pull up the contribution of the Nifty Bank, not the Nifty, and you will see how Kotak Mahindra Bank has moved. It's recovered close to about 3%, 4% from the day's low right now. It's recovered 3% from the day's low and is now up close to about 3%. So Kotak Mahindra Bank, 100 points on account of Kotak Mahindra Bank. And again, the FII related, banking stocks like an HDFC Bank or ICICI Bank, they're still on the red side.
Yeah,
so that gives you the...
I must warn you that there were rumors floating around about Kotak Mahindra Bank.
Okay.
I do not want to mention it, but most people would guess because it's the whisper campaign was in the market. But I think that could be behind this positive reaction. But let's see, until the end of the day, the news can still come.
All right, so that's one thing in terms of the banking action. IT has been on the back foot since morning. So the Nifty IT index is down 1.5%. Again, there has been a recovery from the lows because the Nifty IT index was down nearly 2.2, 2.3% at the session lows, but under pressure now. Tech Mahindra, TCS, Infosys, broad-based sell-off when it comes to IT. Adani Enterprises is weak in trade after yesterday's massive 7.5% rally. There is a bit of a give back. And FMCG, of all the indices, the Nifty FMCG index is the only one where there hasn't been any return. It's absolutely flat year to date. But again, on the last day of FMCG, I'm not sure if it's a harbinger of things to come, but the last day, things have turned positive for FMCG. And Pharma continues to be active. Even today, Nifty Pharma has been the best performing sectoral index of this year with a 40% up move, and even today it's going strong.
Somehow I can't get my head away from the fact that if FMCG is moving, if Kotak Mahindra Bank is moving, if Keynes and all those EMSs are moving, are they not favorites in portfolios of so many funds? So maybe there are other reasons why it's easy to move them in a thin market.
Okay, so let's find out how you should position yourself in the last hour of trade. Nagraj Shetty is now with us for a few closing strategies. Nagraj, what have you made of today's trading action and your stock calls for the last hour?
Hi, good afternoon, Rima. Nifty has been in a range-bound action over the last 5-6 sessions. We may observe that at the higher levels, 24,000 has been a strong resistance, and at the lower level, Nifty has showed some smart upside bounce from near the support of 23,500 levels. I think this range is going to be remain for at least for some more sessions, and having moved up from the lows of around 23,500 levels, we could see some more upside bounces coming in for the Nifty in the next 1 or 2 sessions from the lower levels.
Okay. Any specific stocks, Nagraj, that you would recommend a trade for the last hour?
Yeah, I have 2 stocks. One is from a long side, one is from short side. Long side, I would like to mention about the pharma. Pharma sector has been in a consolidation phase, recently broken above the consolidation, looking attractive on the charts. From the pharma front, Aro Pharma, Aurobindo Pharma is the one after a longer consolidation movement. It has broken above the hurdle in the last couple of sessions. Currently trading around 1335 levels. Overall chart pattern is looking positive. I am expecting this to move up towards the next upside target of around 1435, 1440 levels, and one can place a stop loss at 1290. And another from metal side, metal still looking weak. And the Hindalco is the one who has been continuously in a downtrend. Lower tops and bottoms is visible on the chart, which is indicating the downside momentum which is in force for this stock. I'm expecting more decline for Hindalco, currently trading around 1603, 604 levels. One can look to sell at this point of time. 570 is going to be the downside target for the Hindalco, and 625 is going to be the stop loss.
Okay, Nagraj, thank you very much for that. We'll try and get back to you for the BTST trades. Now, Rima began by saying that stocks have come out for a New Year's Eve party, perhaps. Well, that's what we have laid out for you. As we wrap up on this year, in the final hour of trade for 2024, let's look at the top 5 winners and losers from different sectors of the market. Our research team is standing by with the full list. Well, as you can see, the team is out in all its grandeur. First up, let's look at the 5 gainers and losers from the large cap space. Abhishek, take us through the list.
Lata, to begin with, Trent has been the top performer. It has more than doubled its stock price for 2 consecutive years. So it has delivered positive returns annually since 2014. M&M is the other gainer. It has seen the sharpest rally in a calendar year since, in the last 15 years. So Bharat Electronics, the PSU defense heavyweight, that's gained about 58% this year due to robust government spending on defense and significant order inflows that they have had. Bharti Airtel has been delivering positive returns every calendar year since 2019, but in 2024, the return that they have given is the best since calendar year 2017. Now, Sun Pharma has outpaced the industry benchmark. A superior ROE profile that you saw for the company this year has led to the stock price outperformance. Now, coming on to the declining side, IndusInd Bank has been the top loser in the Nifty. The rise in slippages on unsecured lending and its exposure to the microfinance sector has weighed on the stock price. Asian Paints has seen its stock come under pressure this year, and that's been hit due to weak demand, margin pressure and rising competition that you are seeing from new entrants. So high food inflation has disrupted the consumption patterns across India, especially amongst mass segments of consumer. So India's FMCG sector is expected to rebound in 2025 after the fact that high costs, slowing growth and inflation impacted the stock performance this year. So Nestle, Tata Consumer as well as HUL, they saw their stock price decline in this calendar year anywhere between 12 to 18%. Back to you.
Thank you. And let's now get to the mid-cap big movers on the way up and on the way down. Vivek.
Well, when you're talking about the mid-cap space, the couple of stocks stand out, and amongst the top 5, all of the stocks have minimum given a doubling return as far as calendar year 2024 is concerned. In fact, the top gainer of 2024 has actually tripled in one calendar year itself. So the first stock on the radar, Oracle Financial Services, a couple of quarters where the company gave stellar results led to a re-rating in this particular name, up 3x or 201%. The next stock is one from the EMS space, one that we speak to and one that we cover quite regularly, is Dixon Technologies. This particular stock is up 2.7 times in this calendar year, 170%. PB Fintech, the other stock, one stock that actually saw quite a bit of volatility given the company's likely foray into a backward integration of healthcare. But despite that, this particular stock up 162%. BSE, both of the exchange stocks did quite well, but BSE outperformed 140% higher. And RVNL, railway stock, making its name in the top 5 of the mid-cap space, up almost 135%. But when you're talking about some of the laggards, quite a few stocks have eroded significant value. First on the list is Vodafone. The stock has actually halved in 2024. Along with that, the next 4 stocks are stocks either from the banking or the NBFC space, and most of these stocks have one theme in common. Most of them are actually having significant pain as far as MFI or rural portfolio is concerned. So Bandhan Bank down 34%, AU Small Finance Bank down 30% for the year, IDFC First Bank down 29%, and Poonawalla FinCorp, which had a very weak Q2, this particular stock too is down 29%. Overall, the gainers in this point of time have actually given stellar returns. The top gainer has actually doubled or tripled your money in 2024.
Oh, absolutely, Vivek. It's absolutely breathtaking, the kind of returns we've got from the mid-cap stocks. So the mid-cap index rose 24% this year, and the small-cap index 26.5%. So obviously, there are some stellar winners. Actually, speaking of small-cap, Upasana is here to tell us what went up and down in the small-cap space.
Well, this year was all about the mid and small cap outperformance. Now, coming to small caps, what are the key gainers out there? Well, EMS was one of the themes that was buzzing in this year, and even there is a positive outlook for the upcoming years on the back of its capacity expansion and PLI. Now, Keynes Technologies is one of the stock that has been an outperformer, gained nearly about 178%, followed by Dixon. Amber Enterprises also is one of the star performers, up nearly about 134%. Aegis Logistics is the next one, up nearly about 134%, followed by Blue Star, which remained in focus throughout the year, up nearly about 127%. And lastly, IFCI Limited also remained in focus, gained almost about 106%. Now, coming to laggards, it's mainly the media and NBFC space. Now, Z Entertainment tops the list with a loss of 56%. Credit Access Grameen down about 44%, RBL Bank down about 44%, Tanla Platforms down about 39%, followed by Aarti Industries, which eroded nearly about 36% of its value. And lastly, IIFL Finance, down about 28%. Now let us look at the gainers in terms of NSE Small Cap 250 Index. It is topped by GE Vernova TND India, which was up nearly about 307%. KFintech 219%. Motilal Oswal Financial Services also was up nearly about 200%. Anant Raj also was one of the stocks that remain in focus with a gain of nearly about 191%. And Keynes Technologies, as highlighted earlier, was one of the key gainers in this index with 178% gains. And lastly, Godfrey Phillips also remained in focus with a gain of nearly about 146%.
Eye-popping returns over there. Thank you, Pasna, for highlighting that. But let's move on now to the commodity space because that wasn't bereft of drama and big action. Manisha is here with a wrap.
Well, thank you so much for that. 2024 indeed was a year of record highs in gold and silver. While the gold prices hit all-time highs in dollar, Japanese yen, Indian rupee, Chinese yuan, Australian dollar, and various other currencies, well, silver prices hit an important psychological 1 lakh rupees a kg mark for the Indian markets as well. But as you can see, while gold is putting best 2024 as a performance since 2010, the gold and silver prices gave better returns due to rupee depreciation in the Indian markets than what they did in the US terms. There you can see that difference there. And since we are talking gainers first, well, the US natural gas prices within the energy basket has seen prices gain up by 65% for 2024, trading at the highest since December 2022 on the back of strong global demand, geopolitics and expectations of higher LNG export permits as promised by the US President-elect Trump. Well, the rest of the energy pack, as you can see, has seen a bit of a decline continuing. The Brent is down by nearly 4.5%, while the WTI crude prices also are down nearly 3% there. This is happening on the back of weak Chinese demand. But staying on yet again with the gainers, let's talk about coffee, cocoa, and these prices also hit record highs in 2024. While the Arabica coffee hit record highs at $3.5 a pound, gaining around 70% in this year, you also have seen the highest levels of 1977 come in for this one. Robusta, as you can see, is up 90% in 2024, and cocoa prices hit all-time highs, gaining 160% in this current year. In 2024, the base metal prices also started the year as the weakest commodity asset. But it was by the mid-May that you saw the prices as best performing in sense of an asset class as funds invested in metals that were going to be used in AI and green transition. But by the month of July, the global manufacturing was declining and China economic data wasn't improving either, taking the metals sharply off its 2024 highs. But closing in green, especially with zinc performing with 15% of gains. And you also have seen copper and aluminum gain anywhere between 5 to 7% onto this one. Well, 2025 is expected to test us further, especially as the new US administration under Donald Trump takes over on 20th of January. And then you would see details on trades and tariffs and pledges. It will all start to becoming more clear, as would the retaliation from reactions from other countries. The other thing that the street will watch out for is the China stimulus measures, which are expected to show result in 2025. And the global central bank policies will also shape up 2025, as would the currency moves. And then the policies on climate change, geopolitical concerns, is something that 2025 will watch out for.
Thank you, Manisha, for that. Gurmeet Chadha, Managing Partner and CIO at Complete Circles, is now with us on the show. Gurmeet, thank you very much for joining in. So before we get chatting about the market's outlook, tell us your best performing stock of 2024 and the biggest dud.
So it's been a couple of them. One is Dixon, as your one of the team was mentioned. We got lucky. The other one has been the capital marketplace, which is CDSL and BSE. BSE, we probably pulled the trigger a little bit, citing some valuations. And there is another pharma company which has done very well for us, which is Newland Labs. These been one of our top portfolio attributors, if I may call them, in the portfolio we run for our clients.
Let me ask you an unfair question, Gurmeet. If you have to pick for us one, or okay, let's make it a little more concessional. One or two stocks, even top 3 stocks that will do extremely well in 25, what would they be?
Season's greeting, man. Good to connect with you always. One play we are really focused on is this entire recycling space. I think we have done a lot of harm to Mother Nature. So one theme we really like is waste management, within which we have Vartec Vavag, which is into water treatment, and it is across vertical, whether it is desalination, whether it is seaver, which is the EPC part of it. So to me, it's more emerging like a water technology play. So for example, we desalinate today at much higher cost. Dubai has been doing it at 10 paisa. We sell water at about 45 paisa a liter, which is too high. And with 19% of the world population, we just have 2% usable water. So huge opportunity here. Similarly in that we have a company which is Ganesha, which is to recycle plastics. So one theme which we really like is waste management. The other one which we are very now focused on is the new energy transition play, which I think is not getting reflected in the Nifty. So one stock which we added recently is Precision Camshaft, which is into retrofitting. So India is a very difficult market. Retrofitting is converting diesel vehicles into electric vehicles. It starts with vehicles which less than 5 tonnage. So Camshaft is their bread and butter product, where they are market leaders. In fact, they're the third, fourth largest globally. And retrofitting is something which is very new. They've just got a 500 order from Telangana. And a lot of state policies have now included retrofitting as part of the FAME subsidies and other subsidies you do. So these are some of the new ideas we are looking to add, and some more ideas in the defense tech space.
Okay. Oh, well, more strength to you if we can have waste management companies not just, neutralize the harm we have done to Mother Nature, but also make money for us. But just revise your name again: Precision Camshafts, Vartec Vavag, and which was the other one?
Ganesha Ecosphere, which is into recycled plastic.
Okay. Oh, that's excellent. Gurmeet, what a pleasure listening to these ideas from you. Sectorally, what would you be bullish on in 2025? Would it be still good to go with the winners of run with the, the winners of this year, the EMS e-commerce?
So one is the new age space, which I like. I don't think so. The Nifty of today reflects what India is going to be and how India is transitioning in terms of consumption, over the next few years. So we like the names like Zomato. I think Blinkit, the number of orders will go up from, maybe 10 lakhs to probably 20-25 lakhs in a very short period of time. All of them are doing fundraise, whether it is Zepto, Swiggy. Now Big Basket has just concluded a round of almost $1 billion. So here the winner takes all. So I think anybody who gets to 60% takes all. So I think that's one space we are extremely positive. And these dark store concept or hidden store concept, which basically uses technology, and they are pre-packed stuff. That is how it gets delivered in 15-20 minutes. So I think this is one space which looks interesting. Similarly, marketplaces like PB FinTech, I think look extremely interesting to us. We are tracking some more new age companies, in this space. And the other big theme would be healthcare. I think with or without biosecure law, I think pharma outsourcing will take bigger and forward strides as we go ahead. And I think this is more to do with geopolitical. Also, with the fact that US actually believes that the future of the warfare is biological warfare. So I think the opportunity is huge. Our market share is just 2%. So we are tracking a lot of names. We have Laurus Labs and Newland in the portfolio. There's a company which we like, which is Bliss Pharma, which actually makes suppositories. Suppositories are basically something which you give physically to patients who can't take medicines orally. So it's one of the large manufacturers of suppositories and pessaries there. Then we have more names like Hikal, which we are studying. So a lot of molecules are in phase 3, phase 4, where the commercialization rate is almost 50-55%. China's market share is in double digits. So this could be what our IT outsourcing moment in late 90s, the way healthcare is positioned right now over the next few years.
What have you made of easy trip planners? Perhaps have you ever tracked it? The Dishant Pitti, who held about a 49.81% stake when the company went public as per the RHP, is now looking to completely exit, step by step. He's already done a tranche before and now another 14%. And we understand so far he's not managed to conclude the block deal. So what have you made of, the way this has transpired?
So, we had some insights on it because some of the other founders who sold their company to Eastmatrip were our clients actually. So we haven't taken any exposure there, but obviously, promoter exiting, giving a large stake is always negative. In a market like this, but so I'm very gung-ho on the entire travel and tourism theme. I think there's a new index which we have in BSE, which is the travel and tourism index. Actually, people should track that. I think that's where the consumption wallet share is moving to. The other one is the digital consumption we are doing. The money we are paying for Wi-Fi usage, OTT, music apps, health apps. So, the consumption basket is changing, especially the urban one, and that is what to play. So for now, we have, Indigo in the portfolio. There's been the Gangwal stake sale is now mostly behind us. I think fuel prices have stabilized. Indigo is gaining market share. This year, they're already guiding for 15% growth in number of traffics, adding new routes. I'm amazed by the efficiencies they bring in. Somebody told me they got rid of oven in the flight, so each flight had 3 ovens. That led to a fuel saving of more than 1,000 crores a year. So I think on operational efficiency, I think it's amongst the best in the world. So that is something we are looking at some of the airport consumption plays. That's becoming a new luxury and consumption center. The airport model is changing, so we are tracking some of the names there as well.
Okay, that's a bunch of names and ideas. Gurmeet, always a pleasure listening to you. Thank you so much for hand-holding us all through 2024. Wishing you a brilliant 2025.
Thank you so much. Thank you, sir.
Okay, as we step into 2025, CNBC-TV18 has asked some key questions that you would like to ask experts. How will the Nifty perform in 2025? What are the sectors and themes to bet on? Will the faltering GDP growth revive in 2025? Will the Reserve Bank start cutting rates in 2025? We will ask, or we have already asked experts on your behalf. Stay tuned for the most comprehensive market poll that airs tomorrow on CNBC-TV18.
Sector is navigating a complex landscape of challenges and opportunities that they're seeing. While there are signs of recovery that is quite evident, sustained momentum will be a hinge on factors like funding, legislative support, as well as execution capabilities of these key players. However, could these stretched valuations limit the sector's ability to deliver significant gains in 2025? Let's watch out for that.
Well, 2024 will end as the best time behind for the banking sector. 2025 will mark the test of leadership at lending institutions as liquidity has remained tight. Asset quality has started to see deterioration. Thus, there will be pressure on net interest margin and return ratios like ROA or return on asset. So, incrementally, if you take a look, the loan growth is at 3-year low, and incrementally, the credit deposit ratio is at 3-year low too. So, even if you exclude the SDFC Limited numbers, the credit growth in this year so far has been one of the lowest in last 3 years, and the CD ratio is also at 3-year low. Now, deposit growth will be a key challenge because government spending needs to pick up for deposit growth to pick up as well. High inflation is keeping customers away from lenders. Managements are saying that corporates are wary of the high interest rates in high inflation scenario. SIP flows continues to be strong from retail segment especially. As per November data, the retail SIP has remained stable and on the higher side. Robust small cap investments have been done by retail investors. Now, what lies ahead? Managements do say that microfinance pain will continue till later part of 2025. Now, with asset quality getting over with respect to the pain in H1 CY25, it's the liquidity crisis that will slow down the loan growth for MFI players. Now, over leveraging is a key concern over there, which will cause huge pain in this sector. Unsecured loans have started to see pain. So many lenders have seen or bled in their Q2 FY25 results asset quality. Slippages are coming in from unsecured lending. We may see that pain continue in H2 FY25 as well, which has been highlighted by higher credit cost guidance given by lenders for the second half of financial year 2025. With growth in unsecured loans being
Welcome back. You may complain till kingdom come about not enough volumes in the market and so many people out for New Year parties and for year-end holidays. But there's one person who's always working the phones, always walking up and down D Street to get you the chatter of the day. Nimesh is with us, our pillar of support for market coverage. Nimesh, it has been a great 2024 for you. I can't even count on my fingers and toes all the stories that you have broken for us. But first, what are the insights you have got today from dealing rooms?
Thanks, Adana. It's been a good year, 24 for everybody, for the markets as well. And surprisingly, on the last day, the volumes have picked up. So that's a big surprise as far as the dealing room feedback is concerned. The volumes, the institutional volumes have picked up essentially because of there is a small market close basket buying is what I understand. So last 30 minutes, you'll see some impact of that volume. And also there is VWAP volumes on both sides at a leading FID. So that's going to add up to the volumes in the last 30 minutes of trade. So watch out for that sort of volatility. But having said that, for second day running, the PSUs are well bid. I spoke about PSUs selectively buying as well in yesterday's chatter, and it looks like that's got spilled over to today's market as well. So the CPC index is up nearly 1.5%. A lot of the PSU names are seeing a lot of buying interest from larger institutions. So that's overall feedback. From a range point of view, I still believe while earnings will be a big trigger to watch out for, but the Nifty is pretty much stuck between that range between 23,300 on the downside and 24,300 on the upside. So a decisive move has to come on either side once that's taken out. So that's the range for the January series. But surprisingly, on the last day of 24, the volumes have picked up, and there is a basket buying as well at a leading FI desk.
Is that, Nimesh, NAV management, or is it some kind of F&O play?
Well, difficult to say, Lata, whether it's an NAV management, because the size itself of the mutual fund industry has become very large. So I don't think it matters much. Of course, there are some stocks where some sort of buying would emerge essentially because of that. But net, I guess today's buying seems to be a genuine buy flow from the larger FIs as well as the mutual fund industry. So that's a combination of that. But difficult to say that it's only because of NAV management, Lata.
Okay, and Nimesh, did you manage to get any stock-specific tidbits for us?
Oh, yes, so the first stock on my list today, Rima, is Lupin. A big move in that name, and the volumes are on the higher side. The FI volumes have picked up as well. And I understand some domestic mutual funds are active buyers in Lupin of late, so almost at 52-week high. And still there is buying interest from domestic mutual funds in Lupin. So that's the first name. The second stock is Indus Tower. From yesterday's low, the stock is sharply recovered and the volumes have also picked up. But in Indus Tower, again, there is a strong buzz, an indication that there could be another large block in Indus Tower very soon. So need to check whether the institutional holders are a big seller in Indus Tower. So that's the second name. The third stock is GRP. Again, something which we don't talk too much about. I was just reading about the company, hardly an institutional holding. The volumes are very thinly traded as well. But now understand the company is very close to raising funds via QIP. So maybe for the first time, you will see institutional investors in that particular name as well. So that's something to track there. And the last is Sapphire Foods. While calendar last year, we'll order a lot about from QSRs. But this is one stock which has absolutely underperformed and been pretty much on the sidelines. But now I understand that it could be some corporate development in Sapphire and hence some bit of action in Sapphire as well in the last couple of days.
Okay, thank you very much for that, Nimesh. And hope you too have a superb 2025 and enrich us with all that you're picking up from the street. Okay, well, Nimesh spoke about Lupin. Clearly, that shot of hum insulin has helped a lot of institutional investors. But we have a big guest joining us.
Indeed, we've got Tushar Pradhan, the director of Hexagon Partners LLP, on the show with us on the last day of 2024. Tushar, thank you very much for joining in. So give us, briefly first, the outlook for 2025. It's hard to imagine that after 9 good years, positive years on the trot, that again in the 10th year will also give you the kind of returns that we've seen. Maybe not at the index level, but the kind of money that people have made in mid and small caps. What's your view going into next year?
Yeah, I think there is always a mean reversion to all markets, and we all get worried, especially the more statistically oriented, to saying that there has been 9 significant years of positive performance. So is this a year for where the mean reverts? It's a difficult one to call, but I think one has to again understand that the economics in terms of what we talk about where our country is positioned today vis-a-vis the rest of the world, I think it needs to be called out that we are in a much better position than most economies. if you say that, is it going to be a 10th year of positive returns? I think that is making me a crystal ball gazer, which I'm not. But I think if I look at earnings growth and what would the market support over the next few quarters, I think the earnings growth, if it continues to remain pretty much in double digit, we are going to have a reasonable positive year this year, would be my guess.
Okay. Hi, Tushar. Always a pleasure having you with us. Well, I know crystal ball gazing is not very easy, but I'm torn between two extremes. On the one hand, for all the defeatism and pessimism we heard in 2022 end and 23, there was no recession. I mean, far from it. The US economy churned out among its best GDP growth rates that we have seen in a long time. The Indian economy, yes, 5.4 may have been a disappointment, but overall, a 6.5 or 6.7% growth is to kill for in a world like this. So should we be go with those optimists? Or should we worry about the fall in urban consumption, which clearly stocks FMCG stocks? And right now I'm reading data about US credit card defaults jumping to their highest level since 2010. So unsecured loan seems to be everybody's problem. Which way would you tilt?
Again, as I said, I think we generally tend to make a overall prediction for the market as such. But the market is made up of many components, especially so very startingly in the US, where the Magnificent Seven seem to have led most of the gains in the market. And if you look at the rest of the 493 stocks, you will hardly find companies which are even near to the kind of returns that these seven have managed to make. And when you have a stock-weighted index which weights in favor of these large caps, especially in the US, you get the kind of return that we've seen. So it is not really the US market that we are talking about. And when we talk about the economy, it's much more broader. And people then try to look at a K-level recovery where there are a certain segment of companies which will do exceedingly well, no matter where the rest of the economy likely to go. I think in India, we will not have a similar kind of recovery. India is a lot more, I would say, homogeneous market. I think there are a lot of contributing factors which will lead to market progress here. And I am more optimistic that in India, there will be a more widespread, I would say, all-inclusive growth, as opposed to in the US, where it was sharply in favor of certain companies. In India, I think the game is really about increase in productivity. What we're going to see is not just pure earnings growth, but earnings growth coming out of significant technological inputs in terms of having companies perform better, which is a structural change. So I would vote for the fact that India will do well on the basis of pretty significant earnings growth coming in for this year as well as the next.
Tushar, so construct a portfolio for us starting 1st of Jan. For every 100 rupees that you have in terms of incrementally that you need to put in the market, how would you position it?
I think it's very important to understand that the financial part of our economy, which is going to drive the entire growth forward, has actually been lackluster in the last year. If you look at private banks, even if you look at certain public sector banks, they've not really participated in the kind of growth that we've seen elsewhere in the economy. With a significantly different balance sheet that we will see for them here, which is probably the lowest level of NPLs that we've seen in a decade. Pretty secure equity capital, as in adequacy, as we call it, and pretty benign interest rate scenario in the sense that we are not looking at a very sharp fall from here, which will indicate that their net interest margins are likely to be very, very, I would say, robust going in the future. Given the fact that they've really taken a lot off from valuations, I would definitely make financials a very large part of my portfolio to begin with. I will follow that up with companies which are export-oriented. We already have seen some sort of a indication of a strong dollar, what it means for the emerging market currencies. And I think as long as we then become a lot more competitive on the basis of the currency, or just the fact that your reported earnings will be so much more attractive when you have a falling rupee, I think that's my second bet. And that actually goes across sectors. And the third bet I would think would be on companies which are really focused on domestic manufacturing. because that is something that we've not really seen come through. We've seen capex done by public sector units. We've seen general government capex coming through, but we have not really seen the private capex take off. If any of that happens, we will see a lot in terms of process industries as well as manufacturing actually take off in India towards the last half of the next financial year. And I think that would be my bet to make up the third element of my portfolio. As a satellite part of the portfolio, where I would say, where else would you put your money apart from these three main sectors? I think I will take a selection of some pharma. I would take some, I would think construction along the way, because that is part of the game that I think the next year is likely to make.
Okay, that's most helpful, Tushar. For those who are building their own portfolios, that's a lot of good advice. Thank you very much for being with us through 2024, and hope you have a laughter-filled, fun-filled 2025.
Thank you. Thank you so much.
Okay, as we slip into a break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store.
And lenders following the same. Many lenders who have been focusing on unsecured lending like IDFC First Bank, RBL Bank, small finance banks especially, may see pressure on their return ratios as well. So the big area of focus will be the rate cut from the regulator. Inflation has been high and sticky as per economists. One can expect shallow rate cuts ranging from 50 basis point to 100 basis point in calendar year 2025. With lending rate cut being done, banks can see pressure on their net interest margins as lending rates will reduce for them immediately when the rate cuts happen. So while NBFCs may see improvement or stability in their net interest margin because their cost of borrowing from the banks will incrementally reduce, which is one of their key borrowing segment right now. Now, management terms are expected to end in 2025 for these banks like IndusInd Bank, Indian Bank, you have Bank of Maharashtra as well. Also, for Central Bank of India as well as Punjab and Sindh Bank. Over the last few years or 6 years or so, the gross NPA ratio difference between the PSU banks and private banks have narrowed from as high as 967 basis point to about 127 basis point at the end of calendar year 2024 so far. Similarly, the net NPA ratio difference has narrowed from 451 basis point that you saw in 2018 to right now about just 11 basis point in 2024 so far. Historically, this is one of the lowest net NPA ratio difference seen between PSU banks as well as private banks. So from CY 2018 to CY 2024, PSU banks gross NPA ratio has declined from 14.2% to about 3.15%, and net NPA ratio has declined from 6.25% to 0.62%. Private banks, their gross NPA ratio has declined from 4.5% to about 1.9%, and the net NPA ratio has declined from 1.74% to about 0.5%. Will RBI change its stance on lenders? Now, RBI has banned many products or entities in 2024. So, RBI did ban, Kotak Mahindra Bank's onboarding of customers via the digital and mobile customer application, as well as they have placed limits.
Welcome back. Let's talk about Easy Trip. The stock is under pressure today after the company's co-founder Nishant Pitti announced that he plans to sell his remaining stake via block deal. Hormus is here to tell us more on what the buzz is all about.
You know, there's always a way Easy Trip finds its way to be in the headlines. Now, be it the Maldives controversy or its foray into different businesses beyond its core business, there is a lot to talk about it. Now, let us take a look at the company and what is the latest that has brought it back into the spotlight. Now, news came in on Monday evening that co-founder Nishant Pitti, one of the promoters, plans to exit the company by selling his remaining 14% stake via block deals. However, today, only 1.2% of that stake has been sold, based on the data last checked. Now, at the time of its IPO, the shareholding in Ease My Trip was divided among Nishant, Prashant and Rikant Pitti. Now, Rishant and Nikant had majority of the shareholding, while Prashant had a negligible stake. Now, post its IPO in March 2021, Nishant and Rikant were down to 37% each, while Prashant's stake remained constant. Now, by June of 2022, both Nishant and Rikant gave 5% each of their stake to Prashant, taking his stake to 10.5%. Now, as of December last year, more than 65% of Nishant Pitti's 28.7% holding was locked up. Now, come March this year, that was over, and then came the selling. Now, in September, Nishant Pitti sold 14% stake in a block deal in what was an earlier plan to sell only 8%. Now, that fetched him a cool 920 crore rupees. Now, Pitti may have halved his stake, but who bought it? Did institutions buy it? Not really, because institutional shareholding in Easy Trip is nearly down to zero. Now, what started off at almost 6.25% at the time of its IPO 3 years ago, domestic mutual funds now have only 0.2% stake in the company. So who's got the stock? No prizes for guessing here. Retail. Now take a look at this. Now, similar to domestic funds, retail too started off at around 6% during its listing in March of 2021, and come December this year, that stake has gone up to 34%. So retail investors technically own 1/3 of the company. Now, in absolute terms, there were almost 50,000 retail investors in Ease My Trip during its IPO, and that number has gone up to almost 10 lakh by the end of December this year. Now, in January, Easy Trip had suspended bookings to Maldives following a diplomatic row, and a move that was later reversed in October. Now, however, during this period, the number of retail shareholders in the stock has doubled. The Ease My Trip has on numerous occasions dangled this bonus issue carrot to keep the retail flock interested. It announced a bonus issue in February of 22, another one in November, during which it also announced a stock split, and another bonus issue came in as early as October and November of this year. But have financials matched up to that? Not quite, because the profit at the end of FY22 stood at 24 crore. That number is still at 26 crore after making a peak of close to 50 crore. Now, Ease My Trip has also been in the news for its interests other than its core business, because earlier this year, Nishant Pitti, along with SpiceJet chairman Ajay Singh, submitted a 1,600 crore bid for the now defunct Go First. Pitti withdrew from this bid in his personal capacity in May, saying that he wanted to focus on the long-term vision of the company. Now, the company also announced plans in September to foray into manufacturing electric vehicles. A travel company making EVs would leave many question marks, but the kind of market that we were in back then, the stock went up 11% post the announcement, only to fall 6% the next day. So what next for Ease My Trip? Now, to be fair, there are multiple questions that need to be asked. Will Nishant Pitti be able to sell his remaining stake? 2, if he does manage to do that, will other promoters also follow suit? Will retail continue to pile into the stock on this lure of bonus issues and stock splits and so on and so forth? And lastly, all eyes will be on the December shareholding pattern that could be up anytime next month. Now, it's been 4 years since Easy Trip went public. It has had its moments, both good and bad, but the trip ahead is anything but easy.
Okay, that's a fascinating story that you're telling us, Hormuz. I mean, the kind of mistakes and the kind of lures that retail investors have been fallen to over the years. November, I mean, look at the bonus issue and the stock split. The stock fell from 73 rupees to 15 rupees practically in 1 month. It was all share dilution, but it was not shown in terms of profit.
Thank you, Hormus, for that. But just about 15 minutes left to wind down and bid adieu to 2024. Nagraj Shetty is now with us for a few BTST calls. Nagraj.
Yes, market has been in a range-bound action. Nothing has changed significantly over the last 30-40 minutes. And I'm staying with the main call of Ravindo Pharma on the Pharma, which has been outperforming since last many sessions. And one can look to buy BTST at the same levels I mentioned. Currently trading around the same level, 1335 level. One can place a stop loss of around 1290 and wait for the target of around 1430 odd levels. in the next day or two.
Okay. Nagaraj, thank you very much for that. That's the BTST trade coming for you, and here's wishing you a great 2025. Okay, the markets are on the verge of breaking into the green. The Midcap is still holding on to its green by the skin of its teeth. We take a break. On the other side, we will track the market technicals with Jay Bala of Cash the Chaos.
Card business due to deficiencies seen in Kotak's IT infrastructure. Now, RBI had raised material supervisory concern on Asirvad MFI, which is a subsidiary of Manappuram Finance. RBI intends to implement the expected credit loss guidelines from 1st of April 2025 to ensure that there is bank's financial stability, protect depositors' interest, assess the overall risk exposure and accuracy, reflecting the true value of bank's loans portfolio. Now, Project Financial, there may be additional provisions over there as RBI has stated in their draft regulations. So, this will be implemented in a phased manner, 2% by 31st March 2025, 3.5% by 31st March 2026 and to 5% by 31st March 2027. RBI has given new draft norms which states to increase the bank's liquidity coverage ratio by an additional 5%. Now, the runoff factor for retail depositors is a key cost, and this will also see that who are enabled with internet and mobile banking, that will see additional incremental over there. So, it may come into effect from 1st of April 2025 and may lead to short-term slowdown in credit and impact the net interest margin of the lenders on the negative side.
India is upgrading from approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25. Capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the general election-related restrictions. On the state government capex side, rising welfare spending is becoming a challenge. With the enforcement of the 3%.
Welcome back. We are into the last 10 minutes of trading actually, and there's a bit of green that you can see on the Nifty, just about flat. Let's invite the technical expert, Jay Bala of cashthechaos.com. Jay, always a pleasure having you with us. Thank you very much for sparing time. Well, people told us that there'll be dire consequences if Nifty went below the 23,500 mark. 23,300 is seen as a line on the sand. What's your sense? What can be the range for the first half of 25?
Hi, Lata. Good to be here and good to speak to you after a very long time. I've been maintaining since the end of September that the markets are heading towards the June 4th low, the post-election low of about 21,300 and change. So that's still the higher time frame objective, and the markets haven't done anything to disturb that or put that in question. So the very short term, the markets are either breaking the November low of 23,264 either straight away, or it's going to 24,100, which was the figure I had given last week. The market went to 23,900. So the markets are still, in line with breaking the November low. Reliance's underperformance continues to be a reason for caution.
Okay. Well, that's the kind of the support, if you please, as you say, 21,300. If you have to look at potential springing up from those lows, what kind do you think 2025 ends with gains? How much?
Yeah, fair question. As of now, I'm working with this being just a correction within the larger bull market. There were three options in front of me. One, I'm taking the least bearish view. For that itself could bring the market down to 21,300. The intermediate supports there on the way to 21,300 is about 22,600, and then 22,000, and then 21,300. But what could happen post that, we have to wait and evaluate. I anticipate the first half of 2025 to be negative. Post that, I anticipate a bullish resumption of the markets and go past the all-time high. But that is just a roadmap. I'm very flexible about it. I'm open to a deeper correction because the signal from the US markets is that the technology stocks have possibly topped, and it's due for a very sharp correction. If that were to happen, the IT index, which is not yet broken down, that could break below 41,000. So watch out on the Nifty IT index. 41,000 is very crucial. And as the signal from Bitcoin, a risk-off, risk-on measure, is signaling it's clocked a very important top. I've been pointing that out for the last 2 weeks. I think Bitcoin is likely to halve from the peak value of 108,000. So I'm anticipating about 49,000. So risk-off is the signal from the markets.
That's serious. If Bitcoin were to fall so much, then it is going to create ripple effects in all markets. Let's go stock-wise. The winners of this year in the Nifty, at least, has been Trent and M&M. Basically consumer discretionary, if you were a fundamental analyst. Are those continuing to be good bets in terms of charts as well?
Yeah, Trent has been an amazing stock, and I believe it's got a long-term potential, but in the short term, I think it's got corrective downsides to work with somewhere about 5,000 mark. So, it's got a little bit downside. And if you look at the India consumption index, it's got a reversal signature in the medium term. And I pointed out in October, the FMCG index, in my opinion, has clocked a very significant medium to long-term top. So the consumption space isn't actually very positive. I even pointed out the ITC might have clocked a very long-term top. So within that consumption space, things aren't looking bad. But Trent is looking like a very positive candidate within that space. It might be an outperformer there. And what is the other stock you said, Lata?
I asked for M&M, but okay, let me just rephrase. Instead of throwing stocks at you, tell us which stocks or sectors do you think are on the verge of an up move?
Yeah, I think I've been positive on Pharma, but Pharma as a whole isn't positive now. But right now, Sun Pharma, Lupin, they are looking like they'll be outperformers within the pharma space. But if you look at something like Dr. Reddy's or Supria, they might have, and Divi's probably, they might have clocked important top. But I've been bullish on pharma since 2020. So for the first time, I'm selectively turning bearish on some of the pharma names. But as I said, Sun Pharma, Lupin, and Laurus might be short-term outperformers.
Okay. Any long-term outperformer? What I mean is anything that looks like turning upward.
Yeah. I have two picks for today. Both are short-term, and I'm cautious on the long side. So play the long side with, if you normally play, say 1 lakh, you have to come down to something like 10,000. So basically, you have to come to 1/10 of your original position sizing. So with that in mind, I'm bullish on Godfrey Phillips, probably heading for fresh 52-week highs, along with the objective of 6,200 for the short term, and then higher on. Stop loss is 4,700. As far as other stocks which might turn up, I'm a just-in-time guy, so I'll wait for the markets to come towards the June 4th low and then reassess what are likely to turn up. But as long as the Nifty IIT index manages to hold above 41,000, there might be some winners there. TCS excluded. TCS is looking quite weak. I've been bullish on Coforge and Persistent. They're also coming to an important resistance and probably turning down for a correction. But if the markets were to drop like I anticipated, I'll try to turn bullish on the Nifty IT index.
Okay. This year, TCS is up only 9% and it's underperformed Infosys, which has seen a gain of close to about 20%. And this Q3 would be the third consecutive quarter where Infi's growth rate is expected to be more than that of TCS. But Jay, what about banks, especially large banks like HDFC, where investors are long-term bulls on it? Do you think technically there is support for HDFC Bank?
See, HDFC Bank has closed below an important level that I pointed out last week. That is 1816. And it should not have done that. And SBI, HDFC, and ICICI were the holdouts within the banking sector, which was the reason for outperformance for the banking space. But I think the banking index is set to break down because of HDFC and ICICI. ICICI is set to drop another 5% to about 1,200. HDFC probably dropping to about 1,600. But from a long-term perspective, this looks like a correction within a longer-term bull market. But HDFC could see a deep correction somewhere close to about 1,500 or maybe even 1,300 if things were to get a little more, shaky. But the medium to long-term trend is still up. Probably got one more long-term highs to clock. But before that, it's likely to see a correction to at least 1,500.
Okay. Jay, what about gold and silver? Since you spoke about Bitcoins, it just occurred to me. Gold was making a lot of money for people all the way up to maybe November, and then we started seeing a bit of reverses. How about in 25?
Yeah, the first 2 months are going to be very crucial for precious metals, Lata, because from a long-term perspective, that is mid-2026, I'm anticipating dollar index to clock about 123 to 126. So if that were to be the case, I think gold has already topped out, but that's not my base case. I'm anticipating gold to clock one more higher high, but that's subject to revision depending on what the dollar index does in the first 2 months. Silver, I'm a little more bearish. From a very short-term perspective, I'm anticipating gold and silver to first touch about 2,400 on COMEX, and then about silver to about 27 on COMEX. And then gold might recover to about fresh all-time highs of about 3,000 odds. But as I said earlier, it's subject to revision depending on what the dollar index does in the first 2 months. I'm very bullish on the dollar index. As I pointed out at the beginning of the year to Prashant, 2024 will go down as a year people underestimated the strength of the dollar index. That's exactly what happened. With a very short-term dollar index got one short-term higher high to about 108.85. It's likely to pull back to about 105.5. So if that doesn't happen and dollar were to strengthen much beyond, larger downsides in store for the precious metals.
Okay, 123 did you say for the dollar index? Oh my God, that's something else only. I don't know where it'll take the rupee.
Take us, and that is abroad.
Okay, you said it. Thank you very much, Jaimal. Have a great 2025. So we are winding up 2024 on the note that the Nifty's just about managed to clamber into the green on the last day of trading. It ends flat as flat can get at 23,600. That gives it what, some 8-9% gain for the year. But the Midcap index, although it is ending today at a flat, 57,100 thereabouts, is, however, going to end the year with a good 24% in terms of gains. And likewise, the small cap index ends the year with a good 26.5% in terms of gains. Well, what are the big gainers in the market itself today? Well, no prizes for guessing what are the big losers. Easy Trip clearly is the one that's lost about 7%. A lot of the Adani stocks have seen money being taken off. I guess they were all trading bets. Adani Wilmar is, of course, fundamentally driven. That's -6%. Adani Green -3.5%. Adani Energy 2.5%. Those are the main stocks. In Geo Financial down 2.4%. Adani Power another 2.4% down. But on the gaining side, IRB Infra has come out of nowhere, so I guess a lot of short covering has happened. Keynes is up 3%. BEL, big gainer in the index, BEL, ONGC, Gokuldas Exports, Kotak Mahindra Bank. Those were the stocks that saw very good gains as far as big caps are concerned. Anything you spotted?
Well, just to, wind down, the IT index was under pressure and all its constituents. The Nifty IT index down 1.2% for the day. Realty, financials also closing in the red, but the losses were not very high. On the way up, it was PSUs, particularly defense and oil and gas names. So these were the sectors where you had gains in excess of close to about 1%. Pharma continued with the rally, metals too, and metals and autos, in fact, saw a little bit of buying. But that wraps up the trading session for 2024. And 2024, you were wonderful, and we look forward to what 2025 has in store for us.
Just a word on the rupee. It was at 83 rupees when we started the year. We are now at 85.61 as we close. So about a 2% fall. But
it's still better than what the rest of the emerging markets currencies have fared, right?
Yeah, I wish it wasn't, because the cheaper it is, the better it is for domestic industry. But that discussion another day. Take your point on this being actually a rewarding year for the bulls.
Okay, but don't go anywhere, guys. I know you have a New Year party to celebrate, but on the other side of this very short break, we'll get your markets forward and prep you up for the 1st of January.
Likely to get even stricter, the rise in revenue spending leaves less room for capital investments. This means the heavy lifting will largely fall on the shoulders of the central government. Capex has been slow so far, and hitting the ambitious annual target will need a sharp 60.5% year-on-year growth. As per MK Research, the central government seems on track to meet its target, but the states might fall short by about 0.5% of GDP. Combined, the centre and state capex is expected to come in at 4.9% for FY25, a bit below the budgeted 5.4%. Nevertheless, as we step into 2025, the sluggish momentum seen is expected to now reverse. Another sign of this activity picking up is the sharp drop in the government cash surplus balance from 2.67 lakh crore in the first half of FY25 to just 28,300 crore by the end of November 2024. Since revenue spending is usually steady, this big dip likely points to a ramp up in large, lumpy capex projects. Private capex has been another crucial piece of this puzzle. Data from MK Research indicates that after bottoming out at 2.2% of GDP in FY22, it has now started to recover, reaching 2.9% in FY24. Cleaner corporate balance sheets with a leverage at over a decadal low, along with government initiatives like PLI schemes, robust order book in capital goods sector hint towards an upturn in private capex as well. So will 2025 truly be the year of capex? For now, the groundwork has been laid and 2025 holds immense promise. It's too early to say, but with the central government taking the lead and private capex showing green shoots, all eyes are on how the story unfolds.
Quite a year it has been for the Nifty, right, this time around. But there are some stocks that have made records, not necessarily in a good connotation. And we'll look at some of those. We start off with the index heavyweight, that is Reliance Industries. And with a 5.5% drop that this year that the stock has had, this may end up being the first year since 2014 that the stock has delivered negative returns. Now, yet, the street remains bullish and most analysts continue to have a buy recommendation on the stock. Price targets ranging anywhere between 1,350 to as high as 1,950 rupees on the stock. But on to the other company that we are talking about is Asian Paints, and it wasn't a bad year until the last quarter results, but since then the drop has taken it to be the worst calendar year on record for the company. Now, in fact, since 2010 the stock has delivered negative annual returns only thrice, and two of those years being 2022 and this year so far. Most analysts now have a sell rating on the stock, targets ranging from 2,080 rupees to as high as 3,750, but the stock is veering more towards the former right now. On the
Sensex and Nifty, the healthcare and pharma index is the best performer of the year.
Indian equities make a smart recovery to end flat on the last trading day of 2024 after yet another choppy session. IT stocks fell the most while healthcare and PSU stocks lent support.
Easy Trip falls after co-promoter Nishan Pitti looks to exit. Lupin gains 2% after it acquires an anti-diabetic medicine. In India, RVNL surges after bagging multiple orders from Indian Railways. Hello and welcome to a fresh new edition of Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I am Reema Tendulkar and with me is Vinny. Hi, Vinny.
Hi, Reema. Thanks for that. And last working day of 2024. But 2025 is going to be exciting. I hope so, as exciting as 2024. But today the markets also, range-bound was a range is the game. For this week at least.
But it's good to see the intraday recovery, right? The Nifty recovered about 180 points from the day's low to close flat. So at the session's low, we were down quite a bit, 180 points. The Midcap index ending absolutely flat. The Midcap, the Nifty Bank, though, was slightly under pressure, down close to about 0.8%. But you know what, guys? We're not looking at just today. We're trying to recap, the year gone by and get you up to speed with all the, the big action that we saw through the year. So let's straight away get to that. But before that, it's Hormus now, who is joining in to tell us how the markets fared in 2024, who were the outperformers, who were the laggards. Hormus.
You know, the Nifty ended with gains of almost 9% for the year. The bigger takeaway is the fact that it was the 9th straight year of positive returns for the benchmark index. None of my friends would talk more about specific stocks, so I'll highlight some of the sectors that were the standout this year in 2024. And particularly one sector is the Nifty Pharma index. And it is only in this last 1 month that the Nifty Pharma index has seen a really, really strong move. And the index has emerged as the best performing index of the year, up 40% this year. It's gained in 4 out of the last 5 years, and this is also the best calendar year returns since the year of 2020 that the Nifty Pharma index has seen. The similar performance is coming in from real estate as well. Another positive year for the index. It was up almost 80% last year, but a 35% gain on an 80% base is, of course, anybody would take it with both hands. And it has also gained in 5 out of the last 6 calendar years. Now, on the laggards bit, well, the FMCG index was a bit of a disappointment in today's session, of course, all through the year as well, be it the likes of HUL and the likes. The index was down only 0.5%, but it is only the first negative return that it has given since 2019. And the kind of moves that you have seen in the FMCG index is evident from the fact that since 2009, it is only the second instance that the index has given a negative calendar year return. Now, moving on to the broader markets, it was the mid-cap index and the small-cap index that were outperformers compared to the Nifty. The mid-cap index was up 24% this year, and it was the 5th straight year of positive returns for the index, and almost 70% of the index constituents ended with gains in 2024. And lastly, the small-cap index, another similar performance of 24%, outperforming the benchmark, and it has also gained in 4 out of the last 5 years. 2022 was a negative year for the small-cap index, but also 74% of the index constituents ended with gains. So overall, sectorally, there were a lot of pockets of opportunities. The pack definitely led by pharma and real estate.
Thank you so much for that. Pharma and real estate leading this time in the sector-wise in 2024. But let's get across to our guest for today. We do have Jay Bala of CashTheChaos.com as well as Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, joining in with us. Thank you so much, gentlemen, for joining with us as always. Last trading day of 2024. Interesting one in terms of the recovery, like Reema was mentioning as well. Jan, let's talk about today's day in terms of the recovery that we've seen coming in. What are we watching out for here in terms of the Nifty now? Is this going to be something in a range that we should watch out for in the next couple of weeks? What is it?
Fair question, Vinny. So we are looking at a range of about 24,100. Just like last week, the Nifty hasn't done pretty much from last Tuesday. So still the same range as projected. But if Nifty were to break the November low before coming to 24,100, I think we are in for a much quicker and sharper decline. Anyway, the medium-term objective remains, not medium-term objective, I would say a higher time frame objective, remains the June 4th low, the post-election low of about 21,280. It's either going to come with or without 24,100. If the markets are hitting higher, watch resistance at 23,900 and 24,100, and after that, on a stretch, 24,700. So these are the range to watch for the next 2 weeks.
Sudeep, the fall that we had starting October, we haven't quite recovered from it. We're still ending about 10% lower from our all-time peak levels that we hit towards the end of September, about 26,200 plus. What does that tell you about at least the near term going into Jan and Feb when there are so many cues that we have to navigate globally and even on the domestic front?
I think it's going to be a volatile market even in Jan Feb. Look, there are major events lined up. Of course, we have our budget, which is coming on 1st February. Then we have the RBI credit policy. So I think these two are big events as far as domestic markets are concerned. And of course, we have the US Fed on one side and many other central banks, including Japanese central bank, carefully looking at the rates in their respective countries. I have a little bit of apprehension as far as Japanese central bank is concerned, because at some point of time, I'm sure they are going to increase interest rates, and that may lead to some unwinding of carry trade, which will affect pretty much all the major global markets, including India. So a bit of incremental volatility can be witnessed if Japanese central bank increases interest rates at some point in time over the next 2-3 months. Beyond that, I think we will have to wait for the budget and the monetary policy to kind of really see which way the market will move after that. FIIs have been selling, and I don't see any reason why they will start buying in January, early January. Maybe the budget everybody likes and FIIs can come back, but I think we'll have to wait and watch that situation.
Okay, wait and watch that situation is the word coming in from Sudeep. But moving on, we'll also get you the top large cap gainers and losers in 2024. Abhishek is here to tell us all about that. Abhishek, over to you.
Trent has been the top performer. It has more than doubled its stock price for 2 consecutive years. So it has delivered positive returns annually since 2014. M&M is the other gainer. It has seen the sharpest rally in a calendar year since, in the last 15 years. So Bharat Electronics, the PSU defense heavyweight, that's gained about 58% this year due to robust government spending on defense and significant order inflows that they have had. Bharti Airtel has been delivering positive returns every calendar year since 2019, but in 2024 the return that they have given is the best since calendar year 2017. Now Sun Pharma has outpaced the industry benchmark. A superior ROE profile that you saw for the company this year has led to the stock price outperformance. Now coming on to the declining side, IndusInd Bank has been the top loser in the Nifty. The rise in slippages on unsecured lending and its exposure to the microfinance sector has weighed on the stock price. Asian Paints has seen its stock come under pressure this year, and that's been hit due to weak demand, margin pressure and rising competition that you are seeing from new entrants. So high food inflation has disrupted the consumption patterns across India, especially amongst mass segments of consumer. So India's FMCG sector is expected to rebound in 2025 after the fact that high costs, slowing growth and inflation impacted the stock performance this year. So Nestle, Tata Consumer as well as HUL, they saw their stock price decline in this calendar year anywhere between 12 to 18%. Back to you.
Thank you so much for that, Abhishek. But, let's talk about some of these names. And I want to talk about the FMCG names. Overall, when you look at Nifty FMCG, that was also among the top underperformers coming in there. While in terms of stocks also, top losers on Nifty 50 were HUL, Nestle, Tata Consumers coming in on that front. Sudeep, what are your thoughts on the Nifty FMCG side? What are we expecting this time in 2025? Some signs of rural recovery surely is coming in, but commentary hasn't been too upbeat so far.
Maybe I'm positive on FMCG for 2025. I think we have seen the worst as far as FMCG is concerned. Look, India is a country with 140 crore population. Some of these FMCG companies are very well managed. They had a kind of a perfect storm in 2024 when initially there was a challenge in rural demand, and when rural started picking up, urban demand slowed down. They also had input price inflation. They got hit from all the sides. But I think things have started improving. Rural demand is coming back. Urban demand, we are expecting it to be back as well. Inflation is coming under control. In some cases, raw material prices are kind of getting under control and are expected to further moderate in the near future. Considering that they have corrected significantly from the peak levels, and last year they were actually down by 0.5% as far as overall index, FMCG index is concerned. I think some of these stocks, from a long-term investor's point of view, become attractive from their portfolio point of view. So yes, we are positive, and selective buying in FMCG stocks is being recommended.
Sudeep, trend. It's been the big winner year after year. In 3 years, the stock is up 560%. How do you think it'll fare in 2025? Does it have legs to run more?
Well, as far as business performance is concerned, I'm sure it will continue to do well. The Zudio has been a running success, and they are getting into newer segments with artificial diamond and things like that. And I'm sure they will create a niche for themselves in these segments as well. But the valuation doesn't give me too much of a comfort as far as buying recommendation is concerned. So I will not recommend a buy at trend at these kind of multiples and these kind of valuations. But company performance is definitely going to be good, but may not be as good as is expected to retain this kind of valuation.
Okay, that's what we spoke about in terms of large cap companies, trend surely being the gainer coming in the last few years and last year as well. But what's happening in the mid cap space now? Vivek is here to tell us the list of top gainers and losers.
Well, when you're talking about the mid-cap space, some of the returns have been significantly outsized. In fact, the top mid-cap gainer has seen your money triple in just one calendar year. So the top gainer as far as the mid-cap index is concerned for 2024 was Oracle Financial Services, or OFSS. The stock went up 201%, indicating that it has slightly more than tripled the investment. The next stock on the radar is Dixon Technologies. Remember, the entire EMS team and Dixon, with multiple partnerships that is announced through the course of the year, saw the stock as well as valuations re-rate quite significantly. Over 2.7 times is what this particular stock returned for 2024. PB Fintech, despite the fact that the company saw significant news flow and saw significant volatility, ended the year significantly higher, almost 2.6 times higher. And BSE, remember, both exchange stocks did very well through the session, but BSE this particular year actually managed to end the year higher by 137%. RVNL topped out the list of top 5 gainers as far as mid-cap is concerned. The railway theme remained quite strong, and the stock gained over 135%. But on the other hand, there were quite a few stocks that also managed to erode shareholder wealth. Amongst the top laggards as far as the mid-cap index was concerned was Vodafone Idea, halving investor returns in just one single year. The other stock on the radar, of course, and most of these stocks are either from the banks or from the NBFC space with significant MFI or rural assets. And names like Bandhan Bank, AU Small Finance Bank, IDFC First Bank and Poonawalla FinCorp, all of them fell in the range of 28 to 34% in the last year itself.
Thank you very much for that. Jay, any mid-cap picks for 2025 over the near term and even over a medium term?
I'm still waiting for the markets to complete a correction, but out of the picks that have been highlighted here, I think PB Fintech and BSE Limited, they might still have short-term upsides to work with. They probably haven't completed their highs for 2024, so they might clock fresh 52-week highs in 2020, early part of 2025, but that will be an important medium to long term. That could be, I won't say that will be. But so, yeah, from a very short term perspective, slightly bullish on PB Fintech and BSE Limited.
BSE and PB Fintech from short-term perspective, hoping for good moves there. Thanks so much for that, Jay. And thank you, Jay, as well as Sudeep for joining in with us on the show. Now, with that, it's time for a very short break. We'll get you the top corporate voices and more news on the other side.
Trent has been a wealth creator and a giant wealth creator at that, and it is also the top performer on the Nifty this year. The stock doubled last year, the stock has doubled this year as well, and starting 2014 the stock has had positive returns every single year. The street continues to remain bullish on the stock with price targets with as high as 9,350 rupees. Mahindra & Mahindra is a turnaround story. The stock has had its best year in terms of returns since 2009. The stock is up 70% this year as well, and only 3 negative annual returns in the interim between 2009 and this year. The street remains constructive, targets of anywhere between 2,700 to 3,700 on the stock. Now HDFC Bank, positive returns every year since 2013, but 3 of those last 4 years are returns in single digits. Yet no analyst on the street has a sell rating on HDFC Bank, with price targets ranging up to as high as 25.50. Now FMCG is a sector that is disappointed as a whole this year, and HUL is among those disappointments. A 12% drop here, which has made it the worst calendar year so far since 2004, and yet has delivered negative returns only 4 times since 2007. The street though is optimistic, analysts giving targets of up to 30.
Welcome back to Markets Forward on CNBC-TV18. Now let's shift focus to Easy Trip. The stock is being under pressure today after the company's co-founder Nishant Pitti announced plans to sell his remaining stake via block deals. Urmaza joining you with us to tell us more on what all is happening in the stock and why.
There's always a way Easy Trip finds its way to the headlines, right? Be it Maldives or foraying into different businesses. There is a lot to talk about it. And this time around, news came in on Monday evening that Nishant Pitti, who is one of the co-promoters, planned to sell his remaining stake via block deals. That was the remaining 14% stake. However, only 1.2% of that stake was sold in today's session. Now, based on the data last checked, now at the time of its IPO, the shareholding in Easy Trip was divided among Nishant, Prashant and Rikant Pitti. Now, Nishant and Rikant had majority of the shares, while Prashant had negligible shareholding. Post the IPO, Nishant and Rikant's stake fell to 37%, while Prashant's stake remained constant. And by June of 2022, both Nishant and Rikant gave 5% of their stake to Prashant, taking his overall stake to 10.5%. Now, as of December last year, more than 65% of Nishant Pitti's remaining holdings was locked up. And come March this year, that was over. And in September this year, the selling began when Nishant Pitti sold 14% in that block deal, in what was an earlier plan to sell only 8%. Now, that fetched him a cool 920 crore rupees. Now, Pitti may have halved his stake, but who bought it? Not the institutions for sure, because the institutional holding from almost quarter to 7% at the time of its IPO is down to nearly zero. Now, but who bought it? Well, no prizes for guessing. It was retail. Now, take a look at this. Similar to domestic mutual funds, retail also began at around 6% at the time of its IPO. That stake has gone up to almost 34%. Now, retail technically owns 1/3 of the company. Now, in absolute terms, where there were 50,000 retail investors in Ease My Trip during its IPO, that number has gone up to almost 10 lakh by December this year. Now, in January, Easy Trip suspended bookings to Maldives following a diplomatic row, a move that was later reversed in October. However, during this period, the number of retail shareholders in the stock has doubled. Now, Ease My Trip on numerous occasions has dangled this bonus issue carrot to keep the retail flock interested. They announced a bonus in February of 22. They announced another one in November. At the same time, they announced a stock split as well. And a recent bonus issue came in as early as October and November this year. Has the financials matched up to it? Well, not really, because the profit at the end of FY22 was 24 crores. Now it's 26 crore after making a brief peak of 50 crore. It has also been in the news for other interests other than its core business. Now, earlier this year, Nishant Pitti, along with Ajay Singh, the SpiceJet chairman, submitted a 1600 crore bid for the now defunct Go First. He withdrew from that bid in his personal capacity in May, saying that he wanted to focus on the long-term vision of the company. Now, he also announced plans to, in September this year, to foray into manufacturing electric vehicles. Now, a travel company making EVs would leave many question marks, but then the kind of market that we were in back then, the stock went up 11% post the announcement, only to fall 6% the next day. So what next for Ease My Trip? There are multiple questions to be asked. Will Nishant Pitti be able to sell his remaining stake? If he does so, will the other promoters follow suit? Will retail continue to pile in because of the bonus and the dividend and so on and so forth? And lastly, focus will be on the December shareholding pattern that should be up anytime next month. Now, it's almost been 4 years since Easy Trip went public. It has had its moments, both good and bad, but the trip ahead is anything but easy.
Thank you very much for that. Very well explained. Now let's move on to the other big standout feature of 2024, and that's been the capital raise frenzy that we've seen. Yash joins in to tell us a little more, because this year we've seen Indian companies raise a whopping 3.5 lakh crore via 438 issuances. Yash?
Well, it's been a fantastic year when it comes to fundraising through Indian capital markets. As you said, the headline remains to be a total fundraise of about 3.5 lakh crore through a total of 438 issuances. Speaking about the main board IPOs and the fundraising there, companies have raised about 1,62,800 crore via IPOs in 2024. The weighted average listing premium of these companies stood at an impressive 31%. Speaking about the SME IPO market, issuances increased from just about 109 in 2022 to 235 in 2024, and the amount raised through these SME IPOs jumped from about 1,900 crore in 2022 to 8,600 crore in 2024. Companies have raised a total of 1,13,100 crore via QIPs also in 2024, and names like Vedanta as well as Zomato led that charge on the QIP front. Overall, record high year for the funds raised via IPOs as well as QIPs in 2024. Let's have a quick look at the overall trend, which will include IPOs, FPOs, OFS, QIP as well as rights issue. And the numbers are 2024 versus 2023. Main board IPOs, amount raised was up 2.3 times. The number of issues were up 60%. SME IPOs, the amount raised was up 87%. Issues up 31%. OFS, the amount raised was higher by about 64%. Number of issues are flat. QIPs, the amount raised was 63% higher. Number of issues 11%. Rights issue, though some disappointment there, the amount raised was down 39%. Number of issues still up about 8%.
Okay, thank you so much for that, Yash. But before we wrap up this edition of Market Forwards, we get to some of the key corporate voices. First up on the list is Microfinance. The company says it would remain conservative on the growth estimates. Also, the NBFC will be looking at new sources of funds. Further, it expects loan growth of 15 to 20% in FY26.
Supria Life Sciences maintains its revenue guidance of 22% on an annual basis. On the subject of China, the management said it's not worried about competition coming from China, despite 89% of its sales coming from exports.
That's not all. Vinty Organics guides for a 20% revenue growth in FY26 and FY27. In FY26, it expects its EBITDA margins to be around 26%. Meanwhile, the company is facing trouble from China due to its dumping policy, but it's expecting some relief due to government intervention.
With that, it's a wrap on the last edition of Markets Forward for this year. But don't go anywhere. We'll be back with more news and updates on the other side.
Staying with consumption, Titan is set for its first negative calendar year after 2016. And since 2016, the gains have ranged between 10% to as high as 150% on the stock. The street, though, expects the stock to touch as high as 5,000 rupees, but the bears keep it at as low as 2,800. And rounding off this consumption theme is Nestle. If HUL was the worst year since 2004, this is the worst year for Nestle since 2002. And the MNC has given negative calendar year returns in these 5 instances. But most analysts have a hold or a buy rating on the stock, price targets ranging close to 2,900 rupees. Now, banks make an appearance here with IndusInd Bank, positive returns in 22 and 23, but the worst performer on the Nifty this year, down 40%, and is the 5th time in the last 7 years that the stock has had negative returns. Yet, 37 analysts continue to maintain a buy rating on the stock, targets ranging up to 1,950 rupees. And lastly, despite all the news flow, Adani Ports, news flow this year and last as well, Adani Ports has managed a positive calendar year return, the 5th time in a row that it has done so, and analysts too have a near consensus buy rating on the stock, targets ranging close to 2,000 rupees a piece. So the Nifty may have had a 9% return so far this year, but it is specific stocks that have grabbed headlines, some good, some not so.
Well, the consolidation theme continued to play out in 2024. With 40 million tons of capacity folding up into the hands of Adani Cement and Ultratech. And over the years, Adani's foray into the cement space with a massive war chest has acted as a catalyst, triggering the race for capacity share, which has increased the competitive intensity. The top 5 players now account for more than 60% of the market. That compares with only around 40% 7 years back. The question is, will consolidation slow down from here on? Remember, the recent deals have been concluded at around $100 per ton mark. That's closer to replacement cost. Well, ICICI Securities says that cement majors like Ambuja as well as UltraTech, they have exhausted most of their cash reserves post the recent acquisitions. They add, except for a few NCLT cases, they believe that low-cost acquisitions are largely behind. And now the potential deals may command a significant premium to the replacement cost. That could make them much more unattractive on borrowed funds at low cement prices. Well, the pain point is elevated competitive intensity has led cement prices plunging to 4-year lows. Demand as well has been plagued by general and state elections, heavy rainfall in few regions of South India, the construction ban in NCR region, and also labor unavailability in various parts of the country. But part of the street is optimistic that cement sector has hit rock bottom and it's ready to fight back. Well, Jeffrey says that dealers suggest that price declines have bottomed out. And now the industry is attempting price increases every month. They believe that the recent increase in industry consolidation further supports a case of revival in cement prices. Though sustainability of the price hikes will depend on what the leaders prefer, volume or price increases. Well, Goldman says that their channel checks suggest that demand is recovering, though on a low base. With the expected pickup in government capex, rural demand is likely to improve, and urban real estate market, well, that's doing well as well. So they expect that cement demand will grow by around 7% in FY26. On the profitability aspect, well, INCRED says that lower fuel cost, improvement in volumes, that could lift EBITDA per ton by around 160 rupees on a sequential basis. Though they
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Indian equities end flat on the last trading day of 2024 after yet another choppy session. For the full year, the Sensex and the Nifty end 9% higher, but the Midcap index gains more than 24%. The small cap index is up over 29%. Healthcare and Pharma are the best performers of the year. The rupee remains weak as importers buy dollars to meet month-end and year-end obligations. The domestic currency ends 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025. Most respondents don't see bond yields going below 6.5% in the coming year. Easy Trip Planners shares fall after co-promoter Nishant Pitti announces plans to deboard the company by selling his remaining 14% stake via block deals. However, only 1% equity changed hands in today's session. Pitti had sold 14% stake back in September as well for 920 crores. Ather Energy's IPO gets a green signal from SEBI, the second EV player to drive into Dalal Street after Ola Electric. Ather is looking at raising close to 4,000 crores. This would be a mix of a fresh issue and an offer for sale. 2024 has been a blockbuster year for IPOs with a mop-up of close to 1,60,000 crore rupees. A landmark year for cryptocurrencies as the Trump victory gives it wings. Bitcoin blazes ahead, shatters the $1 lakh threshold, surges close to 140%. Meme coins and altcoins steal the show. Cryptocurrencies' total market cap now at $1 trillion on the last day of the year. The U.S. Treasury Department accuses a China-backed hacking operation of tapping into workstations to steal unclassified documents earlier this month. Calls it a major incident. China denies the allegation, slams what it calls the spread of false information for political purposes. The United Nations accuses Israel of systematically blocking aid to Gaza. The World Health Organization says hospitals have become battlegrounds as 2024 draws to a close. The death toll in Gaza stands at more than 45,500 people. Poor air quality in Mumbai prompts civic body to impose a ban on construction along with other measures. No construction activity will be allowed in areas where the air quality index is more than 200. All of that and more coming up in just a bit. But first, the market action of the day. It was a flat close to 2024 after another choppy session. IT stocks were the biggest drags in trade today, while healthcare and PSU stocks offered some support. So that's the Nifty closing 2024 absolutely flat. The Sensex down 100 points, 633 lower on the Nifty IT. The PSU Bank Index was up by almost 1% today. But overall, a positive end to 2024 with the Nifty extending its gains. For the year, the Nifty is actually up by about almost 9%. The Sensex and the Nifty both have ended with gains of 9%, each delivering single-digit returns for the second time in 3 years. That is the Sensex up by about 8%. The Nifty Bank underperformance continues. The index has underperformed the benchmark Nifty 50 for the second year in a row. Sample this. In the last year, the Nifty saw returns of nearly 9%, while the Nifty Bank rose just 5.5%. So that's the Nifty Bank up by about 5%. In 2023, Nifty saw 20%, but the Nifty Bank only gained 12%. Now, let's talk about some of the other aspects of the market, but onto the money markets now, where the rupee remained weak as importers bought dollars to meet month-end and year-end obligations. The domestic currency ended 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025, but most respondents don't see bond yields going below 6.5% in the coming year. Lata is here now to map up the macros in 2025. Lata, take us through what the poll is telling us.
Well, the Indian rupee will slide to 86.25 by March 2025 and to 87 by the year end. That's according to a poll of economists and bank treasury heads done by CNBC-TV18. Treasury heads, of course, varied in their levels. The range for March for the rupee was 85.40 to 86.5. But for the year, the economists' forecasts lie between 86.75 and 87.5. That's by December 31. An overwhelming majority expect a rate cut in February, taking the repo rate to 6.25 from 6.5 today. But that will move the 10-year bond yield only a bit to 6.7%, bankers told us. By the year end, however, the hope is equally divided between those who see one more rate cut and those who see two more rate cuts. So the repo rate could be at 6% or could be at 5.75, 50-50 vote on that. However, the 10-year bond yield is not seen going below the 6.5% mark in 2025. GDP growth is on an average seen at 6.4% for FY25, with the range of forecasts being 6.3 to 6.5, while the FY26 growth is seen at 6.6%. Again, the range here is 6.5 to 6.8%. Inflation in the current year, FY25, is seen averaging 4.8%, which is the Reserve Bank's forecast. For next year, that is FY26, the poll shows that CPI inflation may average between 4.4, around 4.4%. The range is 4.3 to 4.5%. Finally, the current account deficit is seen at 1.35% this year, FY25, and 1.2% next year, which is very much within the Reserve Bank's comfort zone. All told, prepare for at least a 2% depreciation of the rupee and a slightly downbeat growth. Of course, that will mellow inflation, and don't expect aggressive fall in bond yields.
All right, Lata, many thanks for joining us. That's the Indian macro outlook for 2025. Now, the rupee will slide to 86.25 by March 2025 and by 87 by the year end. That's according to a poll of our economists and treasury heads. As you just heard Lata take us through that. Now, let's talk about some of the other aspects that we are looking at as far as the outlook for 2025 is concerned. As far as the repo rates are concerned, and GDP growth on an average is being seen at 6.4%, with the range of forecasts being 6.3 to 6.5%, while the FY26 growth is being seen at 6.6%. Again, the range is 6.5 to 6.8. Inflation, the current year, is seen averaging 4.8%, which is the RBI's forecast for the next year. The poll shows CPI may average 4.4%. The range of expectations is 4.3 to 4.5%. Finally, the current account deficit is seen as 1.35% this year and 1.2% next year, which is very much within the RBI's comfort zone. All told, prepare for a 2% rupee depreciation and a slightly downbeat growth, mellowed inflation and no aggressive fall in bond yields. On to IPO corner. Ather Energy has received the final nod from market regulator SEBI for its IPO. The public issue comprises a fresh issuance of shares worth up to 3,100 crore rupees. The issue also includes an offer for sale component of up to 2.2 crore shares by existing shareholders. With this IPO, the company will become the second EV maker in India to go public after Ola Electric. SEBI has also given the green flag to 5 more IPOs. These include Schloss Mangalore, which operates the well-known hospitality brand Leela Hotels. They're looking to raise around 5,000 crore rupees. Others on the list are 1,000 crore rupees worth Oswal Pumps IPO and Quality Power, which plans to raise around 300 crores. The regulator has also given the nod to engineering solution provider Fabtech Technologies and technology service provider iValue Info Solutions. So those are some of the IPOs to watch out for. Aerospace component manufacturer Unimech Aerospace made a strong debut on the last day of the calendar year. The stock listed on the exchanges at a premium of 86% to its issue price of 785 rupees a share. The company's market value is close to 7,000 crore rupees. Its IPO received robust investor response, being oversubscribed 175 times when the bids closed on Thursday. Now, Ease My Trip shares fell close to 10% in trade on the back of reports that co-promoter Nishant Pitti was planning to sell his remaining 14% stake via block deals. Remember, Nishant Pitti in September had divested nearly 14% of his stake for over 900 crore rupees. Hormuz is standing by now to take us through the curious case of what's going on at Ease My Trip. Hormuz, Nishant Pitti looking to deboard Ease My Trip. How's it likely to impact the company?
Now, there's always a way Easy Trip finds its way to be in the headlines. Now, be it the Maldives controversy or its foray into different businesses beyond its core business, there is a lot to talk about it. Now, let us take a look at the company and what is the latest that has brought it back into the spotlight. Now, news came in on Monday evening that co-founder Nishant Pitti, one of the promoters, plans to exit the company by selling his remaining 14% stake via block deals. However, today, only 1.2% of that stake has been sold. Now, based on the data last checked. Now, at the time of its IPO, the shareholding in Ease My Trip was divided among Nishant, Prashant and Rikant Pitti. Now, Rishant and Nikant had majority of the shareholding, while Prashant had a negligible stake. Now, post its IPO in March 2021, Nishant and Rikant were down to 37% each, while Prashant's stake remained constant. Now, by June of 2022, both Nishant and Rikant gave 5% each of their stake to Prashant, taking his stake to 10.5%. Now, as of December last year, more than 65% of Nishant Pitti's 28.7% holding was locked up. Now, come March this year, that was over, and then came the selling. Now, in September, Nishant Pitti sold 14% stake in a block deal in what was an earlier plan to sell only 8%. Now, that fetched him a cool 920 crore rupees. Now, Pitti may have halved his stake, but who bought it? Did institutions buy it? Not really, because institutional shareholding in Easy Trip is nearly down to zero. Now, what started off at almost 0.25% at the time of its IPO 3 years ago, domestic mutual funds now have only 0.2% stake in the company. So who's got the stock? No prizes for guessing here. Retail. Now take a look at this. Now, similar to domestic funds, retail too started off at around 6% during its listing in March of 2021, and come December this year, that stake has gone up to 34%. So retail investors technically own 1/3 of the company. Now, in absolute terms, there were almost 50,000 retail investors in Ease My Trip during its IPO, and that number has gone up to almost 10 lakh by the end of December this year. Now, in January, Easy Trip had suspended bookings to Maldives following a diplomatic row, and a move that was later reversed in October. Now, however, during this period, the number of retail shareholders in the stock has doubled. The Ease My Trip has on numerous occasions dangled this bonus issue carrot to keep the retail flock interested. It announced a bonus issue in February of 22, another one in November, during which it also announced a stock split, and another bonus issue came in as early as October and November of this year. But have financials matched up to that? Not quite, because the profit at the end of FY22 stood at 24 crore. That number is still at 26 crore after making a peak of close to 50 crore. Now, Ease My Trip has also been in the news for its interests other than its core business, because earlier this year, Nishant Pitti, along with SpiceJet chairman Ajay Singh, submitted a 1,600 crore bid for the now defunct Go First. Pitti withdrew from this bid in his personal capacity in May, saying that he wanted to focus on the long-term vision of the company. Now, the company also announced plans in September to foray into manufacturing electric vehicles. A travel company making EVs would leave many question marks, but the kind of market that we were in back then, the stock went up 11% post the announcement, only to fall 6% the next day. So what next for Ease My Trip? Now, to be fair, there are multiple questions that need to be asked. Will Nishant Pitti be able to sell his remaining stake? 2, if he does manage to do that, will other promoters also follow suit? Will retail continue to pile into the stock on this lure of bonus issues and stock splits and so on and so forth? And lastly, all eyes will be on the December shareholding pattern that could be up anytime next month. Now, it's been 4 years since Easy Trip went public. It has had its moments, both good and bad, but the trip ahead is anything but easy.
Well, those are the big questions. Many thanks, Hormuz, for joining us. We will head to a break, but up next, Donald Trump supports H-1B visas, backing Elon Musk's stance, even as Republicans remain deeply divided. Musk also adds that the visa program is broken and needs reforms after saying he will go to war over the issue. Parikshit will join us to discuss the H-1B visa row on the other side with former Ambassador Meera Shankar and Shivendra Singh of NASCOM.
It will still be down by around 200 rupees per ton. Axis Capital says that cement spreads are on recovery path. It's at the highest levels we have seen since January 2024. They add that spot spreads are now 12% higher sequentially, though it's still down by close to around 5% on a year-on-year basis. So 2024 has been a brittle one, both on pricing and demand. The hope is that 2025 cement will be in far better shape and it could deliver a far steadier performance.
For the second year running, Tamil Nadu stood out as India's top exporter of electronics goods. At $9.56 billion in FY24, the state's value of electronics exports was double than that of Karnataka and Uttar Pradesh, and the export orders it has received between April and September 2024 are already above $6 billion. In April, Tamil Nadu not only secured the pole position in electronics exports for the previous fiscal, but also registered a whopping 78% growth over its own numbers in the previous year. Incidentally, the state accounted for $9.56 billion in electronics exports out of a total national electronics export order value book of $29.12 billion. This meant that the state approximately accounted for 1 out of every 3 rupees that India earned in electronics exports through all of FY24. So it comes as no surprise that the state's electronics sector repeatedly made headlines through the year. Investments from Salcom, Pegatron and Foxconn fructified, and as their plants commenced production, they added extra thrust to the state's export engine. And in September, American communications major Cisco launched its first Indian plant in Sriperumbudur in partnership with global electronics manufacturer Flex.
Cisco's partnership and the announcement made a huge difference, not just for Flex in India, but also in industry in itself. High technology products, highly skilled workforce, labor force, as well as the talent. And last but not the least is the manufacturing ecosystem, which means the supplier ecosystem as well.
It's this strong and fast-growing supplier ecosystem that the state government is banking on to fuel the brisk growth in electronics exports. It hopes the number will cross $12 billion in FY25, and that's just for starters.
The already existing infra will take us to 12 now, but what we are seeing.
Welcome back. You're watching Business 360. We're seeing a major political row in the United States over H-1B visas. This has sharply divided the Trump camp, and staunch Republicans are hitting out at Tesla CEO Elon Musk and billionaire Vivek Ramaswamy for supporting the H-1B visa program, which is used by skilled professionals to work in the United States. While Musk and Ramaswamy have backed H-1B visa programs, saying it helps America hire the best of American talent, many Trump and Republican supporters believe it undermines America first and American workers. In fact, the appointment of Sriram Krishnan as the White House policy advisor on AI has also not gone down well with the Make America Great Again camp, with many calling him an India First supporter. For now, Donald Trump, the president-elect, has backed Musk and said that he likes H-1B. So what could possibly happen in Trump's second term, considering denials of H-1B petitions went up from 13% in 2015 to 24% in 2018. They fell to 4% by the end of the first year of the Biden administration. Joining us right now are Shivendra Singh, Vice President, Global Trade Development Department at NASCOM, Meera Shankar, former Indian ambassador to the US. Thank you very much for joining us, ladies and gentlemen. Ambassador Shankar, let me begin by asking you, we had seen a sharp increase in denials of H-1B petitions during the 4 years of the Trump regime, Trump 1 regime. How do you think things are placed right now, considering the strong divisions in the Trump camp and strong rhetoric on immigration? Do you expect the Trump camp and the Trump administration to go down harder in curbing the H-1B program or making it more expensive to get foreign workers?
Because you've seen Musk's subsequent statements also. After he backed the H-1B visa program, he now says the program is broken and needs major reform. And amongst the major reforms he has suggested is increasing the wages which have to be paid to H-1B workers, so having a ceiling, a higher wage ceiling, imposing a yearly fee for issue of H-1B visas, in all making it more expensive for the US to hire foreign experts under the H-1B visa program. So we have to see where the final consensus emerges. Clearly, my sense is that the H-1B visa program will not be done away with because it is economically crucial to many US companies, and a large number of the H-1B professionals who go from India are taken up by US multinationals like Elon Musk's Tesla or SpaceX or Microsoft or Google or IBM. So it is not Indian companies. Indian companies do have recourse to the H-1B visa program, but amongst the largest users of the H-1B visa program are American companies. And most of them would be rooting for continuation of the program. So if push comes to shove, and you have, a political base which is riled up about immigration, and on the other hand, you have economic necessity because there's a shortage of talent in the US, particularly in engineering and the sciences, then I think President Trump has made it clear right now that he will plump for economic pragmatism. But continuation of the program does not mean that new conditionalities may not be attached to the program. And these may have the effect of making it more difficult for our companies to hire people on H-1B visas. See, US companies have deep pockets. They can pay higher wages. As it is, most Indian nationals who are there on H-1B visa programs have already a fairly high wage level as compared to the average US worker. So I think we have to wait and see where the consensus on this arises. But I think we should also be active in getting across that this program actually helps the competitiveness of American companies and therefore would be crucial to make America great again.
That's a very important point. And Shivendra, if we can come across to you, we saw how the NASSCOM president recently said that any curbs on the H-1B program may actually lead to a lesser flow of talent from India to the United States. But at a larger level, what has been your dialogue with the Indian government and also to the US government on the matter?
Well, thank you. And I absolutely echo what Ambassador said on this one. It is beneficial to the US economy, and the H-1B workers play a very critical role in making US the #1 economy. Now, let us look at a bit of the rationale behind H-1B, while there is a lot of discussions and perspectives around it floating right now. I think the rationale is that it fulfills a very critical, bridges a very critical skills gap that exists in the US ecosystem. And with AI and new emerging technologies, this is going to increase. And around the world, we are faced with this challenge, including the US. And there are a lot of misperceptions, as we know, and I just wanted to clarify on a few of them. First of all, we hear that it displaces American workers, it leads to unemployment, the wages that are being paid are lower, and it suppresses US worker wages. Now, all of these are absolutely untrue. When we look at displacing American workers, it's a minuscule. In fact, 85,000 can be, put into one stadium for a workforce. So it does not really have an impact on that in terms of total numbers. Secondly, if you look at numbers of unemployment right now in computer occupation, it's just about 2.5%, which is close to zero unemployment in this area. And even USCIS numbers on wages, when you look at it, the median wage is about 122K, and the average wage is about 132K US dollars, which is more than what is expected to be in terms of the prevailing wage or comparable US workers in that area. So that is also not true. And when you look at suppression of US workers' wages, there are various pieces of research which are done, which point to a figure of more than, US workers with computer occupation having earned more than 10 to 40% compared to other non-STEM workers. Now, if that is the case, how is it suppressing that? So I think the value is...
I'd like to take some final questions. Could you also tell me, how do Indian IT companies stand to lose, or how do they get impacted if there are curbs on the H-1B program? If getting an H-1B gets more expensive, there is a higher fee, there is a maintenance fee as Elon Musk is asking for. How will this directly impact some of the big IT companies in India like Infosys?
So look at the current numbers. Even today, when you're looking at numbers, a company has to pay nearly $39,000 to $50,000 extra in the whole process. And I don't know how many of you are aware that there is a $600 asylum fee linked to the H-1B visas, which is absolutely unrelated. There is no relation to an asylum fee to an H-1B visa. So in any case, there is a pretty high barrier in terms of raising the fees to get H-1Bs. For us as NASSCOM and the discussions that we've had with our government as well as with the US side, we consider this to be a trade issue and not an immigration issue. And that is where we have to very clearly define it, because at the end of the day, it's a market access issue where you have problems in fulfilling your business requirements, because it does not affect your net migration numbers to the US. And we are absolutely clear, for immigration, the government has an absolute right in doing whatever it wants to do. But as far as this is concerned, H-1B is a non-immigrant visa, which is bridging a critical skills gap. And our companies, as an industry, we've spent more than $1.1 billion in local upskilling in the US, working with more than 2.9 million students to develop skills locally. Now, till that time, the gap is there. H-1B will continue. We are all for local hiring, but the bridging of the gap.
Shivendra, we've completely run out of time. We'd like to thank you and Ambassador Meera Shankar for joining us on this important topic. Clearly, as Ambassador Shankar said, we need to be had in close dialogue with the US government on this issue. With that, it's a wrap of this edition of Business 360. More news and updates right here on CNBC-TV18.
Down the value chain coming in, more components down the value chain, the entire supply chain probably, if possible, of Apple is something which we are all looking at. But the next year would be, we are looking at really bigger numbers. Right now we are at 35% of India's output, right? We would definitely want to go up.
The groundwork for this is already in place. In January, Tata Electronics announced an investment of 7,000 crore rupees towards expanding its components plant in Hosur. Further, Taiwanese electronics major Foxconn has committed 13,000 crore rupees in further investments, and US-based Jabil has promised 2,000 crore rupees. This means Tamil Nadu will soon host 4 of the biggest global suppliers of tech giant Apple, and as more come in, $12 billion in exports may be just a portion of what the state clocks in 2025. In Chennai, Jude Sanat.
Rural economy came under great pressure during the large part of CY 2024, that is calendar year 2024, especially in the microfinance segment. The sector is expected to see pain in its business going into 2025 as well. Let's take a look at the numbers. So AUM growth, that is asset under management growth, which was at 26% YOY last year, that is in 2023, has declined to less than 9.5% growth year on year this year so far. So growth is expected to further slow down as lenders battle various issues ranging from over-leveraging of customers to credit cost to asset quality pain, etc. So the biggest impact has been seen for Spandana Spurti, ESAF SFB and Credit Access Grameen in 2023. All the lenders saw improvement in their asset quality, but in 2024, ex of Satin Credit Care, all of them witnessed huge pain in their asset quality. Highest pain was seen in Fusion Finance. Amount-wise, these lenders saw gross NPA decline by 32% in 2023 and then it rose by 79% in calendar year 2024 so far. Massive rise was seen for Fusion Finance, Spandana Spurti and Credit Access Grameen. They saw their stock price and valuations also decline due to lowering of growth and deterioration in the asset quality. Now, highest decline in valuations on a one-year forward price to book value has been for Credit Access Grameen, Fusion Finance and Equitas Small Finance Bank. Marginal improvement was seen in lower valuations of Ujjivan Small Finance Bank and Utkarsh Small Finance Bank, the underperforming Nifty this year so far. On year-on-year basis, while Nifty has given a return of 17.3%, these lenders have given negative return ranging from as low as 5% to as high as more than 67%. So from 52-week high, if you take a look, Nifty has given a negative return of almost 7%, while these lenders have given negative returns ranging from as low as 31% to as high as 73%. Highest negative return is from Fusion Finance, followed by Spandana Spurti and then Credit Access Grameen. Let's look at the outlook for 2025 given by ICRA on this sector. Stricter lending norms for microfinance shall improve the credit safeguards but will pose challenges to near
Hello and welcome to Commodity Champions. I'm Anisha Gupta, and as we begin the countdown to 2025, let's take a look back at the year that was for gold and other precious metals. Well, the safe haven bet record its best year in nearly 15 years after hitting record highs around 40 times in 2024. It even looks set to breach the 90,000 level in the coming year. That is, if the geopolitical uncertainty continues to rise. Silver not too far away, its rally has largely mirrored gold's growth trajectory and has managed its resurgence in 2024. But overall, it has been a mixed bag for precious metals. To decode this rally and the outlook in 2025, we are now joined by Mr. Ashok Gautam, MD and CEO at India International Bullion Exchange at GIFT City. Mr. Gautam, hi, thank you so much for joining us. First of all, on the gold demand within the Indian markets itself, it has been quite on the higher side. We've seen an all-time high in this year. It also has been the best returns that we've seen in this year since 2010. So in many ways, gold has seen 2024 as a landmark year. How would you take a look back and summarize that for us?
Thank you for inviting me. In fact, I'll also relate it with what IBX has been able to do in this year, 2024.
Sure, yeah.
And probably the kind of interest which the gold rally has generated among investors as well as the buyers. And also we should not forget that the key point which came as the reduction in the customs duty from 15% to 6%, that also helped gold buyers a lot in India. So I'll split it into two parts. One is, of course, there are geopolitical reasons which triggered the gold rally, which I'm sure many of the investors have now gained a lot of benefits out of it. But traditionally in India, if we see the gold import numbers, they have been quite consistent. So whatever is the gold value, whether in dollar terms or in rupee terms, there has been a consistency of around 800 tons plus minus 50 tons here and there. So that remains constant. And that is something which the international market is also observing. But one more factor, which is the second part, which I wanted to say, that globally and within India also we have seen, the central banks have also upped their buying of the gold. So that has also really seen that the gold rally continues, and many of the central banks have been diversifying their whatever safe assets, whatever they are keeping in various currencies. So some of that has been now moved to the gold. But if you allow me, I would like to link it with what has happened at IBX.
Oh, well, absolutely, Mr. Gautam.
Year.
That actually was my second question. But yes, the numbers have been quite strong. The year has been very kind to you, and we've seen a lot of successes coming in. So, well, yes, to begin with, what is the kind of imports that we've seen in gold, and what is the number of jewelers and TRQ holders that are connected to you? If you could start with that, and also tell us the string of successes that you've seen in this year.
Thank you, Manisha ji, and you and your channel, they have been quite supportive of IBX. So I want to acknowledge that and start from there. Thank you for being a great support. So let's look at what we have been able to do. This calendar year we look at, this whole calendar year we have been able to show an import of around 64 tons. This financial year itself has been amazing. In this financial year itself, we have already crossed 60 tons. And overall, since inception, whatever we have done, we believe that by the end of this week, we'll be crossing the 70-ton mark for the gold import. Now, these numbers, as you see, have come with great effort. In the first financial year, the year when we were launched by the Honorable Prime Minister, we had only done 411 kilograms. The second financial year, we did close to 8 tons. But now, if we look at what we have done, these numbers look quite impressive. In fact, these numbers are what we have been projecting to our board, to our regulator, and to you when we have had the private conversations where we have said that we actually think that our first full financial year, when we are ready with everything, we should target around 100 tons. Sure. Now, this year also, this number is not actually out of our reach. Maybe since inception, whatever is the number, that 100 tons looks doable in this financial year. But let's look, what all has contributed towards it. So obviously, we know that. I'll start with what our regulator has been able to do. Because the qualified jewelers and the TRQ holders, they are approved by the regulator. And they have really set up special task force, because when the deluge of applications started coming in, when the TRQ quota for this financial year came in, we got a lot of support from our regulator. You will be very happy to know that today, the number of qualified jeweler and the TRQ holders, which we are having in our books, is 571. Okay. That's quite amazing. And we also have on the supply side 33 qualified suppliers who are already with us. So this is one factor. Second factor is that the kind of efficiencies which we have been able to bring in. Efficiencies because the kind of transparency which is there, we have kept our costs very low. We have also ensured that we work in close collaboration with customs, so that qualified jewelers as well as the TRQ holders who are coming here to import their gold, they get the import process at the customs gate very smooth. So that has also been of great help to us. Another important factor which we have been able to do is some of the things on the IT side. As you know, we are settling BDR every 30 minutes. We introduced this year fund settlement 3 times a day, so that the qualified suppliers also get their dollars very fast. Not only that, we work with some of the qualified suppliers to work on an API where the live streaming prices are now being given by the suppliers for the buyers. Initially, that was not the case, but this year we have already one qualified supplier is already pushing all their prices through API on a streaming basis. There are 3 more which are in pipeline, and I'm sure in the Q4 of this financial year, beginning from 1st January, we'll have a lot more entities who are streaming their prices.
Mr. Gautam,
So this
also
has helped entities to see the prices live on the exchange, and this has given them a lot of confidence to come here and start trading.
I'm sure.
Yes,
but
yes.
that is about gold. But you also did start silver this year. The futures is something that you also were looking to launch. Have those also made any, strong, steady moves onto that one? And what is now your plan coming in for 2025?
Quickly, Manisha ji, silver we did around 1150 tons. I think that's a good number for first calendar year. We are hopeful that going forward, we will be able to see some good numbers in silver. Though largely that silver volume were driven by the SEPA silver, which was coming in at that point of time. But we are also very mindful that what are the way forward for us. Way forward, as you mentioned, is about the gold futures. For that, a lot of groundwork is being done. So I'll just quickly tell you what all groundwork is being done. That we have reached out by way of coverage. So just to tell you, you'll be very happy to know, today, the onboarded entities in IBX are from 20 states and union territories. They are covered. We are covering 83 districts from where these entities have come on IBX. These are quite impressive numbers. And we have been doing a lot of outreach programs, one-to-one meetings with the clients, where we are explaining to them the benefits of taking gold from us and also looking at us for hedging their gold price risk, which has been permitted by Reserve Bank of India and IFSCA, where they can come on IBX and do the gold futures, use the gold futures to hedge their gold price risk. For that, many of them have already reached out to their AD banks to set up the limits for them so that they can come on IBX. And we are hoping that in the Q4, we'll be able to show some decent results on that.
Sure. So
we
this
have
is
also
about gold.
talked to various international players where they are ready to come to IBX and start making the two-way prices for the gold futures.
Okay. Well, it's interesting to know, as you said, there are participants from 20 states now. So you pretty much have covered the overall India with gift cities in Gujarat, where most of the participants are actually coming to you there. For 2025, what is it that you are looking to do more? I remember a conversation from long back, Mr. Gautam, where you said gold and then silver, and I have my eyes set on copper as well. So are all that ground being created as well, is being readied?
Okay, so let me just tell you, we did look at the platinum, but we somehow found that the volumes are not too great at this moment, but that is very much on radar, and we may have in the calendar year 2025 a platinum contract coming. Just to tell you, we have also reached out to our regulator and we have submitted our product contours for the silver futures. So we will also soon have the silver futures coming in. Apart from that, another thing which we want to do very much is that how to provide gold to the exporters of jewelry. So just to tell you, the SEZ to SEZ movement of the gold for that particular purpose, there is a SOP which has been already cleared by the Development Commissioner of Gift SEZ. They were just waiting for the ICE gate to be implemented at various SEZs, and that has been done. And for that, we have received one representation from the trade body where they have requested that can we have a category called qualified jeweler exporters. For that, we have given our inputs to our regulator, and we are waiting for regulatory and government approval for that category to be activated, where there will be some kind of lenient, criteria as far as the exporters are concerned. That is one thing. Another thing which we are very keen is that there are LBMA refineries in India for silver and also for gold. But at least for silver, what we have worked with our development commissioner and some representation has been made, that can we look at some kind of a deemed export from India to gift IFSC of LBMA silver bars, and these bars can be traded on IBX. So there are plans which we are working on. Another thing which we are very keen, which we must do in the year 2025, is that how can we invite and make our bullion depository receipt very much attractive for the NRIs, for foreign investors, and entities which are outside India and entities which are in gift IFSC, which will also mean that the funds which have set up here, if they are looking to invest in gold and silver, can they look at BDR as a avenue for investment in gold and silver? Similarly, for the NRIs, if they want to have 5 or 10% of their overall portfolio of their investment book, and they're looking at that 5 to 10% into bullion, can they look at GIFT IFSC, IIBX, BDRs for as their investment vehicle where they can invest gold and silver in? With that, I'll also say one more thing, that we are trying to develop some more financial products around bullion deposit receipt. As you know, we have been successful in ensuring that the gold or silver, the silver actually, that transaction was related to silver, the silver which has been traded on IBX, that has been delivered on one of the exchanges, vaults, and it was part of the delivery of the futures on that exchange. That is point number one. Point number two, we are almost ready with the concept that as soon as the electronic gold receipt trading starts on the domestic exchanges, we will activate the BDR to EGR portability. Now, that is something which we are very gung-ho about, and we believe that that will seamlessly bring in the gold which is coming from India, and it can, after getting traded on IBX, it can then get traded on the domestic exchanges when they are ready.
Sure.
Apart from that, we are also, the concept note is ready to develop repo product around BDR. We have also requested our regulator, and they are talking to Reserve Bank of India, how to have the gold metal loan and the gold leasing products. This we have talked to you earlier, but I believe that 2025 is the right year when we'll be able to
get all of this in. So clearly, there's a long, accomplished list that you have coming in from 2024 and big plans going into 2025 as well. Mr. Gautam, thank you so much for joining us, and we wish you all the best. And we do wish you that the list that you have or the resolutions that you have for the next year, may all of those really come true. But thank you so much for joining us, and this is wishing you a very, very happy new year. But with that, let's go for a very short break. Well, that was about gold and the imports and the demand here, but don't go anywhere, because we take a deep dive into shake-up in the jewelry market led by lab-grown diamonds with Smith Patel, director at Greenfield Diamonds, on the other side.
Or the performance of the sector. Borrower rejection rates are projected to increase significantly, as over 20% of the borrowers are expected to be impacted by the new guardrails set by MFIN. Now, NBFC MFI's AUM growth will compress to 0 to 5% growth in FY25 from 29% that they had in FY24. Credit cost is expected to be at a high range of 5.4% to 5.6% for FY25, along with margins is expected to compress the overall profitability of the sector. The sector has challenges stemming from over-leveraging of their borrowers, socio-political disruption, as well as operational challenges largely related to the high employee attrition seen over here. There is significant downside risk to the near-term loan quality of the sector. ROA or return on asset can decline massively for the lenders in large part of 2025. They are strongly capitalized, hence incremental capital requirement for loan growth will be lower due to expectation of slowdown in the overall loan growth of the sector.
2024 saw a lot of action in the mutual fund space, and funds raised via NFOs has definitely been one of them. Let's look at the numbers. Funds raised by NFOs or new fund offers stood at 1.04 lakh crores in 2024. This is still the month of November, and we have more NFOs in the month of December that has not been accounted for here. That is an uptick of 63% versus funds raised in 2023 at around 63,800 crore rupees. Now, this was slightly lower than 2022. That time, the number was 67,336 crore rupees. But 2021 also saw massive inflows. This was double the amount versus 2020, when the amount raised was around 53,700 crore rupees. Now, if we talk about the number of NFOs, 2022 still tops the list. So far in 2024, we've seen 205 NFOs which have been issued till November. This compares with 212 in 2023, 246 in 2022,
Welcome back to Commodity Champions. And 2024 saw another shake-up in the jewelry market with the rise of lab-grown diamonds. It's quietly or quite strongly becoming a preferred choice by consumers, both from a price front and sustainability perspective. The lab-grown diamond market is estimated to quadruple in India by 2033. And on the back of this, big players like Tata are planning to bid big on it. Meanwhile, stock full of natural diamond continues to grow. Will this trend see going forward into 2025 as well? To answer this, we are now joined by Smith Patel, he's director at Green Lab Diamonds. Smith, hi, thank you so much for joining us. Well, there are more listed companies which are getting into lab-grown diamonds now. We've seen demand continue to grow. We've seen prices kind of stabilize as well in 2024. How would you look back at the year and summarize it for us?
Thank you so much for having me at the show, Manisha. I would like to start off by saying that, in 22-23, India exported 4.7 million carats of lab-grown diamonds. In 23-24, it was 7.81. And this year, in the 2 quarters, we've already surpassed that by reaching a 9.18 million carats of lab-grown diamonds exported that have been cut and polished in India and mostly grown in India. So that's a very positive sign for this industry. We see that worldwide, the demand of this is still continuing to grow, and we can expect the same kind of rise happening in India as well. It is clear that the major companies are also trying to test out the markets in lab-grown diamonds. This is because the customers are demanding lab-grown diamonds. There has not been any kind of mass marketing that has happened around this product, but I think in this new technological age, the consumers are realizing that, okay, this is the potential future, and the potential for creativity and jewelry is all being explored in India as well now.
Smith, what about the prices? Would you say after that very sharp correction that we saw in 23-24 was a year of stabilization?
Yeah, so even though you can, like I told you, the rough percentage has increased. However, the prices have not, like the amount of total export has also not decreased, even though the prices have corrected. Pricing correcting actually became a very healthy thing for this industry. Because it was a new age industry, it was newly developed, the prices were pretty high in the beginning. However, the price correction has allowed a lot of other players to enter this business now, taking fewer risks and exploring the jewelry industry all over the world.
When you say new players have come into the industry, is that good or bad for the industry? And how strong is the competition right now? I was also reading a report, Smith, which says there are nearly 1,500 to 1,800 lab-grown diamond reactors in India right now. Has that number changed by the end of this year?
The numbers have definitely changed. We can estimate around 2,800 to 3,000 reactors that are currently known to me personally. So definitely there is potential for this industry to grow, and this has also helped our artisans in India, the skilled laborers, who are now cutting and polishing majority lab-grown diamonds, because it requires the same type of skill to cut both mined diamonds and lab-grown diamonds as well. So definitely,
and would you say the competition is good?
The future is definitely good.
And is the competition good as well?
I'm sorry, Manisha, your voice.
Smith, is the competition good with so many reactors and newer players coming into the market? Is the competition growing?
So it's a very healthy competition. Like I said, the price correcting has actually made this industry a lot healthier. We can see a lot more people who understand the value chain of this business entering this industry. It isn't a short, easy money-making business. It's a proper, you have to think about creativity. You have to think about the value chain. You have to think about who you're exporting, what kind of stock you keep, what quality you're focused on. So the competition actually increases the type of creation and the quality performance that each and every company will have to think about. And that is actually a very positive sign for the industry overall, because now even the end consumers will demand more and more quality products and more creative products for themselves as well.
Absolutely. Smith, I was reading a report from Wed Me Good. I mean, these guys do weddings, and within that, there is a segment which says that 45% of brides in the last couple of years, and this number is growing, have preferred lab-grown diamonds, and majority of uses in the engagement diamonds or rings itself. And, the whole emerging sense is about sustainability, about being environment friendly, and somewhere the lab-grown diamonds seem to be finding there within the space as well.
Yes, it's sustainability, environment friendly, and also the creativity, which I would like to emphasize on that, because now the brides can really, really wear what they wanted to, the things that what they were dreamt of since they were children. I can see that in my factory right now, the amount of custom designs that are coming in by brides who really want to wear what they had according to what they had planned when since they were like small. And we are enabling that right now. We have a big trade show coming up in a few days. However, I'm worried that most of the stock is being emptied out by the lack of demands that are coming in from the recent marriages that are happening in India right now.
Oh, well, absolutely. Smith, I do remember 5 years or 7 years ago, there wasn't a lot of shelf space or stalls given to lab-grown diamonds. But that clearly has changed in the last few years, would you say? Whether it's about exhibitions, whether it's about more stores opening or shelf life, synthetic diamond, as they call it now, clearly seems to be making its way.
The lab-grown diamond has definitely found its ground in India as well. The trade and everyone has been, the government, everyone has been really supportive of this new age product, and we can definitely see that by the number of people that are applying to showcase their products in the trade shows that are happening all around India as well.
Smith, what is the growth number that you've seen? While there are various reports, but since I mean, you've had a first-hand experience with this. What is the kind of growth would you say that we're looking at on an year-on-year basis, and whether it's sustainable?
The growth in jewelry in India is incredible. I've doubled my capacity every year, and I'm still on the verge of doing that. Manisha, personally, in our company, we are opening a 6th factory, which is dedicated for jewelry, and that is mainly for India, because the demand that is coming from the north, south, east, west is unbelievable, and we see the potential of this to grow even further. And this demand is coming in from not only the majors, but the small mom and pop stores who are now able to keep a lot more designs and jewelry in their shelves to show their customers. So I don't see this stopping in the near future, and I definitely think there's a lot more potential for this industry.
I have a very quick last question. And Smith, what is the largest lab-grown diamond that has been created? And as you said, 6th factory done. You've opened a store in Delhi as well. What are you looking forward to in 2025 now?
We're coming up with a store in Hyderabad, Manisha. We see a big market out there. There's a lot of potential. The largest stone we have created right now, I have a 100-carat rough in my possession. We are planning a beautiful stone in that. Let's see what creation we can do with this. The good thing about that, this industry is now, we don't care about weight as much as what kind of a beautiful stone we can plan out of that rough. And that is what the industry is moving towards. And hopefully when the piece is ready, we'll be able to share it with you.
All right. All right. It just gets bigger and better when it comes to lab-grown diamonds. And congratulations for the kind of work that is being done, Smith, and all the best to you for 2025. Wishing you a very, very happy new year there. Thank you. And with that, it's a wrap on this year-end edition of Commodity Champions. Wishing you all a very happy new year. But don't go anywhere, because more specials are coming up on the other side of this break.
And around 81 in 2020. Some of the categories that saw high flows: multi-cap funds getting in 6,300 crore rupees of money, and other ETFs at around 1,400 crore rupees. But the real star of this year had to be sectoral funds. 40 sectoral or thematic funds have seen the highest flows that we've seen in the last 5 years. Sectoral funds garnered around 67,772 crore rupees in 2024 so far, which is more than the flows in this space from 2020 to 2023. In this period, sectoral funds garnered around 52,165 crore rupees. This is via 59 NFOs. Even index funds actually saw a lot of interest. 76 NFOs in the index fund space, raising 12,147 crore rupees, which is the highest that we've seen in at least 5 years. Index funds have always seen a lot of interest, and more so in the last 3 years, with more focus on passive investing. In 2023, 53 index funds were launched, garnering around 2,700 crore rupees. This compares with 85 in 2022, and these numbers were very low in 2021 and 2020, as you can see on your screen. Interestingly, no mid-cap funds were launched in 2023 and 2024. This space did see a big rally, but did not see a new product here, but saw massive flows in the existing names. Also, only one small cap fund was launched in 2024. And now we are towards the end of 2024, and December also has seen a lot of action in the NFO space. But will this continue in 2025? Will there be new products by mutual funds houses to diversify their portfolio? Well, time will tell.
Well, the problem of 2024 for the global steel industry has been that Chinese steel demand has been weak, which has resulted in higher Chinese steel exports. Well, let's explain this to you in further detail. India's steel demand has been rising at 10% over the last 4 years. But in the same period, Chinese steel demand is down by 13%. Now, India is the second largest steel producer and will remain an important growth driver in the world. The issue is China has slowed down, which has resulted in Chinese prices slipping to COVID lows, which in turn has pressurized global steel prices. The Chinese housing market has remained weak, with prices of newly built commercial and residential buildings slipping all the way since mid-2023. This has impacted steel demand, thereby leading to rising iron ore inventory at Chinese ports, which is currently way higher than the average inventory levels. The pain point is that Chinese monthly exports have been rising because domestic demand out there has faltered. And for the first time since 2016, Chinese steel exports will clock more than 100 million tons. It's also on course to challenge the previous all-time highs. Well, the Indian steel industry, they are up in arms. Mr. Sajjan Jindal has made a solid pitch. He wants some protection for the domestic ferrous industry because Chinese steelmakers, they have an unfair advantage and part of their exports are trickling into India. Well, the Steel Ministry has recently proposed to the Finance Ministry to impose 25% safeguard duty on steel imports, as India has now turned a net importer from being a net exporter in the previous year. Well, Nuvama has said the imposition of some safeguard duty along with the onset of a seasonally good quarter could give the steel producers some elbow room to go ahead and increase prices by around 2,000 rupees per ton, as domestic prices are at a bit of a discount in comparison to the landed cost of imports. But they also highlight that factors like anti-dumping investigation in Europe and aggressive exports by China is eating into India's exports, which is more concerning than the elevated imports that we're seeing. We'll have to stay tuned to see the government's action with regard to these rising imports, but things could get better for the domestic steel industry from here on, because Chinese steel prices could have bottomed out. Their exports as well could slow down. Additionally, domestic steel makers, well, they've chalked out their capacity addition plans with focus on value addition and cost efficiencies, which could support volume growth and probable expansion of unit profitability. Well, the steel industry hopes to get its sheen back in 2025.
Hello and welcome to India Business Hour. I'm Shireen Bhan. As we close out 2024, here are the headlines on the last eve of this year. Indian equities end flat on the last trading day of 2024. Another choppy session recorded for the full year. The Sensex and the Nifty end about 9% higher. Midcap index gains more than 24%. Small cap index up over 29%. Healthcare and pharma sectors are the best performers of the year. The rupee remains weak as importers buy dollars to meet month-end and year-end obligations. The domestic currency ends 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025. With just a month to go for the union budget, the government may consider some sweeteners to encourage people to switch to the new tax regime. Sources say few economists have also called for fiscal measures to support consumption. That's an exclusive. Easy Trip Planners shares fall after co-promoter Nishant Pitti announces plans to deboard the company by selling his remaining 14% stake via block deals. However, only 1% equity changed hands in today's session. Pitti had sold 14% stake back in September for 920 crores. Ather Energy's IPO gets a green signal from SEBI, the second EV player to drive into Dalal Street. After Ola Electric, Ather is looking at raising close to 4,000 crores. This would be a mix of fresh issue and an offer for sale. The National Payments Corporation delays the plan to limit the volume of UPI transactions to 30% for each payment app until the end of 2026. The move is a big boost for Google Pay and Phone Pay, which command more than 80% of the UPI market share. A landmark year for cryptocurrencies as the Trump victory gives its wings. Bitcoin blazes ahead, shatters the $1 lakh threshold, surges close to 140%. Meme coins and altcoins steal the show. Cryptocurrencies market cap now stands at $1 trillion on the last day of the year. The U.S. Treasury Department accuses a China-backed hacking operation of tapping into workstations to steal unclassified documents earlier this month. Calls it a major incident. China denies the allegation, slams what it calls the spread of false information for political purposes. The United Nations accuses Israel of systematically blocking aid to Gaza. The World Health Organization says hospitals have become battlegrounds. As 2024 draws to a close, the death toll in Gaza stands at more than 45,500 people. Poor air quality in Mumbai prompts the civic body to impose a ban on construction along with other measures. No construction activity will be allowed in areas where the air quality index is more than 200. Well, we will come to all of that in just a bit. But first up, the market action of the day, a flat close to 2024 after another choppy session. IT stocks were the biggest drags in trade today, while healthcare and PSU stocks offered some support. Overall, though, it's been a positive end to 2024, with the Nifty extending its gains for the 9th year in a row. So let's bring up the picture for just today, which is the 31st of December 2024. Flat close for the Nifty, 100 points lower for the Sensex today. But for the year, the Sensex and the Nifty have both ended with gains of 9%, each delivering single-digit returns for the second time in 3 years. So that's the story as far as the Nifty is concerned, almost a 9% gain, and similar picture for the Sensex. The Nifty Bank, though, has been an underperformer, and that underperformance continues. The index has underperformed the benchmark Nifty 50 for the second year in a row. Rima is standing by now to wrap up the 2024 market report card. Rima.
Well, it was a modest year of gains for the large caps as the Nifty and the Sensex ended higher by 8 to 9%. But this marked the 9th consecutive year of positive annual returns for the large caps. Mid and small caps continued with their dizzying rally and ended the year higher by 23 to 24%. If you look at the one-year chart, first, it was a one-way up move from March all the way up till September. But post that, the markets cracked close to about 10% from its all-time high levels on account of various factors, prominently being the earnings downgrade seen in the Q2 numbers, fewer expected Fed rate cuts, etc. Nifty Pharma Index was the standout sector. It was the winner, 40% gain on that. But even the others, Realty 35% higher. PSUs continued to do up, though again they came off in the last 3 months. The Nifty CPSE index ending with a gain of about 25%. IT Auto up 20 to 20%. Banks had a modest year. So banks continue to underperform for the second consecutive year. The Nifty Banking Index only up 5%, but FMCG, as consumption fatigue kicked in, the Nifty FMCG was absolutely flat. Taking you through the winners on the large cap screen, Trent, it's a doubler. It's a doubler for the second consecutive year. It doubled last year and it's doubled this year with a 128% up move. And M&M was the top gainer in the auto pack. BEL, Bharti Airtel, Sun Pharma gaining 50 to 60%. On the way down, IndusInd Bank was the biggest loser, 40% down. And then you had consumption-related plays like Asian Paints, Nestle, Tata Consumer, Hindustan Unilever, all cracking between 10 to 30%. As we said, mid and small caps continue to rally despite concerns about high valuations. And look at the way some of these stocks have gained. Oracle Financial Services was the biggest wealth creator, the stock rallying 200%. EMS was a big theme which continued in 2024. The winner there was Dixon Technology. PB Fintech, capital market plays like BSC Limited, even CDSL had a good year. And then you had railway defense names. So RVNL pops up with a 135% up move. On the way down, Vodafone Idea, which struggled to raise some incremental money from the banks, was down 50%. And then many of the banking financials had a rough year. So Bandhan Bank, AU Small Finance Bank, IDFC First Bank, Poonawalla Fincorp, all cracked close to about 13%. But 2024 was the year where we saw retail flows dominate the narrative, unprecedented capital raise, a busy election calendar globally, and unabated, FI outflows. But as we look ahead to 2025, at least in the first half, will we see a recovery in Q3 earnings? 20th of January, the important day. Mark your calendars. Donald Trump swearing in, and he's promised 25 executive orders on day one. And then you've got the 1st of February budget to contend with.
Rima, many thanks for joining us, and here's wishing you a very happy new year. But on to the money markets, where the rupee remained weak as importers bought dollars to meet month-end and year-end obligations. The domestic currency has ended 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025. Lata standing by now to map out the macros in the year ahead. Lata, what's the poll telling us?
Well, the Indian rupee will slide to 86.25 by March 2025 and to 87 by the year end. That's according to a poll of economists and bank treasury heads done by CNBC-TV18. Treasury heads, of course, varied in their levels. The range for March for the rupee was 85.40 to 86.5. But for the year, the economists' forecasts lie between 86.75 and 87.5. That's by December 31. An overwhelming majority expect a rate cut in February, taking the repo rate to 6.25 from 6.5 today. But that will move the 10-year bond yield only a bit to 6.7%, bankers told us. By the year end, however, the hope is equally divided between those who see one more rate cut and those who see two more rate cuts. So the repo rate could be at 6% or could be at 5.75, 50-50 vote on that. However, the 10-year bond yield is not seen going below the 6.5% mark in 2025. GDP growth is on an average seen at 6.4% for FY25, with the range of forecasts being 6.3 to 6.5, while the FY26 growth is seen at 6.6%. Again, the range here is 6.5 to 6.8%. Inflation in the current year, FY25, is seen averaging 4.8%, which is the Reserve Bank's forecast. For next year, that is FY26, the poll shows that CPI inflation may average between 4.4, around 4.4%. The range is 4.3 to 4.5%. Finally, the current account deficit is seen at 1.35% this year, FY25, and 1.2% next year, which is very much within the Reserve Bank's comfort zone. All told, prepare for at least a 2% depreciation of the rupee and a slightly downbeat growth. Of course, that will mellow inflation, and don't expect aggressive fall in bond yields.
All right, Lata, many thanks for joining us. That's the Indian macro story in 2025. But here's the CNBC TV18 exclusive. With just a month to go for the union budget, the government may consider some sweeteners to encourage people to switch to the new tax regime. Parikshit is standing by now with more. Parikshit, more sweeteners to get people to move to the new tax regime. What else is on the cards?
Well, we had seen measures being announced in the July budget, and now in the first full budget of the NDA 3.0 government, we are likely to see more measures to encourage people to move to the new tax regime. There have been meetings with the Prime Minister's office, and we believe that a few economists have conveyed that it is very necessary to take certain fiscal interventions to boost consumption in the economy right now, even if it means deviating from the fiscal glide path slightly. But it remains to be seen what the government does in this case, because the Prime Minister has always been very clear that we need to be very clear about our path to the fiscal deficit targets that we have. The industry has also been highlighting the need for simplification of the GST system and reduction of compliances. So there is a hope that the Finance Minister will show her intention in that direction. There have been consultations on how to support MSMEs and agro-farming, and currently the government is considering new credit schemes to support these sectors. Prioritizing ease of doing business and further decriminalization of laws. These are things which we may see figuring in the budget speech as well. In the run-up to the budget, industry representatives have said that this budget is being delivered in the backdrop of a lot of global uncertainty, a lot of global headwinds, and there is domestic regulatory burden. And they hope that the government is cognizant of it and takes actions accordingly. The industry has also called for better and predictable implementation of existing laws and also new big bang reforms, such as reforms in the labour market. So let's see what Budget 2025 has in store and how much of the industry wish list and wish list from the economists is really taken up by the finance minister.
All right. Many thanks, Parikshit, for joining us. Ather Energy has received a final nod from the market regulator for its IPO. The public issue comprises a fresh issue of shares worth up to 3,100 crores. It also includes an offer for sale component of up to 2.2 crore shares by existing shareholders. With this IPO, Ather will become the second EV maker in India to go public after Ola Electric. Well, 2024 Indian companies have raised a whopping 3.5 lakh crore rupees across 438 issuances. Yash joins us now with the details on the fundraising frenzy that we saw on Dalal Street. Yash.
Well, Shireen, it's been a fantastic year as far as fundraising from the Indian capital markets in 2024 is concerned. As you said, a total of 3.5 lakh crore rupees raised from the Indian capital markets through 438 different issuances. Let's first look at the main board IPOs which happened in the year 2024. A total of 1.62 lakh crore rupees being raised and the average weighted listing premium here in 2024 that stood at about 31%. As far as the SME IPO market is concerned, that grew from just about 1900 crore in the year 2022 to 8,600 crore in the year 2024. QIPs were also the flavor of 2024, a total of 1.13 lakh crore rupees being raised by promoters. As far as QIP issuance is concerned, Vedanta and Zomato led the charge on the QIP front. Let's look at the top three companies as per the issue sizes. Hyundai with its 28,000 crore IPO, Swiggy with its 11,300 crore IPO and NTPC Green with its 10,000 crore IPO were the large issues which 2024 saw. As far as listing gains and large listing gains are concerned, Jyoti CNC had a listing gain of about 319%, Premier Energies with about 184%, and Bharti Hexacom with about 144%. There were some IPOs which listed with a discount as well. Here, the first name that stood out was Acme Solar with a discount of about 12%. Hyundai Motors, large issue, but a listing discount of about 7%. And finally, Sagility India with a listing discount of 2%.
All right. Many thanks. The year that was on IPO Street. Thanks, Yash. Aerospace component manufacturer Unimech Aerospace made a strong debut on the last day of the calendar year. The stock listed at a premium of 86% to its issue price of 785 rupees a share. The company's market valuation is now close to 7,000 crore rupees. Its IPO received robust investor response, being oversubscribed 175 times when the bids closed on Thursday. Now, Ease My Trip shares fell close to 10% in trade on the back of reports that co-promoter Nishant Pitti was planning to sell his remaining 14% stake via block deals. Hormuz is standing by with more on the curious case of Ease My Trip. Hormuz Nishant Pitti looking to deboard from Ease My Trip. Now, how is all of this likely to impact the company?
Now, there's always a way Easy Trip finds its way to be in the headlines. Now, be it the Maldives controversy or its foray into different businesses beyond its core business, there is a lot to talk about it. Now, let us take a look at the company and what is the latest that has brought it back into the spotlight. Now, news came in on Monday evening that co-founder Nishant Pitti, one of the promoters, plans to exit the company by selling his remaining 14% stake via block deals. However, today, only 1.2% of that stake has been sold. Now, based on the data last checked. Now, at the time of its IPO, the shareholding in Ease My Trip was divided among Nishant, Prashant and Rikant Pitti. Now, Rishant and Nikant had majority of the shareholding while Prashant had a negligible stake. Now, post its IPO in March 2021, Nishant and Rikant were down to 37% each while Prashant's stake remained constant. Now, by June of 2022, both Nishant and Rikant gave 5% each of their stake to Prashant taking his stake to 10.5%. Now, as of December last year, more than 65% of Nishant Pitti's 28.7% holding was locked up. Now, come March this year, that was over, and then came the selling. Now, in September, Nishant Pitti sold 14% stake in a block deal in what was an earlier plan to sell only 8%. Now, that fetched him a cool 920 crore rupees. Now, Pitti may have halved his stake, but who bought it? Did institutions buy it? Not really, because institutional shareholding in Easy Trip is nearly down to zero. Now, what started off at almost 0.25% to 7% at the time of its IPO 3 years ago, domestic mutual funds now have only 0.2% stake in the company. So who's got the stock? No prizes for guessing here. Retail. Now take a look at this. Now, similar to domestic funds, retail too started off at around 6% during its listing in March of 2021, and come December this year, that stake has gone up to 34%. So retail investors technically own 1/3 of the company. Now, in absolute terms, there were almost 50,000 retail investors in EaseMyTrip during its IPO, and that number has gone up to almost 10 lakh by the end of December this year. Now, in January, EasyTrip had suspended bookings to Maldives following a diplomatic row, and a move that was later reversed in October. Now, however, during this period, the number of retail shareholders in the stock has doubled. Now, EaseMyTrip has on numerous occasions dangled this bonus issue carrot to keep the retail flock interested. It announced a bonus issue in February of 22, another one in November, during which it also announced a stock split, and another bonus issue came in as early as October and November of this year. But have financials matched up to that? Not quite, because the profit at the end of FY22 stood at 24 crore. That number is still at 26 crore after making a peak of close to 50 crore. Now, EaseMyTrip has also been in the news for its interests other than its core business, because earlier this year, Nishant Pitti, along with SpiceJet chairman Ajay Singh, submitted a 1600 crore bid for the now defunct Go First. Pitti withdrew from this bid in his personal capacity in May, saying that he wanted to focus on the long-term vision of the company. Now, the company also announced plans in September to foray into manufacturing electric vehicles. A travel company making EVs would leave many question marks, but the kind of market that we were in back then, the stock went up 11% post the announcement, only to fall 6% the next day. So what next for EaseMyTrip? Now, to be fair, there are multiple questions that need to be asked. Will Nishant Pitti be able to sell his remaining stake? 2, if he does manage to do that, will other promoters also follow suit? Will retail continue to pile into the stock on this lure of bonus issues and stock splits and so on and so forth? And lastly, all eyes will be on the December shareholding pattern that could be up anytime next month. Now, it's been 4 years since EasyTrip went public. It has had its moments, both good and bad, but the trip ahead is anything but easy.
Hormuz, many thanks. Lots of questions there. Now, the National Payments Corporation of India has extended the 30% volume cap for third-party UPI providers by 2 years until December of 2026. NPCI had first proposed this 30% volume cap in November of 2020, later extended the deadline from December of 2022 to December 2024. PhonePe and Google dominate the UPI payments market and together account for 85% of the overall UPI transactions volumes in November, while Paytm accounts for merely 7%. Now, this move will give firms like Google and PhonePe time to bring down their transaction volumes. So this was an overhang for both Google and PhonePe, as they are clearly the dominant leaders in the payments market, but the deadline now being extended by another 2 years. The NPCI has also announced the removal of UPI user onboarding limit for WhatsApp Pay. This will be effective immediately. The move will allow WhatsApp Pay to extend its UPI services to its entire database in India. Remember, NPCI had earlier permitted WhatsApp Pay to expand its UPI user base in a phased manner. So good news coming in there for WhatsApp Pay. Up next, Punjab farmer leader Jagjit Singh Dhaliwal's hunger strike crosses 35 days. Farmers propose talks with the union government to end it. The Supreme Court defers the hearing to the case on to the 2nd of January.
India is in vogue for a number of international brands this season. Surabhi Upadhyay, CNBC-TV18, Mumbai. Hello, I'm Surabhi Upadhyay and I am going to be joined by trailblazers who are transforming the banking and finance sector in India and around the world, only on CNBC-TV18.
Celebrating 25 years of CNBC-TV18.
From sharp insights in the political arena to all the excitement from the world of sports.
are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen. We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Now, the Supreme Court held a special hearing during its winter break to take stock of the farmer protests in Punjab. The apex court had directed the Punjab government to hold talks with farmers and provide medical aid to farmer leader Jagjit Singh Dhaliwal, who is on a fast unto death. Ashmit is standing by now with more. Ashmit, take us to what transpired today in court.
Well, this was a special hearing in the middle of the winter break, and importantly, the immediate concern on the minds of the apex court as well as that of the Punjab government and the centre is the health and the well-being of the farmer leader Jagjit Singh Dhaliwal, who's undertaken an indefinite fast. It's been 35 days. He's been refusing medical attention despite the requests coming in from the apex court. The obvious apprehension that the court, the centre as well as the Punjab government appear to be working with is that should there be any untoward development regarding his health, there could be chaos ensuing in the state. And speaking of chaos, the Punjab government, the Advocate General, appeared before the apex court, clarified that there has been a state of Bandh that was called yesterday. He referred to the logjam that was caused as far as road traffic, rail traffic in the state was concerned. And further importantly, the Punjab government has conceded that given the demand, the nature of demand that the farmers have put forth, which is a legal backing for the MSP, the sensibility that the farmers have expressed before the Punjab government is that there can be a meaningful breakthrough only and only with the intervention and the involvement of the centre. Now, mind you, the Solicitor General, Tushar Mehta, he was available at the hearing. He was present at the hearing. He said that he has no instructions on the involvement of the centre as far as resolution of this entire issue is concerned. But nonetheless, the interim time that has been granted to the Punjab government to at least resolve the immediate farmer protest issues has been till January 2nd. That's the limited window. And it's only then that we'll begin to get more clarity on whether or not there's any engagement being proposed by the centre for a meaningful resolution of this dispute.
Ashmit, many thanks for joining us. In Manipur, Chief Minister Biren Singh has apologized to the people of the state for the violence that has been continuing for the last 20 months. Ethnic conflict broke out in Manipur in May of 2023, killing more than 200 people to date. The Manipur Chief Minister has been under pressure to resign for failing to ensure law and order. Apologizing to the people, Biren Singh also said he hopes normalcy will be restored in 2025.
Entire year is very unfortunate. I feel regret and want to say sorry to the people of the state for what happening till today since the last 3rd May.
Now, the government has said it is extending all help possible after a nurse from Kerala was sentenced to death in Yemen. Nimisha Priya has been accused of allegedly murdering a Yemeni national and was handed the death sentence in 2018. The Yemeni government has said that unless the victim's family pardons Priya, she will be executed within a month's time. In international news, Israeli military has continued to block humanitarian aid into Gaza. The forces have also killed at least 4 Palestinians in an attack on northern Gaza. This comes after a day of bombing in the region that killed at least 27 people across the Strip. A South Korean court has issued an arrest warrant for impeached President Yoon Suk-yeol over his short-lived attempt to impose martial law earlier this month. This is the first time that South Korean authorities have issued arrest warrants against a sitting president. Yoon has so far refused to cooperate with the investigation. The United States Treasury Department has said that a Chinese state-sponsored hacker broke into its systems earlier this month. The hacker was able to access employee workstation and some unclassified documents. The Treasury Department deemed the breach a major incident and said it's working with the FBI to investigate the impact of the hack. China has denied any involvement, calling the accusation baseless. The country has maintained that it is consistently opposing all forms of hacking. The government is looking to push for prospective interoperability of social security agreements for Indian nationals in the US. Abhimanyu standing by now with details. Abhimanyu, what are you hearing?
India is going to push for prospective interoperability of social security agreements for Indian nationals working in the United States. Currently, due to the absence of any totalization or social security agreement for Indian nationals, around $1 billion are stuck in the US as per reports from the NASSCOM, which were social security payments made by Indian nationals in the past at a point of time when they were working in the United States. However, they could not withdraw the amount or avail benefits from the deposit which had been made since they did not complete a mandatory 10-year period as per the American rules. Now, India is pushing for a prospective totalization agreement with the US, and requisite details have already been shared with the American government. Also, the Social Security Agreement is going to be one of the priority areas for discussions with the Trump administration, and despite India's push, the US till now hasn't really been too keen for a Social Security Agreement. Government sources have told CNBC-TV18 that the US believes that the EPFO model is incompatible with the US social security system. However, details have been submitted before the American government, and negotiations are underway to realize a totalization agreement which is going to benefit not just Indian professionals working in the US but also American professionals working in India. Apart from the US, India is in talks with several other countries for similar totalization agreements, which include the United Kingdom, Chile, Philippines and Sri Lanka.
Abhimanyu, many thanks. And that is it on this edition of India Business Hour. From all of us here on the team, thanks very much for tuning in day after day, night after night, right through 2024. Here's wishing all of our viewers a very happy 2025. We look forward to greeting you in the new year. Till then, have a safe one and enjoy the evening.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
SME IPOs continued to make headlines this year as well, mostly for the eye-watering subscription figures that they generated, but also for some wrong reasons as well.
Hello and welcome to our year-ender series, Outlook 2025. We're going to ask a bunch of economists how the year ahead is going to pan out. It's going to be a tough task for all of them, with President Trump taking on, starting his innings on Jan 20th with the promises of a lot of high tariff barriers. But we have three economists lined up for us. First, Sajid Chinoy of JP Morgan will be joining us, and thereafter we're going to be joined by two economists from the rating agencies, Dr. Devendra Pant from India Ratings and Aditi Nair of ICRA. But first, Sajid is here with us. He's also, of course, a member of the Prime Minister's Economic Advisory Council. Sajid, thank you very much for your time. First, draw up the global backdrop for us. I know it's tough, but the Fed has just told us that the number of rate cuts are not likely to be 4, but 2. Tell us, will global be a headwind or a tailwind for us?
Well, I think we should be prepared for quite a treacherous global environment in 2025 because there are two distinct and potentially reinforcing shocks in play. And I think it's important to disentangle both of them. The first one, which occurred with the Fed this week, really should not be a surprise for those of us who've been watching the US economy quite closely. The premise that the Fed would cut meaningfully in 2025 was based on the fact that the US economy would slow and inflation would head towards its 2% target. But what we've been seeing all year long is this remarkable US resilience. Despite monetary policy being tighter by historical standards, the US economy, even in the fourth quarter, is still growing at 3%. So forget recession, we're at 3% growth in the fourth quarter. And this has been a story all year long, propelled by a very resilient US consumer. Now, what that's meant is that the last mile of disinflation is getting much more difficult for the Fed. The fact is, if you look at the last 3 or 4 months and you look at the momentum of core inflation in the US, it's actually running at an annualized rate of 3.5%. So we're very far away from 2%. So it was no surprise that having engineered the first 100 basis points of rate cuts, I think the first 100 basis points was non-controversial given how elevated starting points were. For US policy to go from 5.5 to 4.5, was not controversial. Now, beyond that, the Fed will have to move much more cautiously for 2 reasons. One is, as the Fed chairman said, there's so much uncertainty, and we've talked about the Trump administration, that when you're driving on a foggy evening, you want to go slowly. But secondly, given what's happened in the US economy, there's uncertainty now about the neutral rate. There used to be a belief that the US neutral rate was at 2.5%. The Fed has slowly been marking that up towards 3%. I won't be surprised if that neutral rate is much higher than that. So for both these reasons, the Fed has the space to ease much less in 2025. Now, related to this is the Trump tariffs, because if you do get Trump tariffs, what the risk is that you will reinforce some of these dynamics. 2 big parts of the economic agenda for the new president is A, tariffs, and B, slowing the pace of immigration or resulting in deportation. And the dirty little secret is that high levels of immigration have allowed the US to grow at these levels and kept some lead on inflation. If you were to simultaneously slow the pace of immigration and put on tariffs, that is an adverse supply shock, which will push up inflationary pressures even more and will hurt growth. Of course, the US is hoping, equity markets are excited for the most part, because they believe, at least in the US, these 2 adverse supply shocks will be offset by deregulation and easier fiscal policy. The bottom line is there is uncertainty which could push up inflation further next year. We saw that in some of the forecasts of the FOMC members, and therefore the Fed has to move closely. What all of this means, and I'll end with this, is that the US exceptionalism that we've seen in 2024, higher growth, stickier inflation, therefore higher rates, that could get reinforced in 2025 by some of President Trump's policies. And that's why the dollar today is at a 2-year high. And that's why bond yields have backed up again.
Okay. Well, let me straight away come to India and, time permitting, go back to some of the global issues. See, we had almost started penciling in a rate cut from the Reserve Bank in February. But now, with the dollar getting so strong, likelihood of say the rupee at 85.50 or 85.30, imported inflation, and the fact that the Fed may not cut very soon in the first half of 2025, does the hope of a rate cut from the Reserve Bank fade?
So I think, having tight global financial conditions affects all emerging markets, some more than less. I would argue India is impacted relatively less because we still have very high external buffers. And I keep going back to the point that the India-US policy rate differential back in 2018 used to be 500 basis points. Indian policy rates were 5 percentage points above the US. That narrowed at its bottom all the way to 1 percentage point. And that's another way of saying India did not have to hike in lockstep with the Fed. We had bought ourselves some independent monetary policy because of the quantum of reserves. So just because the Fed is cutting less doesn't preclude the RBI from cutting. I think what will matter more from India's perspective is what's happening with inflation. We're still expecting December CPI to be sticky at 5.5%. So two things will matter going forward from the first quarter. Are we going to see food inflation roll off? That's the hope, given that we've had a strong Kharif harvest, and Rabi should be strong as well. Hopefully food inflation rolls off. And the second is the point that you made, that I think it's important, if the dollar is stronger and all exchange rates are depreciating, that India's exchange rate does not become uncompetitive. I hope at some point we talk about India-China. So if the exchange rate has to become the shock absorber, which it must in some circumstances, there'll be some imported inflation. The good news is we're starting off core inflation at a low level at about 3.6% has been the average over the last year. So hopefully we can absorb some currency depreciation and imported inflation and still have inflation in the 4 handle in the coming months. So there are a lot of ifs in that statement, but if you do in a situation where inflation is in the 4 handle, I think monetary policy will have some space to move in 2025, given the quantum of external buffers India still has. So you use the FX intervention on the dollar front, and you use interest rates to handle domestic conditions, and therefore you've got 2 instruments for 2 objectives.
No, I take your point that the Reserve Bank has always maintained that it's not going to use the interest rate instrument for external reasons or triggers. But nevertheless, you haven't answered my question on what's the space available to Reserve Bank. As you see inflation, the nowcast numbers are still looking strong. As you said, 5.5 for December. So is February even live?
I think February is live because the central bank will have to be forward-looking. And the expectation is that Jan, February, March, given how food prices are expected to evolve later in December and January, should be below 5%. So by the February meeting, the RBI will have a much better sense of how food inflation is evolving and what the quantum of this imported inflation is. The RBI's own estimates are about 5% of rupee depreciation adds about 35 basis points to headline CPI over multiple quarters. So I think in February, the central bank believes that inflation is going to be in the 4 handle. I think February is still live, barring more shocks, because I do think we have to also be mindful that we have seen a cyclical slowing in growth. It's uncertain to the extent to which the economy recovers. So with fiscal policy tightening, monetary policy, given where real rates are, may have to step in and offer some support next year.
Okay. Well, that brings me straight away to the growth question as well. We've got the scare of the second quarter, 5.4, which of course the CEA says could be revised higher. Be that as it may, what's your forecast for the current year itself? Current fiscal, I mean, and next year? Are you seeing some meaningful slowdown for both domestic and global reasons?
So we're working with a number of about 6.4 or thereabouts for this fiscal year, which entails a meaningful payback in the second half. But I think it's important to distinguish how much of that payback is because of a very strong agricultural harvest and strong government spending, and therefore controlling for that, what is the underlying business cycle doing? How is core GVA evolving? I think that will be a better signal on where the private sector is and therefore what the outlook for next year is. Under the assumption that we have a trade war next year and the US will, we take the president at its word, you put on 60% tariffs or close to that on China. Our China economists have next year's growth below 4%, right? Between 3.5% and 4%, despite the fact that China will do more fiscal, more monetary, and will depreciate the exchange rate meaningfully. Now, the reason this matters for India, so what are the channels by which India gets impacted by a trade war? The first channel, which is exports to China, are much less in the case of India compared to a Vietnam or a Singapore or Taiwan. So we don't have to worry about the export angle. We have to be far more vigilant on the imports angle, because what we've seen in the last 3-4 years is a lot of Chinese excess capacity has found itself into many Asian economies, Indonesia, Thailand, India. Now, if the US were to put on tariffs, even more of this excess capacity can be expected to be directed to Asia. And at a time where India would like to see a corporate investment cycle, if you have even more Chinese imports coming in and it's hard to compete with them given the excess capacity they have, then corporates need even more demand visibility going forward to make large investments, especially if the global environment is uncertain. We should be prepared that it's a world in 25 where you could see more global uncertainty, you could see much lower Chinese growth, you could see more imports from China.
Thank you very much for that, Sajid. Wish you a brilliant 2025. We have to go into a break. Thereafter, we are going to be joined by Aditi Nair of ICRA and Dr. Devendra Pant of India Ratings.
Nearly doubling last year, the BSE SME IPO index has jumped nearly 2.5%. This time around, gains of nearly 140%. Now, since 2021, the number of SME IPOs every year has continued to increase. Now, this time around, we had a total of nearly 250 companies going public, which are SMEs. And if that number is not enough, they raised a cool 8,700 crore rupees as well. Now, what is so special about this 8,700 crore? Now, that figure is the sum of the funds raised during the previous 5 years put together. Now, if that is not enough, the next figure is even more eye-watering. Now, these 240 SME companies that went public this year received bids worth over 12.5 lakh crore rupees. That in the quest to raise close to 9,000 crores. The SME IPOs were back in the news recently because of this company called NSE Infra, which became the most subscribed SME IPO of the year, got bids of close to 14,500 crore rupees and ended its trading debut almost double of its issue price. But is NSE Infra the IPO that got the highest bids this year? Not really, because Ganesh Infra World takes that title, getting bids worth nearly 23,000 crore rupees. It planned to raise 100 crores through its IPO. Others in that list also got bids anywhere between 17,000 crore to 20,000 crore rupees. Now, cumulatively, out of the 43 SME IPOs, on nearly 20% of the total SME issues this year got bids worth over 10,000 crore rupees or more. If NSE Infra was the most subscribed IPO this year, which were the other ones? Now, HOAC Foods, HAMPS Bio, KC Energy and Infra, and Toss the Coin is all seeing subscriptions of over 1,000 times. And of course, one must know that these SME IPOs have a smaller size. The number do appear elevated after that. But that also does not mean that there is no demand. All 5 of them saw listing day gains of anywhere between 90% to as high as 370%. So which is the issue that has generated maximum returns this year? It's a company called Oves Metal, which is up over 1,000% from its issue price of 87 bucks. The rest two are up anywhere between 700% to 1,000%. A note of caution here, most of these names are under the extra surveillance measures or ESM framework under various stages. Now, if these are wealth creators, there are wealth destroyers also. MVK Agro, Baveja Studios and others have either halved or are down nearly 70% from their issue price. With thinly traded stocks, little or no institutional interest and no widespread ownership, the scope for manipulation among SME IPOs is a lot higher. Therefore, market regulator SEBI has already come out with tighter listing norms for these companies, and they are potentially stricter rules that are also in the offing. Therefore, it will be interesting to see if these numbers are affected.
Welcome back to our Outlook 2025 series. The Reserve Bank has just cut its GDP forecast for the fourth quarter to 6.5% from 7.2% that came in the December bulletin. But how are economists taking this revision, and how do they see calendar 2025 and FY26? Joining me are two economists, Devendra Kumar Pant, the Chief Economist at India Ratings and Research, and Aditi Nair, the Chief Economist at ICRA. Aditi, Mr. Pant, thank you very much indeed for joining us. Well, Dr. Pant, let me start with you. I read up your report, and you are expecting the Indian economy to grow at just 6.6% in FY26 as well. Would there not be some cheer from the fact that we have a good harvest and there is going to be some, at least, liquidity loosening by the Reserve Bank? Won't all this mean better times for FY26?
Well, Lata, I hope I am in the same camp as you are. As of now, how the situation is. Look, liquidity impacts people at the top end of the spectrum. Now, what we are concerned with, earlier we were concerned with the rural demand. Now we are concerned with the urban demand. Until unless inflation comes down and stays at around, say, 4.5%, more than the liquidity, which will have an impact, the overall inflation decline will have a larger impact on the consumption, and so to say on the overall demand in the economy. We don't know how the monsoon is going to pan out in 2025. As of now, like Aditi or any other forecaster, everybody assumes with the normal rainfall, and it's only around June or so we have more idea about how the rainfall is taking place. We don't know how the weather pattern is going to evolve during this February and March. Will it be heat, more hotter condition compared to normal? Will there be excess rain? Will there be hailstorm? So that we are so hopeful about the good Rabi forecast after the output. If that doesn't happen, then even 6.6 will be a problem. Moreover, how from 20th January 2025 the entire landscape is going to change. Will there be a tariff war? There will be tariff increase. Now, how the commodities are going to behave? Whether how the capital flight will inflows, or whether there will be positive inflows, or whether there will be capital flight. So there are so many unknowns. So based on that, we have looked at 6.6, but any of these 3-4 things which I mentioned, if that materializes, then I'm afraid there could be a downward revision. But what government can do, that is a big challenge. And when we talk about government, we generally focus or fixated about the union government. We have to go and look at what each state governments are doing.
Fair enough.
Because if we talk about government capex, union government capex, 11,11,100 crore. A large part of is defense capex. That does not create much demand in the economy. So we have to see those things, how they are going to pan out in next year. And based on that, there may be a revision. Which way? As of now, we can't say.
Yeah, I read your report. You did say that gross fixed, government expenditure as well as private expenditure is likely to remain muted in FY26 as well. But Aditi, Dr. Pant has clearly raised the issue of consumption, of inflation bringing down consumption. That naturally focuses on what you expect from the Reserve Bank in calendar 2025. After reading the bulletin, did you get a feel that a February cut is on the cards? What is the cutting cycle at all? Is it 25, 50, 75?
Lata, if I may just add a couple of points to what Dr. Pant just said. I think one of the reasons why we're a little more hopeful of rural sentiment remaining a little more sustainably intact in the coming year is that the reservoir levels are actually quite good in most regions. And this is something that takes away a lot of the uncertainty related to particularly things like the onset of the monsoon rainfall and how that pans out in the first month or two. So as you know, July is the main month for sowing. And when reservoir levels are quite healthy, then at least we are less concerned about how exactly when the monsoon onset is and how the first 5 to 6 weeks look. So that's one positive. Second is a kind of odd thing that I'm going to say. We are now becoming more apprehensive of a larger shortfall in capital spending this year from the government of India as compared to that 11 trillion budget that Dr. Pant just mentioned. And that would probably give us higher headroom to show a slightly, kind of mid or double digit growth in FY26 while remaining within the likely fiscal contours. We do think that the government will try and target a 4.5% fiscal deficit to GDP ratio. And with smaller capex becoming more and more likely with every month of data that we're getting from the government of India, there would actually be higher headroom to grow next year. So that's a positive. But global risks abound. I mean, this is certainly one year where we're very clear that we're looking at a lot of global uncertainty and global risks. And that is something that is going to add a very wide range around baselines for all economists. Now, coming to the RBI, my sense is that it's really going to be the December CPI data point, which is going to be very, very important, which is going to dictate whether the MPC can move ahead, a kind of new look MPC in a sense, can move ahead with a Feb rate cut. Other than that, in terms of the cycle itself, we still think it's going to be a very shallow cycle, 50 basis points spread over two policies.
Okay. All right. Let me just correct what I said about Dr. Pant. The government final consumption expenditure is expected to be only 4.3, but they are expecting personal consumption to improve to 6.9% in FY26. Where will this improvement come from? Will it be urban, Dr. Pant?
Well, if it is, if the inflation pans out the way we are looking at, and our estimate is for this year 4.9, and next year it is likely to be 4.3%, then we will see that likely to see across the board. It can come both from the rural as well as urban. But for rural to happen or to consumption to grow, the 2025 monsoon is very critical. Not only overall, it's spread over space and over time. That will become very critical. If that happens, then I think both rural and urban will contribute compared to the 2024 or FY25.
Yeah. No, I take your point that, as economists and, of course, data journalists, we should start factoring in the climate impact. After all, what took away from the second quarter growth was this extra rains in August and the terrible summer that we had. So climate impinging and taking away growth is going to be an important, probably vertical in economics, which is as yet underdeveloped across the world. But Aditi, should we expect something from the budget? Reform orientation? After all, one meeting with economists is over, both with the Prime Minister himself and the Finance Minister. What would your best guesses be?
Lata, my best sense for this budget is that, what I'm really looking forward to is the unveiling of the new medium-term fiscal consolidation plan. As we all know, for this year, the government is targeting a fiscal deficit of 4.9% of GDP, and we expect it to be mildly undershot because of a shortfall in capital expenditure. For next year, the medium-term target was to get to 4.5% of GDP or below, and we expect it to be right around that level in terms of the budget estimate itself that the government puts out. But then we need to look at the fresh medium term, the next 5 years. What exactly is the government targeting? They've indicated that they want to move away from a fiscal deficit target to a debt to GDP target. So what are the contours of that going to look like? And again, coming back to what you were just saying, how are we going to build in, the new set of challenges that the government needs to address over the medium term? Climate risk is certainly one, transition risk, and the new finance commission. We will get the recommendations later on in the year after the budget. That again, how will that get factored into the medium term fiscal consolidation plan? So some, narrative around these items, I would really be looking forward to in the budget. In addition to, looking at the overall fiscal math for this year itself.
Okay. Dr. Pant, how would you draw the external, situation? It's a lot of guesses now, but we are getting hand over fist orders in terms of EMS. We are becoming beneficiaries of supply chain to some extent. Will that be a positive in terms of driving both private investment as well as consumption?
Look, Lata, looking at the size of trade in Indian economy or overall size in the global trade, India is still a small country. And it's a price taker. It's not
that's what I meant.
Price setter. Yes, there will be some improvement. There will be some, we may get some benefit, depends upon how we are able to take advantage of what is happening in our neighborhood, Bangladesh, something on the textiles. We were not able to take full advantage of China plus one. So PLI has been successful in certain sectors. Now, global supply chain, are we part of it? Unfortunately, I will say we are not to the extent we should have been.
Yeah.
So these are these challenges. External, as of now, if I look, we are on a stronger position, but how it is going to evolve post Trump in the Trump era, whether the tariff war or tariff increase, will it be just across the board? If it is across the board, we will be insulated. But if it is Indian exports or Indian commodities which are coming from India, they are targeted. Yes, we will be hit.
Thanks a lot for giving us your idea, Aditi and Dr. Devendra Pant, in terms of Outlook 2025. That's it on this year-ender special. Thanks much for joining us.
Post the stricter SEBI rules, or will this chota packet continue to give bada dhamaka returns in 2025 as well?
(2024) became a landmark year.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Indian equities end flat on the last trading day of 2024 after yet another choppy session. For the full year, the Sensex and the Nifty end 9% higher, but the Midcap index gains more than 24%. The small cap index is up over 29%. Healthcare and Pharma are the best performers of the year. The rupee remains weak as importers buy dollars to meet month-end and year-end obligations. The domestic currency ends 2024 over 3% weaker. Economists polled by CNBC-TV18 see the rupee sliding to 87 by the end of 2025. Most respondents don't see bond yields going below 6.5% in the coming year. Easy Trip Planners shares fall after co-promoter Nishant Pitti announces plans to deboard the company by selling his remaining 14% stake via block deals. However, only 1% equity changed hands in today's session. Pitti had sold 14% stake back in September as well for 920 crores. Ather Energy's IPO gets a green signal from SEBI, the second EV player to drive into Dalal Street after Ola Electric. Ather is looking at raising close to 4,000 crores. This would be a mix of a fresh issue and an offer for sale. 2024 has been a blockbuster year for IPOs with a mop-up of close to 1,60,000 crore rupees. A landmark year for cryptocurrencies as the Trump victory gives it wings. Bitcoin blazes ahead, shatters the $1 lakh